Hello, everyone, once again, and welcome to the second day of our presentations. Today, we are hosting a new cohort of our GFS students who are going to explain to us the case analysis scenario and their presentation about the US economy and possible recommendations for the policy rate decisions. So let me introduce our mock governor first, Yanis Halikas, who has 30 years of experience at the International Monetary Fund. He obtained a PhD at Yale University under James Tobin, and also Ioannis is the senior advisor at the Better Policy Project. So, Mr. Governor, do you have anything to add at this point?
Hello everybody. Hello, Alex and Emma. Uh, as you know, we're trying to make an interest rate decision very shortly. We are looking at a bunch of conflicting indicators that complicate our task as usual. On the one hand, inflation has been coming down, even though it's still above target for the third year in a row. Markets now have priced in a rate cut in September already, and following that, a steady reduction in the policy rate that now markets consider to be consistent with reaching our 2% target within a 2-year horizon. On the other hand, we do have some strong real economy data suggesting maybe that demand has been stronger than we thought, which could put some pressure on inflation conceivably. So we are a bit struggling to see how we should proceed, and therefore, Emma, I would very much be interested in your assessment of where the economy is, how we can best respond to it, what the risks are. So the floor is yours.
Yeah, thank you. I'll try
Let
my
me
best.
just quickly introduce our speaker. Thank you very much, Mr. Governor, for these remarks. So, welcome Emma, who is a participant of our summer school Intelligent Training and Research Center and a student at the Global Forecasting School. So, please welcome.
Yeah, let me just share my screen. Okay, can you see my screen now?
Yes.
Very well, thank you.
Let me just put this here. Okay. So hello everyone, my name is Emma, as Alex already mentioned, and today I'm going to present you the topic of applying risk management approach to the US economy. And as you can see already, a lot of changes are happening in the economy now. So I would love to show you my current analysis under the FPES Mark II framework, also showing you the case A and B scenarios that I created also under the FPES Mark II framework. As we already know, the case A and B scenarios are the main features of the FPES Mark II concept in general. But as governor, you're already familiar with the concept of FPES Mark II. I'm not going to dive deeper into that topic. But I'm just going to say that I think it is important to mention the main, in my opinion, the main factors of this concept, which are the risk management and transparency, in my opinion. And I think that these two factors play a huge role, first of all, in the not only in the US economy and general like in Armenia or in Georgia, in every country, these factors, I think, play a huge role. And especially in the US economy, where the inflation right now is, again, above the target, as we can see, these factors play a huge role. And I think that in my current analysis, I try to cover them in a bit, like cover them in a way. And without further ado, let's get into the main topic. So first of all, of course, I had to look at the GDP now estimates from the Fed, as I think that's the starting point for all of the current analysis. And when I looked at the GDP now, I saw that even though there were many fluctuations happening in the economy, still we see that the GDP now estimates sort of are getting closer and closer to the 2% and staying steady at that 2%. So I think that it is important to pay attention to this because a question arises, why is the US economy so strong and what sort of of factors contribute to the growth of this sort of like the growth of the economy. And then, of course, the first thing that came to my mind was the consumption. So I had to look at the real GDP per capita and also the real PCE per capita. Now, you may ask why exactly I took the real estimates, why exactly I took the real measurements, because I thought that I should look at the picture when the measurements are adjusted for the inflation first in order to see the actual growth in a way. And also I took the per capita to see the picture clearer, to have better estimates in a way. So we see that the real GDP per capita, of course, is increasing. That's not a surprise, I think. And then we look at the real PCE per capita, that's also increasing, which is, again, not a surprise because in the past few years, the consumption has been increasing a lot. And we also see that we have to think, I think, that the consumption cannot just increase that way. There should be some factors that contribute to the growth of that. And when we think of consumption, we mainly think that if people have more money, they spend more money. That's why the consumption increases, right? So again, the first thing that came to my mind was looking at the household's wealth balance sheet, because that would show us that the households became wealthier. That's why the consumption increased. So again, I took a look at the household's wealth balance sheet and mainly at the financial and non-financial assets, as you can see on your screen. And we see that the financial assets are increasing way faster than the non-financial one, which is pretty obvious because if we look at the stock market, here, you can see that the stock market is experiencing a huge increase, and it has been experiencing a huge increase for a while. And if the stock market, the S&P market in general, the S&P 500 market, is seeing a huge increase, it means that the asset prices are going to increase, right? So if the asset prices increase, then the households become wealthier because their financial assets are increasing, so they become wealthier. But again, it is really crucial to understand that this is just not a one-factor-based thing. So we have to look at the whole picture. And we can actually think that during the COVID, when people had to save a lot, they couldn't travel that much, they couldn't go to their favorite restaurants, cafes that much, so they had to stay at home and basically save their money. So that again contributed to the growth of the household's wealth. So people had more money to spend. And of course, when they couldn't spend that much money, as there were a lot of restrictions happening in the world during the COVID. And when these restrictions were taken out, they started to spend their money more aggressively. So that's why the consumption, probably like a bigger increase than what was expected, because they started to spend more aggressively because they were waiting to spend that money. They were saving for a while. So that was pretty obvious. And as I said, these factors that I mentioned, both, like all of them, indicate inflationary pressures, which is quite obvious. And also, I had to look at the core PCE, which is I think, Fed's favorite indicator. So if we look at the core PCE, what we see that there is, again, a huge increase happening. As you can see, there is, again, a huge increase happening. So the core PCE, again, shows us that the consumption is increasing. So there are many, many factors that show us that we have an increasing consumption, and it is not planning to decrease, I think, in a while. If we look at the estimates, we can see that if we forecast it, then we would think that the consumption would increase in the future. So again, I mentioned,
Emma, so just to clarify,
yeah.
so your view is that there are essentially two components that are driving consumption. One is probably pent-up demand, right, from since the COVID. I mean, we know there was a lot of precautionary saving in COVID, so that's now after we came out of the pandemic. But on top of that, there is the increase in wealth, particularly
Yeah.
non-financial asset wealth. So the presumption, I think, is that households regard at least part of this wealth increase as driven by fundamentals, as more a
Yeah.
permanent phenomenon, right?
Yeah, that's what I think would happen, I mean, in the economy, right? And again, if we look at all of these factors, all of these indicators, one thing that we can say is that there are a lot of inflationary pressures happening in the economy now. So we can assume that the inflation will increase, in my opinion, and I would actually refer to that at the end of my presentation. But of course, when doing an analysis, I couldn't let the labor market be out because that's, again, an important indicator in the economy. So I took a look at the wage growth tracker. And this one you see on your screen is the 3-month moving average of median wage growth, which actually showed a decline. And in the past few months, it has been declining, which was a surprise for me because I thought that this would show an increase too, but it showed a decline, again, a surprise, which actually contributed to the fact that there are not many inflation pressures happening in the economy. So this actually showed the opposite side, that there are many deflationary pressures happening too. So this contrasted what I just said. And that, of course, surprised me. And I had to look at the job openings. Yeah,
These are nominal wages, right?
yeah.
So is the same picture coming from the real wage side, that you have this big deceleration?
I didn't look at the real wage, but I took a look at the unemployment rate and job openings. And
Okay.
yeah, we saw there, I mean, if we look at the job openings, we see that it is decreasing again, which is pretty obvious that if the wage growth is decreasing, then the job openings would decrease too. Even though we had a little bit of like slight increase as we see on the last month, but still there is a decline happening here because we see that even though it fluctuates a bit, but in some way it decreases. So of course, as a result of that, we have the unemployment rate that increases. So the unemployment rate actually increased to 4.1%, which is not a surprise as the job openings are decreasing, then the unemployment rate would increase. But I think that actually in here, I had to think a lot about two possible scenarios. So first of all, it is really, really important to understand that in the 21st century, when there are a lot of technological advancements happening in the world right now, a lot of innovations, AI is sort of ruling the world. We have to understand that it plays a huge role, and many companies use AI for their production even. So they use robots, and the human capital, like that factor, is increasing a bit. So it is understandable that the job openings could decrease because of that, and the unemployment rate could increase because of that. But I think, again, it is important to take a look at the fact that right now we see that the consumption is increasing, right? So the demand for the goods and services is increasing a lot, which means that businesses would try to produce more of their goods and services, so the production would increase. And in this case, what first came to my mind was that probably the demand was so much that the company started to produce so much that they ended up with excess supply. So if they end up with excess supply, then the prices of goods will fall, right? I mean, pretty obvious, the prices would fall, and that would indicate that the companies can actually generate losses. And because of that, I thought the job openings could decrease. They couldn't hire that many employees. I mean, I took a look at that perspective too, because I think that's also possible. I mean, taking the fact that the demand is actually increasing in the economy now. So I thought it's actually probable to look at that too. And to support sort of that idea, I took a look at the CPI, and we see that the CPI, this one you see on the screen, is actually the
If we
percentage.
could go back to you, sorry,
Yeah.
Emma, to interrupt. If we go back to your job opening,
Yeah.
yes, I mean the rate has been falling, but it's
Mhm.
still a pretty healthy rate of around 5% of job openings, right?
Mhm.
Uh, and I think doesn't one need to take into account that there was a big, I mean, the big jump that you see when the economy opened up
Mhm.
after the COVID closures. This could account for this very large peak there, but again, if you look historically, I mean, a 5% rate of job openings is on the high side actually still, right? So is that an indication that we should take into account?
I think that in this case also, I'm not saying that the decrease is bad because we see that it's still high. So it's not that this is a huge factor. But I think that if we look at the full picture, we have to take this into account also because it is important. It shows a decline, so there is a reason behind it, right?
But part of it could be just a correction from the huge
Yeah,
rate of job
sure.
openings after the economy opened up, right? After,
Because it showed a huge increase, then of course, after COVID, a huge increase, then it should decline a bit. It is, I think, obvious.
right.
Yeah. Mhm. So again, if we look at the CPI, we see that as the percentage change, we see that it is decreasing, which again can contribute to what I said, that the prices might have fallen a bit. That is why the CPI could decrease. But as you see, as I said, this is the percentage change, so it doesn't give us that much of an information because it's not that of a big change, I think. And if we look at the sticky price inflation, again, Fed's favorite sort of indicators, we see that the sticky price inflation is also showing a decrease. But I think it is really, really important to mention here that this doesn't give us that much information because, I mean, I also took the flexible price inflation here, but I just put it here to show you the difference between the sticky and flexible price inflations. But if we look at the sticky price inflation, we see that even though it is decreasing, it is still at 4.2 or 4.3%, which is still higher than the inflation target for the US, which is 2%, as we all know. So I think that it doesn't give us that much information, but I just took this into account to show that we see a little bit of decrease in the sticky prices, which give us the information that in the economy, as the prices are adjusting way slower for sticky prices, this gives us a better picture than, for example, the flexible price inflation would give us. And after all of this, we saw that in the economy, there are both many inflationary pressures and slightly deflationary pressures happening too. But now that I have to show you the market reference with case A and B scenarios, I would say that I'm more inclined to the inflationary pressures, that I think that inflationary pressures are more in the economy than deflationary pressures. And I will sort of try to answer to that question why. And just to mention from the start that when creating my case A and B scenarios, I started from the inflation. So I thought what would happen if the inflation was higher or lower, and what effect it would have on the other factors. So if we look at the year-over-year core PCE inflation, the market, of course, expects that in the future it would go closer and closer to the 2%, as it is the US inflation target. And with the 3-month over 3-month, we sort of have the same picture with more fluctuations. But I, of course, thought that the inflation would be higher than expected after looking at the economy and all of the indicators that I took. Of course, I thought that the inflation would be higher than possible. So I thought, what if we think that the inflation would be higher than possible? What would happen in the economy? So first of all, we see that after all of that analysis, we saw that the households were becoming wealthier, the consumption was increasing, the demand was increasing. So it is pretty obvious that we have many inflationary pressures in the economy. So that's why I thought the inflation could be higher than what is expected for what market expects. But if we look at the unemployment rate, of course, if the inflation rises, then the unemployment will fall. So unemployment will decrease, which is pretty obvious. And I think that again, if the demand is high, then businesses would start to produce more, and of course, more employees are needed for that. So the unemployment rate would, of course, decrease. Then, of course, the Fed would intervene. And in this case, they would use the contractionary monetary policy. So they would increase the policy rate. And when they increase the policy rate, people would start to save more and spend less. That is why Fed will sort of intervene and try to, in some way, cool down the economy, because we know that too much growth can also be harmful. That is why we have to sort of pay attention to that. And that's the case A scenario. But if we look at the case B scenario, which is that the inflation can actually be lower than possible, and we saw that the labor market kind of gave us a bit of signs that that can also happen in the economy. So I took a look at that too, that the inflation can be lower than expected, than what the market expects. And in that case, of course, the unemployment rate would increase, and the Fed would intervene again, now this time using expansionary monetary policy. So they would decrease the policy rate. When they decrease the policy rate, people would start to spend more, save less, because, for example, if we look at the banks, then the interest rates would be favorable for people, right, to borrow money from the banks. Now, when they do that, they can actually save less and spend more. And that is why the Fed would, to say it in a harsh way, they would actually activate the economy in a way, so contribute to the growth of that. And these were the market reference with case A and B scenarios and the analysis that I wanted to present to you. But I think that it is important to mention that I think many other factors should be included in this analysis. And I just took the factors that I thought were, in my opinion, more important. So what I could say and just fit into this 18 minutes that I had. So yeah, that was it. Thank you so much for your attention.
No, this is very useful. Thank you so much, Emma.
Thank you. Yeah.
Just a question on, of course, my understanding is that you tend to attribute more weight to the case A scenario, right? You see more of the risks in that direction, although there are risks on the other side as well. Now, suppose we are wrong, right? And the economy is in fact on a more disinflationary path, let's say.
Yeah.
If we were to apply your case A interest rate path, what would be the risks? What would be the implications for the economy? Just to judge what the costs of making mistakes here is.
Yeah, I think that I have to mention that even though I think case A is the correct path, I think that case A is definitely the more riskier one. So the risk averse one is definitely the case A, because if we choose case A and it turns out that B was the right path to choose, then we will face many financial instabilities, I think. But if, for example, we choose the other way, choose case B, and then turns out case A was correct, we would just have some missed opportunities, in my opinion, because choosing case A, it means that we think that the economy will grow, but then sort of a recession can happen. But if you think that a recession would happen, then a growth happens, that is way definitely healthier than thinking the other way around. So I think that yes, case A is definitely more riskier, but I think that it is more realistic, and it is in some way important to take a risk sometimes. But again, I'm saying that case A is definitely riskier than case B.
Right. Yeah. Could you elaborate a bit, still going on the case B being the actual state, and we are choosing case A, interest rates? How would this financial instability manifest itself? What do you think are the main channels that we should be looking out for?
Yeah, so just to clarify, you're asking if I choose case A, and for example, the interest rates are high, but then it turns out
Right.
that,
If we keep high interest rates, even though in reality the economy is on your case B, more disinflationary path.
Yeah, so of course, if we choose case A, the policy rate is definitely higher, right? The interest rates are higher, then people would start to save more and spend less. So that would actually contribute to slowing down the economy in a way. So it would help the savings, and the interest rate is high. So it means that the investments can increase also, and the bond rates become favorable. And in a way, it both contributes to the growth. But I think that, of course, it slows down the economy more because the interest rates are high.
But don't you think that asset prices, for example, may be affected if we keep rates very high while the economy is growing more
Yeah,
slowly?
of course, the asset prices would be affected. As I said, also, we saw that in the stock market, we had an increase, and then the asset prices got affected because of that. So in this case, also, if the interest rates are high, the asset prices would be affected because of that. Yeah.
Yeah, and finally, a very brief question, because sorry, I was a bit late in connecting today. How do we communicate this, do you think, to the markets? Now we are tilting towards, suppose we move towards a path that's more restrictive than what the markets are counting on. How do you think, what's the most effective way to communicate our policy intentions to the markets?
Yeah, so as I mentioned from the start of my presentation, the main factors of FPS Mark II are the risk management and transparency. So I think that in this case also, transparency will play a huge role. So if we have ongoing risks, if there are many risks that can come up with choosing case A, I think that it is really important to keep that transparency and tell the market about the risks that can happen in the economy. So they will not be surprised when, for example, case B turns out to be the correct path. So keeping transparency is really important in this case.
Okay. Thanks so much, Emma. This
Thank you
was
so much.
very, very useful and very
Yeah, thank you
informative.
so much for listening.
Have a good day.
You too. Thank you.
You too. Martina, are you with us? That's great, fantastic. So Yanis, let me know when you're ready and then we'll start.
I am ready now. Hi, Martina.
Okay, fantastic. Well, then let me introduce our mock governor once again, Yanis Halikias, who has 30 years of experience at the International Monetary Fund, and he obtained his PhD at Yale University under James Tobin, and Yanis is as well the senior advisor at the Better Policy Project. So Yanis is our mock governor today. And before we begin our presentation, Governor, do you have any remarks?
Thanks, Alex. Hi, Martina. Yes, I mean, we are thinking about our next monetary policy move. We have to decide in a few days. The market is already factoring in an easing cycle to start from September on. The inflation has been coming down, although it's still above our target. But the markets now seem to be expecting a soft landing, let's call it that way, where with a smooth decline in interest rates, they are counting that our 2% target would be achievable within a 2-year horizon and with a smooth path also for the real economy. We have our doubts. I mean, we think that the path may not be as smooth. We see some pressures from the demand side. GDP has been growing more strongly than we were thinking, even a few months ago. Of course, we are trying to disentangle, is this demand? Is this more favorable supply developments that we have been assuming? Is on the demand side, is there risks of bubbles developing, and therefore, what should our policy response be? So in this kind of uncertain context, would very much welcome your assessment, your analysis of where we are. What would be the best monetary policy response, and how would we communicate it to the market, especially in cases where our policy response deviates from what the market is expecting us to do.
Thank you very much, Governor. And let me just briefly introduce our speaker today. So Martina is a master's student at Harvard University and also a participant at our summer school and a student at the GFS. So please, Martina, welcome.
Thank you. Thank you so much for the remarks. Good morning, dear Governor. Thank you for being here. So let me increase my screen. Can you see it? Yeah.
I can see it very well. Thanks.
Perfect. Today, the idea is to briefly talk about the FPAS Mark II framework. How does it work? After that, doing a review of where is the economy now, and finally, to overview our monetary policy scenarios and the guidance that we will give as an institution. So the monetary policy as a risk management, the FPAS Mark II framework that we are applying today to the US economy has this idea of being an institution of risk management instead of a forecasting expert. So the The role will be in this case to move out from the forecasting role and trying to predict that most likely outcomes and instead to give different scenarios on where the central bank thinks that the economy is heading and how it will respond to each of those scenarios, giving not the value of monetary policy instrument, but the path of this instrument. Behind this is the key importance to give the market tools to understand the Fed reaction function, using constant market feedback and answering three key questions. That is, where is the economy now? What is it driving it? So the underlying forces of it, and where the policy instruments need to be to deliver the central bank goal. So this provides a forward guidance for the market institutions, commercial banks, financial entities, etc. And of course, it acknowledges that there's uncertainties and we don't know where the tail events or the darker corners of the economy could be, as a pandemic or a sudden rise in inflation again, etc. So going to I think you were mentioning that all the news are talking about a soft landing of the US economy. This will be the second time in history that it's happened, so it's great news so far. The idea of a soft landing is that the inflation rates are decelerating, are going down, and at the same time the economy is bouncing back. We have some signs that this is happening because inflation year over year in June 2024 in this year was 3%, and the growth rate for May quarter over quarter was 2.8%. However, it's also soon to confirm that this is the case, mostly because we have political uncertainties, an expansionary fiscal policy, as I will talk now.
The 2.8% for the second quarter is a nowcast estimate, right? It's not actual data again.
So that also we will need to see a final estimation.
Yes.
To confirm this. Yes, as I was mentioning, the fiscal policy has been very loose. Maybe because it's an electoral year, maybe because it's a tendency after the pandemic. And even if the term premium of a 10-year coupon bond has a stable tendency, slightly going down in the last month, still these investors that will be contingent on this expansionary fiscal policy will ask for a higher term premium in the next few months. And of course, the total public debt is increasing, the fiscal deficit is increasing as well. So we can expect, we will need either a larger growth in the next years or a larger debt, which is already around, the debt to GDP ratio for US is already around 123%. So we will need either higher taxes, higher debt, or a larger growth. And investors, we can expect, will be adjusting to this. On the asset pricing scenario, the prices has been also increasing a lot since the pandemic. Between real estate assets and financial assets, the increase has been more than $50 trillion on the prices. And if we believe in the business cycle, this is hardly going to continue as it is, because it will disentangle an asset bubble eventually, taking into consideration that the interest rates are very high and the fiscal expansion is continuing. On the credit side and the commercial banks lending, of course, the tightening of the central bank of the Fed these years had notorious shrink on the consumer loans and the credit loans because the interest rates are high. So people could prefer to save than invest in entering a mortgage or taking new credit cards, loans, etc. And well, if this tendency continues, the aggregate demand will be expected to shrink. That's what we read from these two graphs.
Sorry to interrupt. Could this overall picture hide, overstate the increasing tightness? Because at least as far as business loans are concerned, there you have the biggest deceleration, right?
Yeah.
But at the same time, post-COVID, corporate bond markets and the stock market recovered. So
Because of
could
the
it be that
quantitative
they may
easing.
be substituting loans for other forms of market financing so that the overall...
Yeah, that would make sense. You're meaning that maybe they are buying equity in or bonds in
They're either raising equity in the stock market because it's more favorable, or issuing more corporate bonds, commercial paper, because these markets have recovered also since COVID, I think.
Yeah, it is a good point. And actually, we will need to see how the money market funds move because excess liquidity will be in the money market in between buying bonds and using them for consumption. But yeah, it makes sense also because we can see that consumption has been rising overall. So it's not that the people are spending less these days.
Right.
Not yet. So that's a good story to tell. And finally, in the labor market, regarding the labor market, even if we can expect that the next unemployment rate will be smaller because of the 2.8 in growth that we mentioned, the truth is that unemployment rate in May was slightly higher than expected, was 4.1%. So, and after all these years of tightening and years of consumption increasing, we could think that maybe the labor market found a roof. Maybe it will decelerate and unemployment might increase. But it's also too soon to know as of today.
Right, because you had other labor market developments, right? You had during COVID, in the immediate aftermath, you had reductions in labor force participation, right? People dropped out of the labor market altogether, and now they are coming back in. But still, about 4%, is that close to your estimate of where the NAIRU is?
4% is the estimate for keeping the monetary policy target, of achieving the monetary policy target. So that's a natural unemployment rate, and we will be happy with it.
Okay.
But this slightly above made us worried a bit over the last 2 months.
Yeah.
But it's true that this great resignation after in COVID could be just rearranging, and also there's different types of work, the gig economy, so more flexible work scenarios to go in and out from the labor market. That also has to be taken into account.
Very true.
So to finalize, I make 3 key scenarios following the FPAS Mark II framework. A case A scenario, that is where the economy is above the monetary policy instrument is above what the markets expect. A case B, where it is below, and a case X, Y, that show tailwinds and dark corners in the economy. So for the case A, what I think is that this will be a hawkish scenario where the Fed increases interest rates by 0.25 25 basis points in September, not in July, not this week, because the market is not expecting that this week will be any changes. It will be maybe too soon. And there are underlying forces for this. Is a strong demand that is continued because of the asset prices increase, the consumption being strong also, probably due to the expansionary fiscal policy that we have been showing, and a labor market that remains tight. So the landing will be not as soft in this scenario, and the Fed needs to keep interest to avoid having a spike in inflation. So that's the case A. The case B will be a dovish scenario where the Fed is strongly decreasing interest rates by 25 basis points in September, because the Fed sees that the labor market is cooling down and the saving rates are returning to normal levels, and the tightening of the loan conditions is really affecting the economy and taking down aggregate demand. So in this case, it's a case where the economy really recovered very quickly, and the Fed needs to. No, sorry, the economy is still not recovering, and the Fed needs to boost it a little bit further. Yeah. So the extreme case, the uncertain case, is the XY one, and this could take the Fed to decrease interest rates by 50 basis points in September and starting a new QE program, or not in September, and maybe in the near year, the next 12 months, because an event that was not expected in the economy develops.
Okay, so that's if it's even more deflation. If we cut by more,
if the
then
goes up again very strongly, and or if there's a supply shock.
Then in your view, that's sort of a dark corner where we may risk sort of a ratcheting up of inflation. Is that
it could be
the scenario here?
Yeah, it's more in the case A scenario. That's a case A scenario, but also it depends on how much the inflation goes up, right? One thing is that if it goes up by 50 basis points, and another if it goes up by 1% point in the next 6 months. However, it's true that the case XY can go, maybe we need another case, but if it could go either way. If there's a supply shock, inflation could go up because of a lack of products, but if it's a demand shock, inflation could go down. And we need to see both cases.
Is it possible to get in these types of dark corners, your X and Y scenarios, could we, by making mistakes in ourselves, lead the economy to these scenarios? And what's the balance of risks, do you think? So if the true path of the economy, for example, is your case B scenario, a kind of disinflationary, relatively low growth path, but we keep interest rates way above or significantly above market expectations because we think we're in case A. What do you think the cost should be, and vice versa, of course, if we are in the high growth scenario, but we ease very aggressively because we think we're in case B?
Actually, that's a good question, because in our FPAS Mark II framework, we include case AB and case BA costs for risk management that shows, if we choose the KE scenario, how much it costs if the economy was really in the case B scenario, and vice versa. So this can provide, I don't have the numbers of the cost now, but this provides usually to the agents an understanding of what will cost to the economy these mistakes, and also how the central bank will deal with them. Of course, we will eventually adjust as soon as what the market new expectations come in, but it's important to take them into account.
And so your final assessment, your bottom line here is, where should we be moving toward? Should it be more
Yeah.
close to the market, closer to case A, closer to case B? Where do you see the balance of risks there?
I think the market knows that the interest rates will go down, and I think that's important. But I will take maybe a few more months, or even be more conservative than the case B. So probably around the conservative market's expectations of 10 basis points 15 basis points in September to decrease interest rates, and take it from there. Because I think that it's true that interest rates have been high for long, but we don't see much effect in the economy of this, and that's scary because of asset bubbles, of extreme demand increasing. So we can expect that the real business cycle will eventually hit. But since the economy has a lag, we cannot keep them long for very much
Right.
large. Yeah, because we will see the events probably 1 year from now, 6 months from now.
Yeah.
So yeah, that's my answer. I will slightly decrease the rates on September, but very slightly, and take it from there.
Right.
So
yeah, it's just a bit above what the market expects then.
Yeah, it is true.
Okay.
And I'm looking to the market, as we can see here, the Fed fund rate evolution is around 3%. Well, it will get to a target of 3% in the medium term in 2026.
Right.
And with
but do you think we should be raising them I'm just trying to understand. Oh no, this is case A. Okay, fine. This is not.
Only case A. Only case A.
Right. Your desired one would be a slight cut, actually, starting in September already. Yeah. But a bit smaller than the market. Yeah. Okay. No, this would simplify our matters, our challenges in communicating this, because we are not deviating that much from the market. We're just a bit more cautious. Okay.
Yeah, exactly. I will mostly agree with the market, because the A is keep rising interest rates with fears of inflation behind. So the unemployment evolution in that regard is the same. In the case A, we expect unemployment to
be below.
Sorry, the colors are mistaken here, but the red will be the upper line. In the case A, we expect unemployment to be below, and in the case B to be above. And a similar.
I think the colors are correct. No?
Case A, sorry, the Zoom square is. Yeah, you're right. They used to be wrong, but I corrected them yesterday. Yeah. So case A is above, and so the unemployment is rising. We need to keep interest rates low, so we overheat the economy a bit. And in the case B, the unemployment is going down, aggregate demand is strong, and we need to still increase interest rates to cool down the economy. That will be the storytelling. And the PCE is the consumption, which is also a way to forecast inflation or align expectations on inflation. As I was mentioning, in the case A will be above the market scenario, and in the case B will be below the market scenario. This year-over-year
No,
core,
but this is the price index, right? For consumption.
for yeah,
For
for
core, yeah, the core, yeah. Okay.
the core, and
Yeah.
then we have the core 3 quarter-over-quarter.
Right. Right.
But yeah, that's what I have for today. Let me see how we are on the time. 54. I don't know
We're
if you
good.
have
We're
any
good. I
more.
think you covered everything very well. So
Mhm. Thank you. Yeah, let me know if you have any more questions.
thank you so much. No, I think you answered everything, all my puzzles at this point. But
Mhm.
yeah,
Great. Thank you
thank
so
you.
much, Governor. Goodbye.
Thank you so much, Martina.
Thank you very
Useful,
much.
very useful.
Mm.
Okay, Yanis, so now we have 35 minutes to have breakfast.
Oh, good.
Yes.
It's even
And then we
breakfast.
have then we have Tigre at 9:30, and then Gore is 6, so we won't have any session from 10 to 10:30.
Okay, okay. Did nobody has cancelled, right?
Gore has canceled at 10 a.m.
Oh, the 10 a.m. is cancelled.
Yes,
Okay.
yes, but now we just I just gave us half an hour to have breakfast.
Good, 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 good.
So
I'll
I
see
will
you. I'll
see
see you
you
there.
in cafeteria or in or here in 35 minutes. Hello, Yanis. We were supposed to have Tigran here, but he's not there.
Okay.
Well, the only person on Zoom other than us is Asya, and I don't think that's she isn't on the schedule. Therefore, I think I don't know. He didn't communicate anything, so he was supposed to be here. Well, I don't know. Suppose he's not coming.
Doesn't
And
seem he's going to show up.
yeah, and the other person is cancelled. She says
Oh,
sick. Therefore, I guess you at 10:30.
okay, whatever.
I'll email hi Cass whether he's coming. I'll let you know about an hour when we finish.
Okay,
Yeah. Well, see you around.
thanks.
No problem.
No, I don't know, but they should let us know, no?
Yeah, I mean the other person that did.
Yeah, the other person let us know. Yeah,
Yeah, but I don't know what happened. That's weird. Yeah, absolutely they should let us know. Yeah,
yeah.
I don't know. It's very weird. It's not
So
okay.
you'll keep a note as to who cancelled or didn't show up, so
Yeah,
we
yeah,
can
absolutely.
reschedule with them, right?
Yeah. Yeah, I'm
Okay,
just writing the good luck.
okay. So I
Yeah.
will let's see. See you later.
Yes.
For those not in the meeting, you can come to my room, please.
Diana, so do we know, should we go to Doug's room or stay here?
I didn't understand, Alex.
Okay, that's fine. Don't worry. Thank you.
You mentioned once someone's name, but I didn't understand.
Okay, I will just stay here. I mean, I'm fine with that. Thank you.
I'm sorry. I can't listen to. I can't hear.
Yes? No? Yes? Okay. Good. Fantastic. We start? Yanis, what do you think?
Yes.
Okay, fantastic. Thank you very much and welcome after this 1 hour break. Well, 1 hour and a half actually. So let me introduce our mock governor again. So here we have today with us Yanis Halikas. Yanis, who has 30 years of experience at the International Monetary Fund. He has a PhD at Yale University. Good. Thank you. It's always strange to listen to myself. So he obtained his PhD, Yanis, under James Tobin. And also Yanis is a senior advisor at the Better Policy Project. So welcome, Mr. Governor. And do you have any comments at this point?
Yes. Hi, Alex. Hi, Marine. Marine, as you know, we are contemplating our next policy move. In the meantime, inflation has been coming down, in fact, faster than we were estimating a few months ago. The markets are now factoring in a start of an easing cycle starting in September and continuing through the near term. And on this basis, now they expect a relatively soft landing to our 2% target within a roughly 2-year horizon. That would be, of course, a very welcome development. On the other hand, we are seeing signs of persistent real economy strength. We're trying to determine, does this reflect supply factors? Does this reflect continued strength in aggregate demand? And could that include some bubble type developments in asset markets that may be supporting demand? So these are conflicting indicators that we are getting, and I would very much appreciate your assessment of the situation, your policy recommendation in light of your assessment, and a good way to convey and to communicate to the markets our policy decisions, especially if they were to deviate from current market expectations. So I'll be very interested in your input here.
Thank you very much, Mr. Governor, for your remarks. So let me quickly introduce our presenter today. So Marina is a student at the Global Forecasting School and as well as the participant of our summer school at the Dilajan Training and Research Center. So welcome, and we are all ears listening to your presentation now.
Thank you. Let me share my screen. Hi everyone, I am Marina, and today I will be presenting an analysis of the US of the current state of the US economy using the FPAS Mark II framework. Before starting the current analysis in US economy, let's talk about the three essential ingredients of FPA scenarios. So to create effective FPA scenarios, we need to answer these three fundamental questions. Where is the economy now? What do we think may be driving it? And what do policy instruments need to do to achieve basic policy objectives? By answering these questions, we can develop a robust economy scenarios that guide policy making and enhance economic stability. For example, understanding the current state of economy in general includes analyzing the key factors such as GDP growth or unemployment rate or inflation measures and so on. Now let's understand the current state of the US economy and key factors driving its performance. So where is the US economy now? Currently, US economy is experiencing significant growth driven by increased consumption. So if we look at the graph on the left side, we can see that this has been a steady increase in GDP, with consumption being a significant contributor to this growth. In 2024's first quarter, personal consumption expenditures represent about 68% of the GDP, and this number I think very significant. I can say that increased consumption creates a positive condition in economy where higher spending means more production, employment, and income, but it also can cause inflation. If we look at the second graph on the right side, we can see that which shows changes in household debt from first quarter of 2023 to first quarter 2024, and we can see that the most relevant changes in credit card debt, and what these changes can give us. From my point of view, household debt can boost consumer spendings because people have much money to spend. Another reason for higher
Sorry, Marina, these debt increases are nominal increases, right?
Yes.
Okay.
Another reason for higher spending is that households have more wealth. After COVID-19 pandemic, asset prices, as we know, have gone up, making households wealthier. This increased wealth has led to more spending, and this trend includes both financial and non-financial assets. We also can see the second graph, which shows the rise of household net wealth. I think this increase in wealth is also due to higher income, because during pandemic people have saved too much. Now let's look at the labor market, which is currently uncertain. Let me explain this. When we looking at the labor market of the US economy, it seems that it is in a good condition with a lower unemployment rate, higher wages, but unemployment levels decreased after the pandemic, but are now showing a trend of increasing with the current unemployment rate is about 4.1 to 4.2%. Conversely, job openings are very significantly higher than unemployment rate, than the unemployment level. But now we can see that this ratio, I can see, normalizing. Additionally, average hourly earnings are rising, which can lead to inflation. And let me explain this. Higher wages means that it is more costly for firms to hire employees, and it can increase the cost for firms, and this also can lead to higher prices of goods and services. In my opinion,
I was wondering, Marina, if I could interrupt a bit. I mean, your average hourly earning increases. Do they really pose an inflationary risk there? Because I see they're settling around 4%, right? So if you take inflation out and if you take productivity growth out, they don't seem particularly inflationary. I mean, is this how you read it?
I think
So they seem to be evolving in line with productivity or even a bit below productivity growth at this point.
I don't think I can answer to this question.
Okay, no, please go on.
Okay. So, in my opinion, when we are looking at unemployment, it is important to take into account case B scenarios, because unemployment is increased. But on the other hand, when analyzing the wages, case A scenario is more relevant, I think. Now the other indicator is inflation. Analyzing inflation is important to compare these two type of prices: sticky prices CPI and flexible price CPI. Let's begin with sticky prices. Sticky prices are those that do not change frequently. They remain fixed for long periods. Common examples are rent or long-term contracts. Interestingly, sticky prices make up about 70% of the consumer price index basket, and I think this means that they play a significant role of the overall measurement of inflation. On the other hand, we have these flexible prices, which are adjusted more frequently, often on a monthly or even a weekly basis. Examples include fresh produce or fuel prices. Flexible prices are more sensitive to market conditions and react quickly to economic changes and shocks. And I can say that during pandemic COVID-19, we can say this difference. For example, in pandemic, flexible prices were rising up to 15 to 20%, but sticky prices, which are less frequently adjusted, peaked at 6.5, I think, percent, and have been gradually decreasing since. As of the latest data, sticky price inflation stands at around 4.2%, which is still above the Federal Reserve's target of 2%. The slower adjustment of sticky prices means they reflect the past inflation pressures. Given the current higher than target sticky price inflation, it suggests that there is an underlying persistent inflation pressures in the economy, in my opinion. And
Can you elaborate on this a bit? I mean, to what extent do sticky prices reflect? I mean, especially the 12-month rate,
yes.
the year-on-year rate. Could that be also reflecting base effects when prices had been set up to 12 months before, when inflation expectations were higher? So could this be a lagging indicator of what you can expect for overall inflation?
Mm.
I mean, maybe if you had a higher frequency, a more forward-looking, if you would take, I don't know, a month-on-month annualized sticky price inflation, this might give you a better sense of where things are heading. I understand that I mean, flexible price inflation have a big component which is very volatile and not very informative for inflationary trends. I mean, we have declines in energy prices, for example, which can fluctuate, and it's not part of the Fed's target anyway. But maybe should we be focusing more on say month-to-month annualized sticky price inflation rather than 12-month year-on-year?
I think in my next analysis, I consider this.
Okay.
And now the market references. Recently, inflation has come lower than expected. This decrease in inflation hasn't hurt the economy because real GDP is doing well. This situation, however, has changed the market's expectation, as we can see. As of July 25, compared to the start of the month, market expectations have been lowered. The market thinks that challenges won't cause much unemployment because the current rate is still below about 4.1 from 4.2%. The market expects the terminal rate to be around 3.5%, which is higher than Fed's estimate. This shows difference in perspectives of markets and the Fed. And I think, and also the market has increased, we can say on the next graph, increased the probability of the rate cut in September. And I think if inflation continues to drop and the economy stays strong without increasing inflation pressures, the rate cut can justify it, but can be justified. But however, I think it is still very risky. In conclusion, the market
Can you
outlook.
elaborate a bit? I mean, what might account so the neutral rate that the market views as reasonable is it's a strange combination of things. The market expects that interest rates will come down faster
Yeah.
than before, but it still views as, I mean, estimates the neutral rate at a level above the Fed's estimate and substantially above. I mean, this is not a trivial difference. Could you do you have any ideas what might account, what different assessments of the outlook may account for this difference in this discrepancy between the markets and the Fed?
I think the market expects that the inflation will be will decrease because they think that the U.S. economy is they think about soft landing and stable inflation. They have stable inflation expectations, and they think that it will. They have decreasing inflation expectations. That's why there are huge differences.
Right, but I mean, at the terminal point, their inflation assumption is very close, I believe, to the Fed's inflation target, right? Around 2%.
Yeah.
So could this discrepancy in neutral rates reflect a more positive assessment by the markets of the supply side of the economy that would allow higher potential growth?
I think it can maybe. And this is all, I think. And my case A and case B scenario. So now I want to discuss case A and case B scenarios and outline the factors for each. After analyzing the data, it's clear that there is possibility of inflation, demand pressure due to increased consumer spendings, which I mentioned earlier. This can cause inflation, leading to a response from the Fed, which can be as such as rising interest rates to cool down the economy, and also on the other hand, as well as we saw, sticky prices are still lower than which could lead to deflation. This scenario could require the Fed to decrease the interest rates to increase the interest rate. Additionally, I need to say that there is also political uncertainties in US, and this can also influence consumer and household and business spendings, which can also affect the economy. And we need to take into account these uncertainties also.
So what's your assessment? Which scenario should, or closer to which scenario should the Fed base its monetary policy on?
From my point of view, I think case A type of scenario is more relevant because as we saw, there are demand pressures, and I think it is more important to take into account this scenario.
Okay. But I assume you wouldn't go all the way to scenario A, right? I mean, it could be closer to it, but I believe you're not recommending that we raise rates, right, in the near term, as your chart there suggests.
No, I think.
So what would your recommendation on interest rates be on balance? Should we ease in September or keep interest rates as they are for longer?
I think I will keep interest rates for longer.
Mm-hmm. Okay. Okay, and I mean, as you know, FPAS Mark II poses additional challenges in terms of communicating to the market. Here we are deviating from, based on your recommendation, we would be deviating from market expectations. So since we don't have a baseline under FPAS-2, what do you think is the best, most convincing way to communicate our policy stance to the market? Should we be emphasizing, for example, our relative assessment of different outcomes? Should we identify risks to the outlook? Should we be emphasizing maybe the costs, welfare costs of lowering interest rates too fast? What do you think would be best to guide market expectations better?
I didn't think about that, but I think I need time for thinking.
Okay. Great. Okay, no, thanks. I mean, this was very, very useful, very nice analysis.
Okay, thank you.
So thank you so much.
Thank you very much, Marina. Next, we have Andre, but he's not here yet.
Okay, can wait.
Yeah, we can wait. It's sort of fun. It's sort of weird what like people are doing.
It's a bit
For
early.
example,
It's 2 minutes
2
early.
minutes, 2 minutes. So we are finishing too quickly
Let's
today.
keep our hopes up.
Yeah, exactly. The other person who canceled because he said he's feeling unwell. His interview was supposed to be at 10, like the one that was supposed to be at 10.
Yeah.
And I came to Doug's session, and he was there listening to Bayesian econometrics.
Okay, yeah. I'm sure it's more interesting.
I don't know why.
But so you'll the problem is that I cannot stay now past 5:30.
Past 5:30, so I don't know about Haikas. He isn't responding, so
No,
I suppose
no. I think Doug also meant why don't you essentially tell him don't be under pressure to pay because there will be follow-up sessions on this.
Yes, exactly. Okay, so I'll write him that because I
So
asked him like,
say that we understand that he'll be busy with the doctor and we will get if he wants.
Yes. Okay. No, I just ask him whether he wants to do
The
a
problem is that
reschedule,
now
but
I have booked. I mean, Susie
exactly.
booked.
Sure.
I've already changed the car, and there are other people involved. who are
Yes.
going to Yerevan, so I
Okay.
don't want to push
Yeah,
it
absolutely.
further.
Absolutely. So I would just let Haikas know. So that's
Yeah,
all
no,
right.
tell hikers that to take it easy and don't be under
Yes.
pressure and
Yes.
we'll
Yes.
schedule
Yes. 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 That's what I will say. But well, someone's
Okay,
missing.
let's see now. Who is supposed to be now?
Andre.
Andre. Or maybe
Yes.
Doug is
No, he's not there.
occupying him with the girl. There he is.
Oh, great. Fantastic.
Perfect.
Oh, sorry for being late.
No,
No, you're right
it's
on time.
just on time.
You're,
Just on time. Just on time.
you're
Yes.
an
So
Englishman here.
shall we start?
Yep.
Sure.
What's
Yeah.
up, meme?
Great. You all right? Yeah.
Let me share the
Okay.
screen.
Yeah, good. So let me just quickly introduce our governor. So our mock governor is today Ioannis Halikas, who has 30 years of experience at the International Monetary Fund, and he obtained his PhD at Yale University under James Tobin. And Ioannis is also a senior advisor at the Better Policy Project. So, Governor, do you have any opening remarks?
No, as you know, Andre, we are trying to figure out how best to navigate monetary policy. We have an upcoming meeting. The markets are already expecting us, have changed their expectations, their assessment of the economy. Now they're expecting a much more benign scenario with inflation coming down faster than we thought. And they're envisaging a kind of a soft landing to our 2% target within a 2-year horizon. On the other hand, there are some signs of strength in the real economy that could reflect either the demand side and possible bubbles that may be supporting that, or the supply side, which of course would have different policy implications. So, in light of this uncertainty, to guide our decisions, we very much like to see to hear your assessment, your policy recommendation, and your recommendations regarding communicating our assessment to the markets.
So let me quickly introduce our presenter. Thank you very much, Governor, for your remarks. So today we have Andre, who is a student at University of Wisconsin-Madison, and he's also a participant of our summer school at the Diligent Training and Research Center and a student at the Global Forecasting School. So please, Andre, welcome.
Yeah, hello. I have some issues here. I think it lags. The presentation lags. Oh, I guess it's fine now.
Yeah, can see it very well.
Yes.
I feel like my laptop lags, but okay. So, hello, I'm Andre, and today I'm going to discuss about case scenario for the US economy, the implication of FPAS Mark II. Let's start. Do I like from your perspective?
We just see the first slide,
We just see
case
the first page
scenarios
only.
for
We
the
haven't
US
seen.
economy.
Yeah, my laptop turns off and turns on every time. One sec. Let me turn
Yeah,
on
yeah,
the video for a sec.
no
Let's see
problem.
if it works now.
No problem. Take your time.
It doesn't work better, I guess. Um, can I join from someone else's laptop? Is it fine?
Yeah, I think so. I mean, but
Okay.
if it will take too long, like don't worry, we are fine if you can just explain like that. But if you are using someone else's laptop, that's fine.
Yeah, I'll join
Just
after 2
yeah,
minutes.
just be mindful that we have another person at 11:30. So
Maybe Alex, if you ask Andre to email you the presentation, maybe
Yeah,
you
that's
can
also possible. I can share the
Manuel.
screen, yes. I don't know, Andrea, whether you're here, but we can do it in the
Yeah,
way that
I plan to connect with Hovanes laptop. One
okay,
moment.
because you can just send your presentation to me and I can share it like if you want.
Yeah, that works better. Can
Yeah.
you tell me your email?
Sure, I'm writing in the chat. Yeah, I wrote it in the chat.
Mhm.
So like, just let me know when you want to change slides, and I will be changing it.
I've sent you. Can you check it?
Yeah. Maybe I'll refresh it.
Mhm.
I can't see anything. Maybe there's a lag. Oh yeah, I see it.
Mhm.
Let me just open it. Okay, I'll just share the PDF. I think it'll be the easiest.
Thank you.
Where's... Yeah, here we go. You see my screen?
Mhm.
Yeah.
Awesome. So I'm Andrea Vardanyan, and I'll talk about case scenarios for the US economy, implication of FPAS Mark II. Next slide. There are several essential ingredients that the framework should have. It should answer several like these questions. Where is the economy now? What do you think? What do we think might be driving it, and what do policy instruments need to do to achieve basic policy objectives? Yeah, and those are the ingredients of frameworks, like the ideal framework. It should be related to the current data. It should be realistic, and it should be relevant for policy. Um, Next slide. And the framework we use in Central Bank of Armenia is FPAS Mark II. The difference between FPAS Mark II and the other frameworks is that it gives you more flexibility. So I have different cases for different scenarios. And usually case A is a plausible hawkish scenario, policy rate path higher than market expectations. Case B is a plausible dovish scenario when the policy rate path is lower than market expectations. And of course, there are some radical cases that actually help us to avoid dark corners. So, for example, if there is a earthquake, war, or economic crisis. Next slide. Of course, both scenarios have their own risks, and usually the central bank needs to balance it. So if we have hawkish decisions, it can have several consequences, such as economic slowdown, higher unemployment, and debt servicing issues, currency appreciation, reduced liquidity. And of course, when we have the dovish scenario, it can have its own risks, such as high inflation, asset bubbles, currency devaluation, reduced savings, financial instability. We will have several of these examples of those risks in the US case in the next slides. So,
I'm not sure, can I ask something, Andre?
yeah.
So your case A, um, your case A presumably is a case where the Fed thinks that inflation is persistent relative and high relative to market expectations, right? So I'm not sure if some of these
Now, what I
things you
meant
mentioned,
here is that yes, the inflation is high. We increase the interest rate, so we fight
right?
against inflation, and those
Yeah,
are the consequences, not the reasons. So,
right,
uh,
right. Some are risks, but some are ways that the tightening would work, right? That, I mean, you would have appreciation could be a transmission channel, right? That's
Mhm.
what, or liquidity reduction again should be. If you think there is excessive liquidity in the system, reducing it might be an intended consequence essentially, or a
I mean,
necessary transmission channel of the tightening, right? And the same for
so
case B, right?
the way I thought about reduced savings is that lower interest rate discourage savings and other like fixed income investments, and
Mhm.
thus it will affect the long-term
Yeah,
savings.
no, absolutely.
That's
Some are risks, but some could be transmission channels that are normal in a sense, and
yeah,
you want it to happen, right? And
yeah.
can you explain how one of the risks in case B, the disinflationary type scenario, could be asset bubbles?
Um,
Because here
yeah, of course.
yeah,
So
please.
if we have dovish monetary policy, we want a higher employment, like lower unemployment, and it will
Right.
cause lower inflations. And yes, it will have uh, there will be excess liquidity in the market, which can lead to some speculations in investment, like real estate, the one we had like before 2008 in the US, and which eventually created a bubble which can one day explode. That's the risk.
Yeah. Okay. No, that's
Mhm.
very good.
Um, this is an example of FPAS Mark II. We can see hawkish case A and dovish case B, and somewhere in between there is the market reference, the one the market usually expects to
Mhm.
happen. Next slide, please. And as I stated before, everything has costs. So when we implement case A scenario, there are costs that like could be um, mm, mitigated by implementing case B and vice versa. And of course, the central bank should decide which path to use depending on the reality, and understand the risks, and yeah, that's all.
So this is
So let's
essentially
start.
you compare there the costs when you make a mistake, right? If we think
Mhm.
that the state
Mistakes
of
can be
economy
costly.
is one, and we base our assessment, yeah. Yeah. Could there be a case ABY, like you have a BAX there? Is there the possibility, in other words, that uh, uh, we are late essentially to loosen policy because we think we are in a high inflation scenario, uh, whereas in reality the economy is in a disinflationary scenario, in a disinflationary path, and um, could we end up in the opposite dark corner there? Is that conceivable, or is it unlikely in your view? That's why you only have BAX there. I see.
Now, of course, there can be BAY too. Like there can be many
Right.
examples. So
No, but what's your
it
assessment? I
depends.
mean, in terms of the actual
Mhm.
economy, I mean, what's the likelihood?
So if the central bank doesn't expect that shock to happen, so like it is something that never happened before, like the coronavirus before the 2020, of course there
Mhm.
can be some mistakes taken when implementing case A or case B or even XY. And of course, it will have like bad consequences if the central bank doesn't expect that to happen.
Right.
So there
Okay.
can be BXY or BAY. Um, so comparing potential GDP to an actual GPT of the US, we can see that they are relatively close. Of course, there were times of boom, there were times of recession. My data is from 2016. We can see a dump in 2020 because of coronavirus. But now, like during the time I'm doing my presentation, the economy is actually over the potential GDP, which of course has some negative consequences. Um, like overheating of the economy, but there are like better consequences too, such as like low unemployment. And in the next slides we'll talk
What's
about
your
it.
potential? What's the potential growth there underlying your blue line?
Yeah, it is the expected growth, expected potential GDP. Like they use
How
growth
much is
models.
your estimate of that?
Um,
No, I mean, what's your
sorry,
estimate of what is your estimate of potential growth?
it's expected to be 2% a year, like the
2%. Okay.
average. Mhm.
Yeah.
But yeah, it's never actually 2%. Usually it's like higher than 2 or lower than 2.
Right.
That's
No,
why
no,
we
but
see that.
just out of curiosity. Yeah.
Here we can see the GDP. The next slide, please, Alexander. Here we can see the real GDP growth. Unfortunately, because I sent it through email, there are some errors in the slides. Alexander, can you please download it and open it as a presentation? I think you shared only the Google Chrome.
Wait, let me redo it. Guess should be that one. Yeah, you can see it now? Can you see it now?
Yeah, now it
Very
is
good.
more elegant,
Yeah,
the
okay.
presentation.
Wait.
So again, we can see negative growth in 2020, but after that there is a huge increase, approximately 6%. But eventually it will gradually converge to 2% real GDP growth, if of course there will be no other shocks. And yeah, it will have like long-term, short-term and long-term consequences, which are discussed in the next slides. Those like huge increase and the decrease. Here we can, next slide, please. Here we can see the shares of GDP. Like from the first side, everything looks like steady, but in 2020, we can see increase in government spendings. There are several reasons behind it. First, the government doesn't want economy to slow down, so it promotes the projects, usually infrastructure projects, to keep the economy going. And the second reason is that because there is an economic crisis, the wages actually go down, and it is beneficial for the government to invest because the actual cost of the investment, like in the infrastructure, will be lower than if the government will do those projects um, during like none during the boom periods of the economy. Next slide, please. Here we can see more detailed shares of the GDP. So as we can see, consumption dropped during the COVID, but then increased, and it is approximately 2/3 of the GDP, which is expected to be. Below it, we can see investment, and we see that investment fluctuates more. It is because the investment has a beta component on it, and it is easier to predict whether there will be an recession with investment, and we can see that during the COVID investment it dropped really significantly. But again, investment is fluctuating a lot. Everyone can interpret it like he wants. Um, so, but now it is approximately steadily around 10-ish% of the 10-ish% share of the GDP. And then we see the government spendings, as I told the government spending increases during the crises. and net and here is the below the government spending. There is the net exports of goods and services, and again it is usually negative in the US because it imports more than exports. But we see some increase of of exports than imports. Yeah, next slide, please. Let's understand the unemployment rate. Unemployment rate is approximately 5% in the US, the potential unemployment rate. But again, it fluctuates a lot because it's a flow. It is in a flow state. We can see that unemployment rate increased during COVID, but then it gradually decreased. And in 2022, it's actually lower than the potential unemployment rate, which indicates that the economy was above its potential GDP. And of course, it had some consequences such as high inflation, but it had like better consequences such as like low unemployment. So more people were employed. The economy was growing faster. Yeah.
Could 5% be too high for the Nairo, in the sense that, I mean, you got long periods starting from 18 to COVID, really, and more recently
Excuse
now,
me?
but because you had this long period from 2017 to the eruption of
Before the
COVID, wherein unemployment was well below 5%, but inflation was pretty stable. Could we be overestimating the Nairo level? Could the Nairo be a bit lower than 5?
Of course, there might be some measurement errors. There can be like measurements errors of unemployment, the potential unemployment, not the actual unemployment, and of course the inflation. We saw some of those measurement errors during the COVID, then when the inflation was actually higher, but it was measured lower because the CPI was used. And here too, there can be measurement errors. There can be some other factors that unfortunately I ignored during my analysis.
Okay, no, that's useful to know. I mean, I'm just trying to understand.
Sorry?
No, that's useful to know. I'm just trying to understand you the numbers here a bit. Yeah, yeah. Please go on.
Yeah. So let's understand the labor market. Next slide, please. So we have the 3-month moving average of unweighted median hourly wage growth overall. So that's the growth of wages, hourly wages, compared to the same month of the previous year. So in the last period, we have 4.5-ish%. It means that in 2024 April, the wages increased by 4.5% compared to 2023 April. And we see the job openings, total non-farm. Of course, the wages in the US increase always. Like, of course, if there is not a like huge recession or depression, but we see some decline. So the rate of change of rate of change decreases, and it can be because the demand demand of laborers decreased, so it shifted down. And the reasoning behind it is that job openings, we see that it lowers too. So the businesses, they don't want any labor anymore, like they want less labor, and it can be the reason of slowdown of the economy. But I'll be optimistic here. It's not because the new recession is coming. It is because the actual boom of like aftermath COVID boom is gradually slowing down, which is a natural it's happening naturally. So there is nothing to worry about so far. Next slide, please. And of course, the inflation. when we compare inflation with the other graphs, with the graphs I showed you before, we can see that when unemployment rate is low, the inflation rate is high. But inflation rate will, if correct policies are implemented, the inflation rate will gradually come to its target, which is in the US case, it is 2%. There are several reasons behind it. First, it is that there are no demand shocks in the long run. The expectations are low in the long run. Expectations of inflation in the long run are 2%. Of course, those are the two major reasons. And how can we state that the expectations of inflation are low? Are in the next slide, Alexander?
Actually, could you elaborate a bit why we put special attention to sticky price inflation?
Yeah. So a sticky price inflation is the inflation that excludes energy, like fuel and food, because those commodities they fluctuate a lot. So, for example, the price of oil, it fluctuates a lot, and you cannot necessarily understand whether the inflation increased because of the oil or because the other good actually increased. And the food is the same reason. It can be seasonally. So the same fruit in winter can have different price than in summer, because of course there are like other periods of growth, like different periods of growth throughout the year. So sticky
But
price.
doesn't the sticky price inflation or the sticky price index exclude other items as well? I mean, the traditional core or underlying inflation excludes food and energy, fresh food and energy. But I think sticky price index excludes a lot of other items as well, right? I mean, excludes types of goods and services
it
which
includes some
change prices
service.
frequently, right?
I think it excludes education, medical services, and some other services too. Yeah, the things that can fluctuate a lot throughout the
Yeah.
the
Also,
year.
when you're using it to understand inflation, I mean underlying inflationary pressures, given that these are sticky, right? Is it better to use the year on year, which could have big base effects, right? Some of these prices were set when inflation expectations were much higher. But
I mean,
shouldn't you use more, say, month-on-month annualized to see what the latest forward-looking tendencies are there?
I mean, here I wanted to see the relation, and like any measurement of inflation I used, I would like expect to see the same relation. So an increase after COVID math, and a decrease starting from 2023.
Yeah.
So
No,
it is just
I'm
for
sure
the
you get the same. I mean, the general tendency should be similar, but a year on year, an annualized month on month, say, for the latest month might give you a better sense of if you want to use it in a forward-looking sense of how inflation. What's your view of that? Wouldn't that be a better give you a better sense?
Yeah, it might be like it would give like more precise data. Yeah.
Yeah.
Next
Okay.
slide.
Yeah. I mean, just an observation. It's not.
So the interest rates, of course, the central banks are for setting up the interest rates. We can see that when the inflation was high, the Fed decided to increase the interest rates, which were like approximately zero for about a decade. The same with 10-year interest rates. We see that they gradually increased, but they are actually lower than federal funds effective rate. So it can mean that in the long run, the Fed will keep the 2% interest rate idea or even lower, everything to have an inflation of 2%. And it will motivate people to know that in the long run, interest rate will be 2%, and the expectations of inflation will eventually converge to the expected inflation rate.
In the long run, you expect the real neutral rate to be zero?
Yeah, if the Fed will, if the Fed wants, if the inflation is low and the Fed want to increase the inflation rate, then yes, the effective rate might be 0%. We could see it like in 2010s when the interest rate was approximately 0%. It cannot be negative for several reasons. The banks need to have an income, but it can have 0%, approximately 0%.
Yeah.
That's
That would be your steady
like,
state estimate of the neutral rate then.
excuse me?
You're in the steady state when the Fed has managed to hit its inflation target and inflation remains stable at the target. Would you expect the inflation, and the target is 2%? Would you expect the interest rate consistent with this level of inflation at the target to be 2, or the real interest rate to be a bit positive at that point?
Like if the inflation is in its target rate, I would expect the interest rate to stay constant, like the one before. It will depends when the inflation rate goes high, the interest rates will go high also. When the
No,
inflation rate goes low.
when it has reached 2%, and let's suppose we manage to keep it there. I mean, the interest rate consistent with that, would you expect it to be zero in real terms or positive in real terms?
I expect it to be positive in the real terms.
Okay, so
But
above 2%, right?
But it can fluctuate. So interest rate can fluctuate too, depending on the state of the economy.
Okay. Yeah,
If
please
we
go
can
ahead.
proceed quickly to conclusion
Yeah.
because we are already over time.
Yeah.
So 1 minute and let's move to Lukasi.
So can you open the next slide? So I've talked about possible asset bubble. We can see it here. There is like a $58 trillion increase in assets, which can indicate some bubbles. It is because the Fed has had low interest rate when it used to have high interest rates. So in 2021, like 2020 and 2021, they increased it in 2022. So of course, this is a thing we should care about like when implementing next policies. And in the end, the next slide, Alexander. Those are like my implications. We can see there are like hawkish and dovish scenarios, and eventually all of them will converge to, in the long run, they will converge to the same point, because in the long run there are like there are like lower risks and so on. Yeah, that's so far.
Thank you. Thank you very much for your presentation.
Thanks very
Mr.
much,
Governor. So I guess we can move on to Lukasi, who will be next. Yanis, shall we proceed, or just let me know when you're ready?
Can you give me actually a minute? Apologies,
Absolutely.
Lukasi.
Don't worry.
I need to.
No worries.
I'll be right back.
So just to clarify, you are now, and then are there any changes?
After me, I guess there's a Sophia.
Okay, let me just change the schedule.
I-
So you are at 11:30, well, slightly
Yeah,
later, but
instead of Ivan.
okay, and instead of Martin, there's Sophia.
Yes, and could you write in the chat if Tinatin is changing the slot with the next one?
Just clarify that yourself if possible, because
Okay.
otherwise it will create a huge mess, and I need to.
Okay.
So this is confirmed. This is
Because
confirmed
we
for
are
me,
we are
Martin.
going to Tbilisi, and that's why.
Okay, yeah, just discuss it and just tell me directly when you know if that's possible. Because sure.
Yes.
And so who is so when is Martin and when is the other person?
And
Van?
after Sofio, Tinatin will be presenting. She text me now.
Okay, does Hovannes know about that? Does he know that he switched his spot? Because this is very important.
That much I know. I will tell Tinatin to write in the chat. Okay.
Okay, okay, I'm not okay, let's just stay the schedule as it is now, because this is
Okay.
like late. I understand there might be any like confusions at the end and some changes has to be made, but it has to be confirmed with other people that they know that they're changing their slot and they
Sure.
know that they can change their slot during that time, because otherwise it will be messy. So thank you very much, and shall we let's start?
Sorry about this.
Yeah. Yeah, don't worry, Johannes. So, hello everyone once again, and I'll quickly present our mock governor today, who is Ioannis Halikias. Ioannis, who is a senior advisor at the Better Policy Project, at large experience at the IMF for 30 years, and he obtained his PhD at Yale University under James Tobin. So welcome, Governor, and do you have anything to say at the beginning?
Yeah, hi, Lucas. How are you?
I'm fine, thanks, dear Governor.
So we are trying to think about how to adjust our policy going forward. The markets, as you know, expect us to start easing very soon, as early as September, and then follow a gradual, steady easing. And they have revised their inflation expectations down. So now they expect, on the basis of this path of interest rates, a soft landing to our 2% target within a couple of years.
Exactly.
That would be a very benign scenario if in fact it's validated. On the other hand, we are a bit puzzled about continued signs of above potential strength in the real economy. We're not sure if this reflects demand, if it reflects supply factors that could be boosting GDP. If it's demand, this could create inflationary risks down the road, so that the inflation path may be higher than what the markets are anticipating. So in the context of this uncertainty, I very much appreciate your analysis and your assessment of where the economy is, what we should be doing, how we should communicate our decisions to the market in a convincing way. And I'm very eager to hear your assessment.
So let me introduce quickly just our speaker, our presenter, Lukasi. So Lukasi is an intern in the National Bank of Georgia, and as well a participant in the summer school at the Intelligence Training Research Center and GFS student. So welcome, Lukasi, and we are all ears
Thanks for
listening
the
to your
introduction.
presentation.
Do you see my screen?
Yes.
Okay, nice. Thank you, dear Governor. So I guess we are all familiar with this ELPAS Mark II approaches and the framework. So just to give you the insight, what I'll be doing, it will be analysis based on this framework. So in which I will offer and suggest the current analysis, and after this, I will observe the data to tell you so which type of scenario we will be hitting in the future, and given the market reference, what are the additional shocks or uncertainties that might change our expected path. So just for the simplification, I draw some lines to give you the better insights for the people who are watching right now. What is case A scenario and case B scenario, above the expected path and below the expected path. In reality, what our market reference is the following that is given on the graph. So we know that the latest update, it was updated, and we see that the inflation expectation we observe the in policy rate, which is going down. So we are using the center Fed using smooth landing. But if we look at the range in which it will be hitting, it will be something in between 3 and 4%, which is quite high number. And I see a kind of possibility that maybe if it is a nominal interest rate, then real interest rate will be also above 1%. And this is high above the neutral rate that we observe right now. So there is a possibility, dear Governor, that in the economy we observe high real interest rates. So that's why maybe we have to revise our understanding about real neutral interest rate. Just the insight from this graph and the expectation from the market. So given this information, now I go to the current analysis directly to give you some insights what's going on in the economy. So first of all, we observe that we have decreasing inflation and increasing unemployment. Let's split this graph into two parts. First of all, we observe that inflation is going down, but uh, we still have to be very careful and cautious. And now I will tell you why. Because we see that even though there are downward trends for the inflation, for the sticky inflation or the general CPI, we have to be very careful because the level of the inflation is still above the target. So yes, it's going down. So we are observing sticky price inflation, which consists 70% of our CPI and goods and products, goods and services, but it's still above the target. So maybe we should be more careful and don't use this cutting interest rate immediately because the underlying forces is still remaining into the economy. At the same time, I want to tell you that the latest update of GDP now is showing 2.8%, which is well above the potential level that is observed in the US economy. And for the information, we observed this high growth of GDP for the 2 quarters. In the previous quarter, it was high. In this quarter, it is also high. That gives me the insight that based on the Ocon's law, simple law, if there is a high level of GDP growth, maybe unemployment will go down instead of increases. So we observe that unemployment goes up, but in reality, if there is a high GDP growth, it might go down. So in this case, the scenario will be changed. So if we observe increase in unemployment now, if it goes down, we need to use kind of case A type of scenario in which we need to anchor inflation and inflation expectation to its target, therefore increase interest rate. So this is a uncertainty we need to look at. At the same time, we see that labor markets are in better balance, meaning that the upward pressure on the wages goes down because vacancy to unemployment ratio goes down to this initial level, not initial, but pre-pandemic level. So it's a indicator that there is a no upward pressure on the wages. At the same time, dear Governor, we observe that wages, the average hourly earnings year over year growth is stabilizing. So there's a modest growth. Therefore, I don't see additional wage pressure into the economy. However, what we can say that we can also observe in order to find out this inflationary pressure into the economy for the case A type of scenario, we have to observe commodity prices. So first of all, let's observe oil prices. We see that they are stabilizing around $82 per barrel. But if we look at carefully on the right side of this graph, we see this upward trend. Maybe it indicates that there can happen something, dear Governor, which might increase the price of oil. So the transportation cost will be higher, maybe cost push shock will happen, and we need to be more careful because it will create additional inflationary pressure into the economy. However, on the other hand, we observe that wheat and corn prices are declining and there is a downward trend, I mean clear downward trend, which might indicate that the general cost of producing goods and services, which requires wheat and corn and this kind of agricultural commodities, will not create additional price pressure into the economy. So it's very interesting to analyze both cases because the previous graph was kind of case A type of scenario explanation, while this graph is case B type of scenario explanation. So it gives us more space to communicate with the public given the information we observe here. Let me move on. So we see that this was the pressures into the economy that I was describing. Now let's go directly to the consumption because it is the main driver of GDP growth. I guess so. It's very important to analyze it. So first of all, we observed that in real and nominal terms, uh, there is an increasing demand on consumption. So if there is an increasing demand on consumption, it means that people demand more, people boost the economic activities, people create the inflationary pressure. So direct a message into the economy that there will be necessity of high interest rate, but it might not be true because let me skip these slides because they are additional slides we can use and interpret them later. We see that even though there is an increasing demand, we should not be very careful because we observe cooling down process, dear governor, because personal consumption expenditure year over year growth declining. I mean, this growth is not drastic, so we might observe the situation cools down by itself step by step. So we can use this information to say that
Lukasi,
here,
this is nominal, right?
this is nominal, yes.
Okay.
Yes. So we can use this graph to say that there might not be a situation in which we need to increase interest rate, but we can see the uncertainty and the risk into the economy, namely there is a room to fuel consumption further. I believe that you've seen this graph many times, but here
Yes.
I want to tell you that all this indicator says that there can be pressure into the economy. But what I want to focus on is this. Maybe this information gives us the right to say that people not only have more to spend, but they have confidence to spend. What does it mean? Maybe in the future they won't have that much amount of financial or other type of resources, but they will have confidence. So this term confidence is very uncertain. So we need to careful while dealing with it because it might create the environment in which maybe consumption or goes down or the asset goes down, but people still spend because they are confident. So that is one type
So,
of uncertainty.
the reading is that even though there could be a bubbly element, there is also a
Exactly.
fundamental element in this. At least that's what the market perception is, right?
Exactly.
That there would be favorable supply developments, the productivity developments that justify in part at least, this
Mhm.
increase in asset price.
Exactly. That
Okay.
I wanted to say. Okay. Now
Yeah.
goes to the next one. Next one is very important. This is positive output gap. So we know that positive output gap can create inflationary pressure, and that's the kind of main indicator or main term in our models. But we know that there is a closing tendency. So maybe in the future, step by step, it will go to the zero. So there won't be any positive output gap. But given the information that GDP growth is well above the target, I mean, sorry, real potential growth target, it might not be case. But right now we observe the closing tendency. However, we see that
But
this
again, in
closing
line with the previous slide, right? If in fact there are some
exactly.
favorable supply developments, potential may be shifting upward relative to its past trends, right?
Yes, that's why this slide comes after the previous slide. And the
Right.
next slide is also a supportive slide of the fact that maybe our output gap won't close because there is a still high demand on loans and the amount of loans are increasing, both all commercial banks loans and real estate loans, which are also very important. And we need to consider that, excuse me, we have to consider that households are spending a smaller portion of their income on debt payment. What does it mean? It means that they have to spend less, meaning that they have more financial resources to spend on the consumption, meaning that in the end it can boost the economic activities again, boost the demand, create inflationary pressure. However, still on the other side of this coin, we can see that maybe people taking more and more loans, but bank lending conditions continue to tighten demand because this some indicator shows that banks don't issue these loans easily. I mean, given the information on the right graph. So maybe this tightening condition is declining, but in the end, on the right-hand side, if we look at, there is an increasing trend. So maybe they will tighten this policy even more. So we need to be careful, because if this tightening process is too high, then maybe we need to boost economy by lowering the interest rate. So there is an uncertainty here. There is a risk, excuse me, this is not uncertainty. I would call it a risk of big tightening of the policy. And what I wanted to say with related to the loans, saving rates are getting back to the normal rates. Very important indicator, meaning that we are kind of moving out from the COVID era, and we are stabilizing our saving rates into the economy. So it is not exactly at the previous level, but it's stabilizing, and it's getting the level that it was pre-pandemic.
And in
The
fact, if fundamental factors have increased wealth, right,
Mhm.
this could justify lower equilibrium saving rates to some extent.
Exactly, because they have higher income and higher financial resources in their pocket, let's say.
Mhm.
Okay, next one is also very interesting, related to the bonds. We observe that term premiums are close to zero. I mean, 10 years zero coupon bond, 2 years zero coupon bond, and 1 year. What does it mean? I mean, let's talk about it in a logical way. If they are declining this term premium, they are not expecting something big changes and fluctuations or the risk in the market. So they expect that interest rate will be lower. So it gives us the ability to communicate with the public that yes, you are more or less right. There are no need of increased interest rate, because what you are thinking is correct, and we might use this smooth lending to cut the interest rate step by step, and kind of match with this expectation from the public. Another interesting indicator of this volatility is VIX indicator, which clearly shows that volatility is declining into the economy. So economic perception of people about economy is getting stable and stable, which gives us more space, because we don't need to use kind of aggressive policy to fight against these volatile expectations, because they are declining. And even more, as long as we are speaking of the volatility and these expectations from the public, let's look at this equity market volatility tracker. So macroeconomic news and outlook. We have three measure: interest rate outlook, inflation outlook, and business investment and sentiment. All of them, especially the last one, shows that there is a no risk. I mean, no risk is a wrong way to say it, but there is a low risk or low expectation of having uncertainty or the on the unstable environment into the economy. So we can say that equity market expects in general that situation will be stable. So no need to kind of case A type of scenario, I would say, or even case B type of scenario. So we could follow market reference. That's what I want to say. But the next slide gives us very interesting insight, dear Governor. It is the volatility tracker related to the elections and political governance. We observe that this index was stable before the 2024, but in this year it goes up. What does it mean? Maybe it means that people are not comfortable with this upcoming election into the economy, and they may revise their expectation given the information they will be receiving step by step as they are getting close to this election and the result that will be on the table after the election. So this is actually uncertainty, and we need to look at it. And in what type of scenario we can look at it, I will be talking later before we can go to the shocks. Now, to summarize, dear Governor, we have market reference, which is quite aligned with this Fed operations and what market think. This smooth landing or step-by-step decreasing interest rate goes to the target. However, to summarize, we have different types of considerations. For example, for the one side, case A type of considerations can be that there are strong demand and positive output gap persist, or recent trends in the oil market may indicate an increase in its price and transportation cost. that is related to cost push shocks due to increase in transportation. At the same time, we observe increase in household wealth, increase in the confidence of them, so they might continue spending, sustain consumption. There are also a possibility of having higher neutral rate. We need to reevaluate it. It's very necessary. And in the end, maybe we need more aggressive policy due to uncertainty future election in the US, or there also might be the case, depends on the result of the election, might be the case of fiscal dominance. So I'm not sure about it, but we need to consider this possibility. On the other hand, dear Governor, there is a case B type of considerations like saving rates, as we see, clearly are getting back to the normal rates. Tightening on the loan conditions is also need to be considered. Price correction in the stock market, because right now prices are very high. So I think it's overpriced. So price corrections might be happening soon. Also increasing unemployment, which we observe, but at the same time, I said that given based on this Okun's law, which is very simple connection, actually, this case can be very opposite. So we might observe decreasing unemployment, and then external shocks that coming from the partner countries, maybe from the China, that can create some kind in types of environment in which we need to cut the interest rate even lower than market expect. I think I summarize all this important data for you, dear Governor, and give you all the information that I have right now. Thank you very much.
Right. Thank you very much, Lukasi. Just to get your view, you've given us a very nice, almost symmetric distribution of shocks, of risks there on the upside and downside. So is your bottom line that the market has it pretty much right? That that our policy should be close at least to what market expectations of interest rates are at this stage?
I think so. In general, did you say anything? I lost your connection.
So,
Voice.
is that the market have it right on the interest rates, or should we deviate in either direction, either be tighter or looser than what the market expects?
In my opinion, Governor, so at the end of the day, you make the decision. But in my opinion, because of this sticky price inflation is very important. Because of this inflation that is well above the target level, we at least we might not use smooth lending. So we can keep the interest rate at the level that what we have right now, and we can wait some time, and after this we can use this smooth lending. So if you ask me, I would suggest more of the case A scenario rather than market reference pass. That's my opinion.
Okay, thanks. So that means probably delay the interest rate cuts beyond September, which is what market expects now, and then resume it a bit later.
Exactly, can be the option.
Okay, thanks so much, Lukasi. This was
Thank you very much, and have a good day.
You too.
Thank you. You too. So we are supposed to have Sophia here, I think, according to our schedule, but she's not here. I'm not sure.
She's coming. 1 second.
She's coming. Okay, that's good. Perfect.
Excuse me, Alex. Could you tell me when will I present?
Oh well. So okay. So Lukasi told me that you switched spots. Therefore, you will be at 3 p.m. Is it okay for you?
Yeah, sure.
Okay. Thank you.
Yeah. Okay.
So, Sophia, are you with us?
Yes, it's coming.
No, I mean, I see that.
Yeah. Oh, sorry. Actually, I have a knock at my door. Can you give me
Okay. Yeah.
1 or 2
Sure.
minutes?
Let me know when
Sorry
you're
about
done.
this.
No worries. No
I'm
worries.
trying.
I'll also take a 1-minute break. I'll be back.
Some logistics because I'm leaving. Yeah, sorry about this.
Okay, are we ready to start?
I'm
Sophia,
ready.
are
I'm
you
all set. Yes.
are
Sorry
you
about the delay.
you have problems with the microphone? Okay, I mean, if you can, I don't know, switch. Yeah, sure. Wait 1 minute.
Yeah, you're muted, Tina.
Can you hear me?
Yes. Shall we start?
Okay.
Yes,
I will
yes.
share my
Yeah,
screen.
perfect. Fantastic. Thank you very much. And so welcome to other Sophia, but first let me introduce our mock governor, Yanis Halikas. Yanis, who is a senior advisor to the Better Policy Project. He has a experience of 30 years at the International Monetary Fund, and
Okay.
as well,
Yeah.
he obtained his PhD at Yale University under James
Okay,
Dobbin.
okay.
So welcome,
Okay, can you
Governor. And do
see
you
the
have?
screen?
Yes, we can see the screen. And so welcome, Governor. And do you have any opening remarks?
Yes, hi, Sofia. Uh, as you know, we're about to make an important interest rate decision. We have seen the inflation coming down, which is welcome news, certainly. The market itself has revised its expectations down. Now they expect us to start loosening as early as September and keep loosening interest rates in the following months as well. And on this path, the market expects a soft landing to our 2% target, which would be a very welcome development, of course, if the market is right. On the other hand, we see some pockets of real demand growth or possibly real more favorable supply developments in the economy that keep GDP growth probably above potential, although potential is always uncertain. That could delay the inflation adjustment at least, or create even upward pressure on inflation in the near future. So, given this uncertainty, we welcome very much your input and your assessment on where the economy is now. How should we respond, and how should we communicate our policy response to the markets in a credible way? So.
Okay.
Fantastic. Thank you. Thank you very much, Governor. So now we have our speaker, Sapio. Let me quickly introduce you. So Sapio is an intern at National Bank of Georgia and also a student at the Global Forecasting School and participant at our summer bootcamp and diligent training and research center. So welcome, and we are looking forward to your presentation.
Thank you. This is my presentation about the EFAS framework and the US economy. To briefly tell you what is EFAS Mark II, it's a framework that coexists challenges related to current monetary policy. It introduces forward-looking monetary policy risk management and a new way of communication to the market, which reduce these risks and increase the governments helps the monetary policy and central banks to maintain its credibility and correctly communicate to the market. It broadens the monetary policy scope beyond the inflation control and includes understanding the impact of interest rates and exchange rate. And also the main feature is the projection of different policy paths. And there are three main questions under FPAS Mark II. Where is the economy now? What do we think are driving forces of economy and current dynamics? And what do policy instruments need to do to achieve the basic policy objective? And we have the three main ingredients, 3 Rs, which is that the information should be related and the decisions should be related to the current data, should be realistic and relevant for policy. And this means that we should have this path which has even a small likelihood to be realized in reality. And there are several scenarios under FPAS Mark II. The case A scenarios, which obtains the higher policy path than the market reference, due to that the realized inflation is higher than the equilibrium. The lower policy path, where the inflation is lower than the equilibrium rate of inflation, and case XY scenarios, which contains avoiding dark corners and some inflation traps and other problems. So there are also case A, B, or BA type scenario when the central banks are sure that case A will realize, and they tighten the monetary policy, but somehow the case B will realize and they have the worsened situation. And case A, B scenario is the same scenario, but when the situation is much worse and there are some dark corners and great risk for the economy. So to sum up, we can see that in market reference scenario and case A scenario, the monetary policy rate is higher, and in case B, monetary policy rate is lower, but in the long run, they converge to each other. So let's go to the current economic condition in USA and what might be the driving force for inflation and in which direction. So first, to start with the GDP now. This is the previous forecast, and on the right-hand side, we can see the new forecast. And we can see that during last projection for Q3, the forecast is increased from 2.6 to 2.8. And from the analysis to the contributions of GDP of USA, we can see that the main driving force is consumption, among others, and its share to contribution to GDP growth is increasing over time. So you can see projections for Q1, Q2, and Q3. And in Q3, it was 1.99, almost 2 percentage point out of 2.8 percentage point. So
but that's a Q3 forecast. That's your forecast, right?
No, it's from GDP Now forecast. This.
It's for Q2 or for Q3?
What? It's 1.99 percentage point contribution of consumption increase.
Right. So it's a forecast for Q3 then?
Yes, for Q3.
Yeah.
So let's analyze what might be the driving force behind this increasing in consumption and personal consumption expenses. The first one might be this labor dynamics. As we can see, there is tight labor market in USA with low low unemployment, which then is translated to higher prices because businesses often pass this increasing costs from tight monetary markets to consumption prices, and also as wages are increased, they have higher disposable income, and this then causes consumption and demand for consumption to increase, and therefore this pressures there's upward pressures on prices. Also, we can look at asset prices. This is S&P asset prices, which are increasing during last year, and also total financial assets of US citizens and households, which is increasing during the last period as well. As a result, we can say that this increasing demand for goods cause the GDP gap to increase, and as a result, prices are increasing, and there's upward pressure on inflation. Besides this, we can look at the government debt projections over the next 5 years, and there is this upward trend, and from money creation and endogenous money creation, we can say that this increasing expenditures and increasing government debt, which is one of the driving force of GDP increase, might cause this increase in prices, as there will be higher demand from citizens and consumers. And we can, from this graph, it's evident and it's visible that as real disposable income increased in USA during last year, the personal consumption expenditures has also increased. And as a result, there is positive GDP gap in economy.
But we've turned into this saving, right? So.
Sorry, can you repeat?
So, I mean, consumption is increasing faster than disposable income in the latest.
Yes, consumption is increasing at higher rates than disposable income. And
well, these are levels, right? You have levels there.
Yes.
So you have negative saving there. Is that what the chart shows?
Yes, the disposable income is less than personal expenditures, and this might indicate this negative saving and borrowing.
Okay.
And this graph shows what I have said before, that there is increasing demand and the GDP gap is positive. And as the economy is above this equilibrium and potential level, there will be upward pressures on prices. Also, during the last years, and as there is some political elections and risk related to some specific factors, the country-specific risk has increased during last years, and this might increase this term premium in the economy, and as a result, it will have upward pressure on prices and increase in inflation. Also, these two graphs show that housing prices have increased, and the inflation expectation from 10 years expected inflation is above the target. And sticky price inflation tells the same story. And there are some underlying inflation measures. For example, there's median CPI and 16% trimmed mean CPI. And from this table, we can see that during June and it was above the 2% target, and this difference was significant as it was more than 0.5 percentage point. So now let's go to the another part, what might be driving force of decreasing inflation in US. The first one will be the banks tightening standards. And as banks are tightening standards for commercial and industrial loans and some consumers, as well as for companies, small, medium, and large companies and enterprise, there will be less loans taken out from these consumers, and as a result there will be less manipulation in economy, less demand, and as a result it will have downward pressure on prices. And you can see from this graph that the growth rate of loans have decreased, and for commercial and industrial loans it's even negative. The second driving force for inflation will be the transportation costs, which are decreasing over the last year. And there is also a decrease in commodity prices in overall as well as in wheat and corn prices. And same pattern, but with less magnitude, can be observed to oil prices as well. Previously, I mentioned that there is increase in consumption, personal consumption. But if we look at this growth rate, we can observe that this rate of growth of personal consumption expenditure has decreased over the year. It's still increasing, but at a lower rate. So it might be indicator of this cooling effect that based on this, we can say that over next periods, the inflation will become less and will decrease. Now let's go through this market reference scenario. This is FOMC economic projections for next several years, and we can see that they expect that this real change in real GDP will be less than previous years. They also expect unemployment rate to increase compared to previous current level, and expect the personal consumption, expenditure inflation, and core inflation to decrease over time. Now on this graph, we can compare this participants' projection for change in real GDP, unemployment rate over September. We can observe the September projection and December projection, and we can see that the latest projection is better than the previous one. So they expect that economic condition will get improved. We will have lower inflation and higher unemployment rate. And this is these expectations and projections. And from this graph, we can see that July projection of SOFR path is lower. So they expect that monetary policy rate will be decreased in September. And actually from this lower graph, left-hand side, we can see that almost 8%, there's expectations that interest rate will be cut by 0.5 percentage point, and this probability is about 85%. And this is participant assessment of appropriate monetary policy, and we can see this median projection is decreasing over the next 2 year and in long run. So to sum up my presentation, the drivers of case A scenarios are tight labor dynamics, increasing disposable income and consumption, increasing country-specific risk, and inflation expectations, which are above the target. And all of this is increased income and consumption, increased demand, and there is a positive GDP gap in the economy. However, on the other side, there are some drivers of case B scenarios, which are banks tightening standards, decreasing commodity and transportation costs, decreasing rate of increase in personal consumption, and also the wage increase rate is decreasing, so there are some cooling effects. And finally, the fact that market expectations and FOMC projections are in favor of this decreasing inflation, and they agree to case B scenarios. Thank you for your attention. This was my presentation.
Thank you very much, Sophia. This was quite interesting. You gave us a nice balance of shocks there, of risks there, to underline how complicated the outlook is. how do you think? How would you weigh these risks? I mean, the market expectations at this point are somewhere in between your two scenarios. Is the market perception of where we're going approximately right? And therefore the interest rate path is something that we should consider following, or do you see the risks weighted differently, and so that it should push us towards either of the two scenarios, either be tightening relative to market expectations or some loosening relative to market expectation? How do you?
In the short
Yeah.
run, over this next, for example, 1 or 2 years, I don't think there will be drastic decrease in inflation, and I think it will be somewhere above this target. So in general, I agree with this FOMC participants' these projections that monetary policy rate will decrease, but I don't think there will be so big change in monetary policy like 0.5 or more. Yeah. There will be
So you
some
think we should be
increase in inflation.
So we think we should be more cautious relative to what the market is projecting?
Yeah. I think market is a bit more optimistic from my
So
criteria.
what are the main considerations? I mean, you've listed all sorts of risk factors in one direction or the other.
Yes.
What type of indicators would you place particular attention in guiding your assessment that the risks are possibly weighed a bit more towards the high inflation scenario?
The first one is, I think, the sticky price inflation, which is way above the target. For example, this 12 months inflation is about 4%, 4.3% or something. Yeah.
And can you elaborate a bit on the importance of focusing on the sticky price inflation?
As a sticky price inflation, where some shock is happening to the economy, the flexible price respond very quickly, but sticky price remain more or less stable. But when there is a change in sticky price and when sticky price inflation is above this target, it might be indicator of this inflation risk in the economy. And yes, and we can see the 3 months inflation, sticky price inflation is fluctuating, while this 12 months has this downward trend. But yeah, it's still above the target, and there might be
still above. I would focus more on this 3-month annualized, which shows lower. And I think if you were to extend it by 1 month to June, you would see a bigger decline in this. So, but still above the target. You're right.
Yes, and also, as I have read, this median CPI is a good indicator. I have read it in some papers of, and it shows some good directions for monetary policy path. And as it is above this target, and also the trimmed mean is above the target, it allows me to think that there should be some caution monetary policy and do not expand in very short run.
Right. Of course, operationally, as of course you know, one needs to also take into account lags in the transmission of monetary policy, right? If we take a decision today to keep interest rates high, for example, to lower them, the impact on inflation is going to manifest itself maybe 4 quarters from now. So we need to be looking at the outlook in the future in judging our present stance, right? Is that correct in your view?
Yes, it is.
Yeah. Okay. And how do you, given that we have at least a small deviation now from the market expectations in relation to your recommended stance. How should we communicate this to the markets, do you think? Unfortunately, unlike FPAS1, we don't have a baseline to guide expectations on the basis of that. So what should we be doing instead? How should we communicate? Should we emphasize risks? Should we emphasize least regrets implications?
Yes, we should emphasize on possible risks, which might increase the inflation. So market will have this better knowledge if there will be realization if bottoms and risks. So drastic increase in a decrease in unemployment or tightens the labor market, they will have better understanding what policy paths will be in economy.
Okay, thanks. No, this was quite interesting and informative. Thank you so much, Sophia.
Thank you very much. Goodbye.
Thank you so much, Sophia. We are supposed to have Tinatin now. Mariam, do you know, is she coming?
Yes, Alex, she's coming.
Yes.
Okay, that's good. That's good.
Give me a moment. Hello.
Hi. Yanis, you can let me know when you are ready, and then we'll start.
I'm ready whenever Tina is ready.
Fantastic. So Tina, are you ready?
I just need to find my presentation.
Yes, sure.
One moment.
You can start, Alex, with your usual
Yeah, we can
introduction.
start with the introduction. Welcome once again. As
You should
every half
tape
an
it
hour.
so that you don't have to repeat it.
I'm not sure. Doug told me to repeat, therefore I believe it's certainly worth mentioning the fact that we have our governor with us, our mock governor, Yanis Halikas, who will help us today with the presentations, with his immense knowledge and experience as he spent 30 years at the International Monetary Fund, is now a senior advisor to the Better Policy Project. So, Governor, do you have any comments right now?
Yes, thanks. Thanks, Alex, and thanks, Tina, for being here. We are trying to determine our next policy move. Market expectations, as you know, have shifted quite a bit over the last month. Now, markets expect, based on favorable inflation developments recently, they expect us to start loosening pretty early, as early as September, and keep a steady loosening pace after that. And on this basis, they're expecting a soft landing of the economy towards our inflation target within maybe a 2-year horizon, which would be a very welcome development if it materializes. I would be very interested, however, on your assessment of alternative factors that should enter into our calculation and might lead us to deviate a bit from what the market is expecting. We are particularly puzzled about persistent signs of strength in the economy. The GDP seems to be growing above potential still and above what we were expecting a few months ago. Could this be demand driven mainly in your view? Could it reflect some bubbly developments in asset markets that may be boosting demand? Or could there be more fundamental supply side developments that account for this and that we need to take into account? Of course, these would have almost the opposite policy implications. So it would be very interesting to hear your analysis of these things. And if you could have your assessment of what we should be doing in terms of interest rates and how best to communicate it in a credible way to the markets under our FPAS Mark II framework.
Thank you very much, Governor, for these remarks. So let me quickly introduce our presenter, Tina, who is an intern at the National Bank of Georgia and participants at the summer school at the Diligent Training and Research Center, as well as the GFS student. So Tina, welcome.
Hello. First of all, thank you for having me and thank you for your remarks, Governor. Now I'll briefly say that like the structure of my presentation will be that I'll be following the FPAS Mark II reasoning, where I'll be considering different scenarios for development of in the United States economy. I'll be looking at scenarios where we have a case A, which is where strong demand persists, the labor market is tight, when there is a huge consumption because of an increase in household wealth, but also be observing a case B scenario, which comes from tightening on the credit market or like seeing saving rates that are increasing just right, and also looking at labor market, which is actually not tightening but loosening. I won't go deep into it. I'll go through all scenarios, but the structure of my presentation will be that I'll be looking at different markets and seeing different scenarios within the market. So I won't structure my presentation based on scenarios. So case A would imply higher policy rate and B lower. So we all know that. The way that I'll be looking at the markets will be that I'll be putting more emphasis on the risks that come from having more dovish outlook like we have now, whereas in reality the fundamentals might be skewing us towards a more hawkish outlook. So I'll be more precautious about a case BA scenario because it is more costly if we fall behind a curve by having an expansionary monetary policy when an economy needs a contractionary monetary policy. So I'll be more leaning towards being more safe in terms of like not losing central bank's credibility by hiking inflation and needing more higher interest rates in the future. So having a BAX even maybe. So the three main questions that FPAS Mark looks at starts with looking at where the economy is now, which is very logical. And so to quickly sum up where the US economy is now, I'll say that it is true that the economy is growing higher than we expected. So it is at 2.8 now, which is much higher than the 2-point estimate that would be sustainable without having inflationary pressures. We also see that PC inflation is declining, which is very promising, and it seems to be like a soft landing scenario, which would be a very positive thing. But and all these happened surpassing expectations. So the GDP is growing higher than Atlanta Fed expected it to be, and inflation is declining more than it was expected as well. However, there are also unemployment is lower than the CBO Naira estimate, which is also something to take into account. However, there are lots of uncertainties in the market. There are lots of potential bubbles in the markets, and there may be overly positive outlook as well in some cases. But also there is also elections, and there is political uncertainty. There is also speculation by Republicans stating that the Fed might be reducing the rates and having an expansionary policy just to support the economy during Biden's reign. So there is also that leverage on like the narrative of what the Fed does. So this must also be taken into account when we look at the current state in the US economy. The first thing that I'll look at will be the estimating the market reference rate, because as far as I'm concerned, the way I look at FPAS Mark II is that we'll see what the market expects, and then we give advice on like, is it higher than what the market expects, or should it be lower, the Fed policy rate. The first thing to look at is that the expectations about future interest rates, which is shown by SOFR. And these short-term rates are good indicative about what the market thinks. So we see that in the short term, the market expects that the Fed will lower the rates, but when we look at it in the long run, we see that it is still higher than Fed's 2.8 because it's between 3 and 3.5. So the neutral rate is probably, even as long as markets are concerned, is probably higher than whatever the Fed is stating in the report, FOMC. FOMC's assessments also point to a declining in the Fed rate. So the market reference rate could be that that it will go down in the future, but not so very much. Also, when assessing market reference rate, I decided to look at what the financial markets are feeling. So looking at financial stress index, we see that it's declining, but there is a little bit of uptick in the end. When looking at market reference rate by observing NYSE Composite Index and S&P 500, we see that they are quite positive, which could mean that they are expecting the Fed to decline the rates and they're not scared of rising interest rates in the future. And they might also be looking at the output, which is very strong, and they might also be expecting a soft landing. When looking at equity market volatility tracker, it is also going down. The equity markets are also quite positive, but there are several markers which are ticking upwards, such as macroeconomic news outlook and inflation outlook. They're going up. Also, healthcare matters, financial crisis. People are equity markets are feeling a little bit stressed in these aspects. But overall, the VIX index, which is basically a fear index, is showing promising outlook on the financial market side. However, when we look at consumer sentiment, but this is not the best proxy for what the consumers are saying, we'll see it more in the markets. We see that they're a little bit scared, probably because of inflationary expectations, or probably because of what they expect will be happening in fiscally or politically. So this is the market outlook, which is more on the dovish side, I would say. So now I'll be looking at the second question through market, and the second question is about what are the underlying forces. So the first market that I'll be looking at is the first thing that I'll be looking at is the demand side pressures, and when looking at Atlanta Fed GDP now, we see that it is indicating much higher demand side pressures than would be sustainable. So it is at 2.8 currently, which is significantly higher than what we would say would be like a steady state for US's economy. It could be because of the bubbles. It could be because of consumer spending. But the one thing that like Pat Higgins, I hope I'm saying his name correctly, from Atlanta Fed said in his presentation about GDP now, he said that the best indicator for real GDP growth is real final sales to private domestic purchases. And he said that if it does not go below zero, it is probably expansionary state. So we're probably in a boom. We are expanding, and we see that the real final sales to private domestic purchases are not going below zero, unlike real GDP growth, which is much more volatile. So this indicator is also pointing to GDP expanding in the future. And when we look at what might be the reason behind it, we can look at the contributors to it. And in the third quarter, and also usually the biggest contributor is the PCE. So personal expenditures, but also a huge contributor was government spending. Here also exports were quite big, but exports are volatile, so I would go deep into it. So exports and imports can stray us away from the true path of where the fundamentals are going. But when we look at PCE, when we look at government spending, also residential spending, we see that like there are huge pressures coming from personal spending on GDP, and this consumption might be driving it upwards a lot. Also here we see that the consumer spending is mainly made up of service spending, service expenditures, which is like what usually happens in developed economies and especially in US. So I'll be looking closely into service expenditures. So on this graph, I graphed all the important variables that are driving GDP, including imports and exports, and we see that all of them are increasing. Here, I expanded these four because because of the scale issues, and we see that all of them are increasing. All of them are increasing, or you could say almost on trend. Real private inventories, real imports, exports, government consumption and expenditure. So these trends, one could assume that because they're increasing, GDP will continue to increase. But when we look at their growth rates, we see that they're not increasing at a very high growth rate. So their annualized quarter-on-quarter growth rates, we see that you could say that they're even stabilizing. They're not upshooting as much, but they are on an increasing trend. But you won't say that we're not in this state, for example. So it's more normal. It's more normalizing. So you could say that maybe the demand side pressures are not that harsh. When we look at like real consumption and GDP, we see that again, they're moving together. But when we look at it again, well, I wouldn't say that I wouldn't expect that they would upshoot dramatically. So there are demand side pressures, but I would say that maybe they can moderate in the future. So these are their growth rates, quarter on quarter annualized. But the equation that Doug Luxton created with the NBG was that consumption equation, which holds through all the COVID. If you take out COVID crisis, it still holds. Is that it depends on last period's wealth, this period's disposable income, and measure of permanent disposable income, and this can be evaluated the wealth by household assets, which is increasing dramatically because of financial assets increased by 36 trillion, non-financial assets increased by 18 trillion. And so there's a huge increase in household wealth. And we see that real disposable income is also increasing. But you wouldn't say that real disposable income is increasing higher than spending. So one could say that personal expenditure, so consumption is still irrationally high, and even this wouldn't support it. And when we look at financial markets in the future,
you said that real consumption expenditure, sorry, I missed you there, is or is not increasing faster than income?
it is increasing, but I wouldn't say that it's increasing faster than that. I think it's moderating much more than consumption expenditures, if you can, like, it goes like that. And consumption is increasing, I think, at a higher rate. And I think this
Than
is
income, yeah, okay, yeah.
I think it's an overconsumption trend, and I'll talk about it more. I think
So that means essentially that they view part of the wealth accumulation, right, as fundamentally driven, that they don't expect major corrections there.
Yeah, I would agree with that. I think consumption is driven fundamentally, but I also expect that this wealth will be moderated in the future, because I think the financial markets are overly positive, and I don't think, so when we look at the asset prices, they are increasing quite heavily, but I think that once they internalize that the economy is not actually in that like blooming phase and it's just expectations, maybe asset prices will moderate. But it could be coming from AI, it could be coming from higher productivity, but it's questionable, especially when we have supply chain shocks, which are, I think, kind of impending given the Red Sea crisis and all of it in China and Russia. So I think it's susceptible to decline in the future. I don't think the wealth will persist. We also have an output gap, which means that we are the output is higher than potential output. So it also could be pointing at, I expect more. I'm not that hawkish, so I think there is a potential for moderation. Also, when we look at saving outlook, we see that debt to GDP was very high in this period, and it has moderated. But given the non-Ricardian outlook, which usually is more reliable, one could say that that the saving was not high enough to counter the government debt, which was very high in the pandemic, and also post the pandemic they have maintained it very high, and this points to a higher neutral rate than counted in by than what the markets think. So this is more a case A scenario. Like all these scenarios are also case A, but what I'm saying is that that I do not expect that this to be coming from fundamental things. I expect it to be coming from more booms, like despite like more I think it's more to the boom side than to the fundamental side. I don't think it's just AI and productivity.
So there's a big bubble component,
I
right?
think there's a big
in
bubble.
your view, right?
Yes,
Yeah. I mean that's the crux of the question, isn't it? If I go back to your very early slide, that now that the market, if we try to reconcile what's going on, how to compare the Fed's perception so far with the market perception, the markets expect a higher neutral rate, substantially higher, almost, if I remember correctly, about
yes,
3/4% higher. That's a big difference than what the Fed is projecting, and also they are advocating a faster convergence of interest rate to their higher level. Now, why would that be the case? But correct me if I'm wrong. But doesn't that mean that markets are expecting a much more favorable supply side? They're expecting higher potential output growth by a substantial margin relative to the Fed, in order to expect such a higher neutral rate. Is that your reading of what the discrepancy? Because if that's the difference, that's what we should be focusing on, right? Who is right? But how would you explain this difference in neutral rates?
So the market expects the neutral rate to be higher. I think I agree with you. I think it comes from the supply side. I think they're positive about the market, but I think Fed is overly positive about I think also Fed is taking into account what the market is thinking. And I think Fed might be more exuberant about how the things might play out, because they think that the net neutral rate is lower, like 2.8, whereas markets are saying it's from 3 to 3.5. But I think that the fundamentals are more on the market side than on the Fed side, because I think there is a bubble, and I think the market also thinks that.
No, I'm sure that everybody recognizes that such a huge increase in asset prices probably has some bubble-related component. The question is how much is the fundamental component?
Yes, I would say that
I know this is an impossible question to answer, but very casually observing that GDP growth remains strong as inflation is coming down may point to some favorable supply side developments that we may be underestimating, no?
Yes, so soft landing usually points to a better state of the economy, given like productivity is better, supply side is better. So this would be the fundamental side explaining the hike in GDP. But yes, I agree that there's also a bubble side. There's also a fundamental side. So there's definitely a fundamental side.
Sorry for this distraction. Please keep going with
it was interesting.
your very interesting presentation.
Thank you. It was a great question. I don't think I gave a good answer, but
I mean, there is no good answer to this, I think, for now. We just need to be monitoring developments very closely.
Thank you.
Productivity developments, maybe, very close.
Yeah, it's very hard to assess. Well, well, when we look at the global supply chain pressure index, we see that it declined, then it went up. So it's quite volatile, but it's not very high. But one would say that it can go high given all the wars around the world, given volatility in China's housing market. So we cannot say much, but I'd say that we're kind of safe on that aspect. So but we cannot say a lot. But we're definitely not that. So we're not in that bad place. We're in like in moderately bad place. But another thing that we should look at is the credit side pressures, and we see that bank lending tightened index is like hiking up in the end, and we see that loans are increasing. But when we look at their growth rates, we see that they are growing, but not at an increasing rate. So you could say that in pairing the bank lending tightening index going up with loans increasing at a low rate, now you could say that the credit market is more pointing towards case B scenario where the demand side pressures will be lower. Sorry. Did I stop the screen share? Can you still see my screen?
Yes, we can see the screen.
Okay.
Yeah, it faded a bit, but now it's fine.
Can you still see it?
Yeah, but
Yeah,
we
we can.
keep seeing the same slide, right?
Okay, yes, we're on the same side. So the cautiousness on the credit market would point to a case B scenario. And when we look at the delinquency rates, which are increasing, it's not very high increase, but they're increasing, and it could also point to borrowers struggling to keep up with their debt payments in an environment with high interest rates. So again, this is also a case B scenario. I won't talk about this one because it's an old thing. I don't think it still holds. I don't think we still have a dollar shortage, if I'm right. So we had a dollar shortage in September.
You used to, yeah, but not anymore.
Yeah, it doesn't hold. Another thing that we should look at is inflationary trends. Oh, I also forgot to mention that in the States, there are also non-financial funding. It's not just bank lending that boosts the economy. So an important variable that one would take into account would be what's happening on the corporate markets, or what's happening in non-financial markets. I haven't done it yet, unfortunately. I didn't have enough time, but it would be an interesting thing to look at. You mentioned it once.
Yeah, but the presumption would be that I think at least since COVID, certainly the stock market has recovered, and also the corporate bond markets and commercial paper markets have recovered. So you would expect, at least on the firm side, there may be additional sources of financing, and they may be substituting out of loans towards those. So I agree, it would be important to look at those sources of funding as well.
Yes, so it would be like decreasing the importance of case B when we just look at this. So because there are other ways of funding. Another thing that we should look at is inflationary trends. We see that sticky prices are quite significantly higher than the target of 2%. But when we look at flexible prices, we see that they are below the target, which could mean that they are reflecting the current demand and supply side interactions. And they point to that in the current state, the inflation is quite pointing to the case B scenario where inflationary trends are not that high, but sticky prices are the prices that show us the real expectations on the market side. So when we look at the real expectations that the markets have, they are significantly higher than the 2 percentage point. What is that? So that's not important. So when we look at commodity prices and transportation prices, they're also declining. So this also points to a case B scenario. Another market that's absolutely important is the labor market. And when we look at Ocken's law, labor market reacts quite late to the GDP growth, and GDP has been growing quite fast, but in the later periods, it has been growing even faster. So right now we see that the unemployment has risen to 4.1, but it's not really that scary because given the high increases in GDP in the past few periods, we could expect that unemployment will go down in the future. The only aspect that this high unemployment might have right now that could be substantial is the market expectations, given that this 4.1 is has not been in unemployment hasn't been as high since 2021. Market might be thinking that, oh, maybe the labor market is not doing well, and maybe there is a case B scenario, but I wouldn't say that because the job openings rate is also rather high, and I think the unemployment will go down in a few periods. Also, we see that average hourly earnings by employees is also high, but when we look at the wage growth tracker, it is quite, even though it's declining, it is still higher than what it should be. What's sustainable, it's 4%. So I would say that labor market is pointing to a case A as well.
Are you sure that it's higher than what's sustainable? Because these are nominal rates, right?
I thought it was 4%, the wage growth tracker. No, I could be wrong.
But in nominal terms, nominal wages are rising 4%. So if you control for inflation and productivity, I'm not sure if they're excessive or inflationary wage increases, but that's
I didn't know
that's in the eye of the beholder.
Okay, so this, then whatever you said in combination with it declining, it would point to a case B. Then I'm changing my narrative there. And also, I forgot to mention, the unemployment rate of 4.1 is still lower than the NAIRU's estimate of, I think it was 4.5 or almost 5% unemployment. So maybe it's a case B scenario as well. So what my final recommendation, it would be that US economy is very complex. There are many things that one must take into account. But again, given that markets are expecting the rate to be at 3 to 3.5, and given that a lot of the positive things in GDP might be happening because of the booms, and also because of the scariness of having a BAX scenario, maybe we should not lower the rates very quickly. And so yeah, I'm also kind of hawkish, despite there being a lot of case B scenarios. I think it's scary to lower the rates very soon.
Do you see major risks if we do follow your advice, but in fact the economy is on a more disinflationary path?
I don't see, because I think given the also there is a fiscal thing happening. I think there is a huge. I think given the government debt is so high, and given that savings are not increasing that much, I think the natural rate is very high, and I think the government debt will not decline. And given all the risks from the supply side, all the wars around, and with Trump coming, and who knows what happens, I think case A is okay. I don't think it's very risky.
Okay. Thank you so much, Tina. This was super interesting.
Thank you very much. It was interesting to me as well. Goodbye.
Thank you.
Bye.
Thank you. Goodbye.
Bye.
So now I guess we can move to another highlight of the day, which means half an hour for lunch. And we'll return at 1:30 for Amalia's presentation. So see you in 30 minutes. Hello, Amalia, are you here?
Hi, yes, I'm here.
Fantastic. Well, then let's wait for Yanis and then we can start.
Okay.
Hi, Alex, are you ready?
Yes, I'm ready. Shall we start?
Of course. If
Fantastic.
Amalia is fine.
Hello.
Yes. Hi,
Hi.
nice to see you, Amalia. So now we'll listen to your presentation, but before that, let me introduce our governor, Yanis Halikas, our mock governor, who is a senior advisor to the Better Policy Project, as well as he is an experienced economist. He spent 30 years at the International Monetary Fund. So, dear governor, do you have any opening remarks?
Well, hi, Alex, hi, Amalia. Um, as you know, we are trying to decide what the appropriate monetary policy course should be from in both in the near term and over the near and over the coming months. Um, Inflation, as you know, has been coming down. In fact, inflation performance has been a bit better than what we were projecting a few months ago. The markets have factored this progress in. Now they are expecting us to start a new loosening cycle starting already in September, and then to continue pretty steadily reducing interest rates. And on this basis, they're expecting a soft landing for the economy, where output is going to converge to potential. The inflation is going to stabilize around our 2% target within maybe a 2-year horizon. So this would be a very benign type of scenario, certainly if it materializes. On the other hand, we see some areas that could raise some concern. The real economy seems to remain strong. Our latest nowcast for GDP puts growth still above potential, or what we think is potential, and where this could, of course, have some inflationary impact that could at least delay convergence to our target. It could also reflect some bubbles developing in various asset markets that are a separate cause of concern, of course. On the other hand, on the positive side, they could very well, the strength in GDP could very well reflect favorable supply and productivity developments that we may not have fully factored in. So given this uncertainty, I'm looking very forward to hear your analysis, your assessment of where we are, what we should be doing with our interest rates, and how to convey any decision we make there to the markets in a credible way so that we can stabilize and guide expectations. I'm eager to hear your views on these things.
Fantastic. Thank you very much, Governor. And let me pass the floor to Amalia, our GFS student. So, Amalia, we're looking forward to hearing your presentation.
Thank you, Governor. Thank you, Alex. And let me start. I'd like to start by briefly introducing the FPAS Mark II framework and then discuss the US economy using this new framework. As you may know, since 2024, the Central Bank of Armenia has launched the new forecasting and policy analysis system, FPAS Mark II. This framework builds on the existing FPAS Mark I framework by focusing more on uncertainty and transparency in monetary policy making. It offers a more structured approach, treating monetary policy as a risk management exercise, which lays a stronger foundation for implementing policies with the least regrets. To highlight its main differences and achievements, let's compare it to the FPAS Mark I framework by introducing its drawbacks, which include baseline scenario trap, limitations of linear model dependency, and short-term interest rates announcements. Now let's focus on what the baseline scenario trap is. For most inflation-targeting central banks, the baseline scenario, as we know, has been the main way to communicate their policy and analysis. This means the central bank gives a single main idea of how the economy is doing now and how it might do in the future. They act like an expert forecaster, predicting the most probable future with high confidence. The new framework changes this approach. Instead of relying solely on their own projections, the central bank now uses market expectations for the policy rate as a starting point. These market expectations actually provide valuable insights into how the market views current economic conditions and potential future monetary policy actions. Additionally, the new framework offers a structured assessment of the various risks and shocks that can impact the economy, explaining their effects on inflation and the broader economic environment. It also shows the central bank's potential responses to these risks in relation to market expectations. And the structure that is applied is the following. Case A type of considerations, which require the policy rate to be higher than the market expects. And it's divided into two parts: expansionary demand, when shocks result in aggregate demand rising more than aggregate supply, which increases underlying inflation. This, of course, requires a sufficiently increase in policy rate path to anchor inflation expectations. And case B, contractionary supply, when we have stagflationary shocks require an upward adjustment in the expected path of the policy rate, resulting in a significant short-run trade-off between inflation and other objectives, such as unemployment. And case B type of considerations, again divided into two parts. Shocks result in aggregate demand rising less than aggregate supply, which decreases underlying inflation. This requires sufficiently decrease of policy rate path to anchor inflation expectation. And expansionary supply, so these are the favorable supply shock, reduce inflation toward target, resulting in higher growth and lower interest rates, which the policymakers often call a policymaker's dream. And although there is
It doesn't
much
happen
more,
very often, unfortunately.
yes, unfortunately. Although there is much more we could explore, let's now shift our focus to the US economy. I will analyze the US economy, as I have already said, using the FPAS Mark II framework, and address three important questions, essentially. Where is the economy now? What are the underlying forces? What do policy instruments need to do to achieve basic policy achievements? And the first indicator that I want to introduce is gross domestic product. As of July 17, economic growth in the second quarter of 2024 is estimated at 2.7%. The main contributors, as we can see here in this bar chart, are increased consumption, inventory investment, and a decrease in both exports and imports. Even though consumption growth has been relatively subdued with the help of contractionary policies implemented by the Federal Reserve, it, as we can see, remains strong at around 1.5%. This suggests that high demand pressures from consumption remain elevated. On the other hand, we had observed other trends in economic condition indicators, and let me introduce them as well. The first one is decrease in both imports and exports. This decline suggests lower domestic demand pressures. However, both imports and exports are quite volatile figures, and their changes may not indicate long-term conditions of the economy. The second one, increase in inventory investment. This positive change in inventory investment can be interpreted in two ways. One interpretation is that businesses may be producing more than they are selling, which could signal a decline in demand. Another interpretation is that the increase in inventory could indicate that businesses are expecting demand growth. To meet this anticipated demand, businesses, of course, need to ensure they have sufficient inventory to avoid shortages. And the third one is decrease in the growth rate of investment in residential sector. Although its contribution to GDP is relatively small, this trend may suggest a slowdown housing market. Such a slowdown could indicate reducing consumer confidence or affordability issues, reflecting decrease in economic activity. In summary, the decrease in both imports and exports, increase in change in inventory investment, as well as decrease of investment in residential property points to reduced domestic demand pressures, while the still strong consumption growth and again increase in change in inventory investment could still signal about hot demand market and anticipation of future demand growth by businesses. And further, I separated risks into case A and case B type of risks, and let me talk about them. So case A, domestic demand could rise due to expansionary policies enacted by the government. This increase in domestic demand could in turn contribute to further inflationary pressures. Next, the supply side shock, which like the potential future sanctions and conflicts in Middle East could lead to increased production costs for businesses. Such cost increases might further reduce competitiveness in domestic and foreign markets, which in turn will negatively affect business growth. Combined with higher demand conditions, this could further create inflationary pressures on the economy. But the Fed should be attentive in assessing the current economic conditions, ensuring that policy is not too tight for an extended period to avoid disrupting the production process. This is more case B type of risk, and other case B type of risks are the following. Actually is very very risky that GDP growth is concentrated on consumption rather than investment in equipment or other indicators. This introduces uncertainties and risks regarding the sustainability of future economic activity. and the substantial increase in public wealth, particularly due to rising asset and equity prices, could indicate the existence of bubbles. If market participants recognize the overvaluation of these assets, they may correct the prices, leading to a decrease in public wealth and consequently reduction in demand. Further tightening policies combined with asset price reevaluation and reduction could substantially reduce business investment in structures and housing market activity. This reduction would be driven both by higher lending interest rates applied by banks and decrease in collateral values, which would significantly impact lending conditions. This all for GDP, and now let's move to labor market. The unemployment rate, as we see in this graph, has remained stable at around of 4% Nauru, following the sharp increase in 2020 due to the pandemic. This stability highlights the recovery of labor market, which we know supported by the healing of supply chain. And of course, additionally, the increase in labor supply driven by robust immigration. This has also a huge contribution to the stability in the unemployment rate. Here, I also have some risks, case A and case B type of risks. Case B type of risks are the potential increase in labor market could continue due to this immigration inflow, and this would ease labor market conditions, gradually reducing inflationary pressures related to the labor market in the medium or long term. However, we could consider here case A type of risk as well, in the sense that the future inflow of migrant workers in the US labor market remains uncertain. Political pressures could slow this inflow. And also here we have aging population, which presents additional challenges to increasing labor supply. Such forces could strengthen inflationary pressures originating from the labor market. And also I want to discuss case B and case A type of risks in consideration of tax cuts. So case B type of risks is concerning the tax cuts as part of fiscal policies, which might boost labor supply by making the working environment more attractive. A higher labor supply, of course, could help mitigate wage-driven inflation. But on the other hand, we have also case A type of risk as an increase of public wealth due to tax cuts could further fuel demand, exacerbating inflationary pressures. So the overall impact on inflation will depend on how these dynamics interplay. If managed effectively, these policies have the potential to promote sustainable economic growth while controlling for inflation. And the next figure that I want to talk is wage growth. Wage growth has remained elevated due to downward wage rigidity. As we know, wage has downward wage rigidity. This rigidity makes it challenging to reduce wages when they have been increased. The risks associated with wage growth are the following. So, despite observing elevated wage growth during the pandemic, as we can see, real wage growth was negative due to higher inflationary pressures. However, starting from 2022, and especially in the last quarter of 2024, inflation has decreased much faster than wages. This shift indicates that now we could face additional demand-side pressure due to increased wealth of the households resulting from rising real wages. Although we can also hope that this declining trend could continue, and we can have less inflationary pressures from the labor market and less inflationary pressures as well. The other one is inflation and inflation expectations. In the third quarter of 2024, inflation is moving towards the 2% target, with the core CPI registering at 2.6% year-over-year in May 2024. This progress is largely attributed to reduced pressures from both the demand side and supply side factors. So this time, the cause of the inflation was both from demand and from supply side. In despite of the previous many shocks happening in the US economy, on the demand side, the significant increase in public wealth driven by higher equity and property prices, as well as the drawdown of precautionary savings, has been largely countered by recent monetary policy measures. On the supply side, the reversal of previous oil price increase and the recovery of supply chains have also contributed to the moderation of inflationary pressures. So these are the underlying forces which help to decrease the inflation up to 2 and 6% till today. Looking ahead, although there are risks in both directions, most of which we have already discussed and will consider in our case scenario. Meanwhile, I want us also look at sticky price inflation, which remains above the long-run target of 2%, currently at 4 and 2%. This elevated rate may be influenced by long-term inflation expectations, because dealing with sticky price goods, businesses anticipate that inflation will persist at around 4% or decline only gradually. This reflects public perception that inflation will remain high for certain products, even as overall headline inflation approaches the target. Moreover, although the trend in Q3 indicates a reduction in sticky price inflation, inflation expectations overall remain broadly elevated. This suggests that prices may not decrease rapidly despite the improvement in the headline inflation. And market
Couldn't you interpret this also differently, in the sense that you're looking at year-on-year rates, right? So could they be influenced also by essentially a base 12 months ago, say, where they might have been setting prices at different levels of expectations. So it may be a bit backward-looking indicator of what the actual inflation pressures are. Maybe, I mean, another way to look at this would be to compute more forward-looking measures, like a month-on-month, for example, annualized. Take the last month of the core sticky price inflation and annualize it forward and see where current prices are. I mean, that's a complementary. Can you explain why we emphasize core sticky CPI? Why is it a useful indicator?
As we might know, there are
because there is a conflict there, right? The Fed's target is the core overall CPI, the core CPI, and this has been much lower, as you showed us before.
Yes.
So why should we pay attention to the core sticky CPI?
This core sticky CPI is somewhat telling us about the market expectations, because there are some assets from the difference between sticky CPI and just CPI is that in sticky CPIs are included the goods that are that the prices of which we can change in
less frequently.
Less frequently, yes, less frequently. And in that case, if the business owner has that opportunity to change that price, it changes accordingly the inflation expectations. So he thinks that in the future, the inflation, like within 2 years, or how often he could change that prices would be this much. And that's why he changes that prices accordingly, not based on these days inflation, but based on inflation expectations in the future. So because he would not have that opportunity to change its product prices in near future. That's why it's like kind of indicator of the market expectations
The market
about
expectations,
future.
yeah, they don't, since they change it infrequently, they do not want to get locked
Yes.
into the wrong price.
Yes.
Yeah. Okay. Very good. Keep going, Emily, please.
The next one is market expectations. And as you have already told, the expected 3-month average secured overnight financing rate indicates that market participants with 75% probability expect that Federal Reserve would reduce its refinancing rate to approximately 4% to the third quarter of 2026. This anticipated decline is expected to commence sharply from the expected upcoming quarter. And here I want also talk about the natural interest rate and say that uncertainty remains regarding equilibrium rates, rising questions about the distance of policy rate from the level at which it is neither contractionary nor expansionary. And the COVID-19 crisis actually disrupted many of the assumptions from the Great Moderation era, renewing discussions about higher natural rate. This ongoing assessment may lead to a revision of the view on the natural rate, and I suggest you to discuss the revision and to understand if the natural rate in reality is much higher than we have calculated. And here, the sum up of all above mentioned considerations, but I will illustrate this sum up with case A and case B type of scenarios.
Yeah. Just in the interest of time, I think we can exclude a number of these scenarios, right? We certainly don't have contractionary demand, right? Because output is strong. Probably we don't have contractionary supply, because this would have meant prices going up, inflation going up, and GDP stagnating. So maybe the two more natural candidates would be expansionary demand or expansionary supply, as I see it, right?
Yes, but yes, the only risk in contractionary demand, so we are talking about the case B type of considerations, yes? The only risk is that the market can just realize that the housing market is overvalued and the bubble subsequently
Fair
will
enough.
burst.
Yeah. Fair enough. That's right.
And this will have subsequent many
It will
effects
reduce
on
demand, yeah.
Yes, it will reduce demand. It will reduce the capacity of lending by the businesses and households, and also the financial sector collapse in some way because of decreasing collateral values. But of course, these risks are less realistic than the case A type of risks, when we have this elevated demand conditions as a result of expansionary policies implemented by the government, and labor market, we could have additional supply side pressures on wages because of conditions. Labor market will go below the Nairu if we have this high demand. Additionally, potential tax cuts could further fuel demand, and sticky prices, if they stay elevated, Federal Reserve task will be even more hard to achieve this price stability, its price stability mandate, and also the potential sanctions in the Middle and conflicts in the Middle East can lead to increased prices. And of course, this will disrupt the
that will be a
production
contractionary
process.
supply shock. Yeah.
Yes. This will disturb the production process and make the domestic firms less competitive, both in foreign market and in domestic market as well. And also we can have this condition of natural rate. If we decrease our interest rate sooner, it is the risk that actually we are not tight enough to anchor this inflation, and the inflation.
No, that's understood. In the interest of time, maybe you could cut short and give us your assessment. What are the
My assessment for this,
which one of those risks, in case A or case B, should we be paying more attention to?
And taking into consideration that we are discussing this framework under least regrets approach, I think it would be more prudent at this stage to address case A type of risks and avoid decreasing the policy rate soon. Because given the current high policy rate, the risk of becoming stuck at the lower bound is low. And if we consider case B type of considerations, and it turns out that actually case A type of scenario is currently happening in the market, and the inflationary environment is not yet anchored, much higher policy rate would be required, potentially causing further damage to production. So I think.
So you would, yeah, okay. No, that's a reasonable. We have to think about all these things, but that's a very reasonable. Thank you very much. Unfortunately, we don't have a lot
Yes,
of time.
we are out of time. Thank you as
Yeah,
well.
but thanks very much. This was very detailed and very interesting.
Thank you as well.
Thank you very much, Amalia.
Thank you.
So I guess we have Hovhannes with us.
Yeah, hi.
Hi. So, Yanis, do you need a
Just
minute?
1 second.
Absolutely. Let me
Alex,
know when
please.
you're ready, and we'll introduce our next presentation.
Something's wrong with my camera, I think. Let me.
Yeah, of course.
Yeah, I'm good.
Doesn't change
Thanks.
anything. I mean,
I think
I
it's
have
the
a
same,
bit
but like
technical problem
don't worry too
here.
much about
Yeah, the camera is not working properly. Apologies for that.
Don't worry. I mean, unless you can quickly fix it, but that's okay. You can.
No, I don't think I can.
Well, then let's just continue like that. So, welcome everyone once again to the next of our presentations. Right now we'll have the presentation of Hovhannes, but before that, let me introduce our mock governor, Yanis Halikas. Yanis, who has a experience of 30 years working at the IMF, and now he's a senior advisor at the Better Policy Project. So, welcome, Governor, and do you have any opening remarks?
Hello, good to see you. We're about to make some important interest rate decisions in the midst of uncertainty as usual. Inflation has been coming down, which is a welcome phenomenon. Markets have responded to this. Now they're expecting a much more benign inflation path, and they are factoring in a loosening early on, already in September, and then a steady loosening of interest rates after that. On the other hand, there are some signs that give us a bit of a pause. The real economy continues to perform much more strongly, or somewhat more strongly than we anticipated, on the basis of our estimates. Output is still running above capacity, and growth rate exceeds potential. And this could mean two things: either that we have demand pressures on the economy that could delay or even in a worst case scenario reverse the progress in inflation so far, or we may be actually wrong on our potential and the supply side of the economy has been developing as productivity or other supply side factors have been more favorable, in which case this would be a very nice scenario for us to navigate. So in the midst of this uncertainty, I would welcome very much your assessment, your assessment of risks, either way around, where the balance of risks is, your recommendation in terms of our interest rate policy, and best way to communicate it to the markets in a credible fashion under our FPAS Mark II framework.
Thank you. Thank you very much, Governor. So now let me briefly introduce our speaker. So Hovhannes is a student at the Global Forecasting School, as well as the participants in our summer boot camp at the Diligent Training and Research Center. So Hovhannes, welcome, and we are looking forward to listening to your presentation.
Thank you, Alex, for presenting me. Once again, I'm Mr. Governor. I'll be presenting my views on applying a risk management approach to the US economy and giving my recommendations about the policy rate for the next period of time. So let me start by sharing my screen. Also, should I leave the camera on, or maybe should I switch it off because of the quality? I don't know.
I'm indifferent as long as even if
Yeah.
we can see you a little blurry, that matters to me. So.
I mean, it's okay. It can stay like that. We certainly don't mind.
Yeah.
Okay. Okay. Great. So let me share my screen real quick. You should be able to see it now, I think.
Yes, very clearly. Thanks.
Okay. So welcome, and as I mentioned, I would be presenting my views of applying risk management approach to the US economy and giving my recommendations concerning the interest rates. And before we start, let me mention that I would be doing this with the help of the FPAS Mark II framework, which is the brand new and enhanced version of the previously used FPAS Mark I framework, which was practicing inflation targeting. And so the biggest difference between the FPAS Mark II and FPAS Mark I frameworks is that then in this case, in FPAS Mark II framework, we construct the economic narrative based on case scenarios. And here are some of the scenarios that we should probably assess during our current analysis. First of all, we start with market reference scenario, which is basically what the market expects from the macroeconomic variables to go. And based on this market reference scenario, we construct either hawkish or dovish case scenarios. For example, on one hand, we have case A, which are the scenarios that assume economic conditions that would require higher policy rate path than what market expects. And on the other hand, we have case B scenarios, which assume economic conditions that would lead to applying a lower interest rate path than what market expects. And also, it is also useful to mention that there are also case X, Y type scenarios, which are basically tail risk scenarios, as well as the scenarios that incorporate avoiding the dark corners of the monetary policy, which are the high and variable inflation or a low inflation trap. And this is mainly why we call this framework the framework of least regrets, or avoiding the dark corners. And so moving on, I would like to discuss the way I thought about constructing my case scenarios. Here are the essential ingredients of the FPAS Mark II scenarios. First of all, we have to answer a basic question of where is the economy now? This is kind of a start point of our analysis. then we should assess what are the driving forces that drive the economy towards a specific direction. And then basically the outcome of our analysis would be deciding on the policy actions that need to be done to achieve policy objectives. And basically, this is the flow of my presentation. I'll be going on and answering these questions and then present my case scenarios and also the recommendation. So regarding the current state of the economy, we see that the economy continues to grow and it's mainly driven by services consumption. Here you can see the Atlanta Fed GDP now, real GDP estimate for the second quarter of 2024. And also I would like to be more simple in this case and observe the real gross domestic product and the real potential gross domestic product. We will see that here we have a huge gap, positive gap between the real GDP and real potential GDP, which may also hint that we're going to have a recession sometime in future. So I wouldn't be sure that the hawkish scenario is what we have to go for in this case, but I'll expand on this later. And so moving on, these are the risks or the drivers of the economy that I considered in my current analysis. I've divided them into two main groups. Case A type considerations, which are the inflation expectations are yet to be anchored, and I'll try to explain this more in detail. And then increase in household wealth, both in financial and non-financial assets, which maintains the consumption level high. And also the case B type considerations are that the recent stabilization in labor market indicates cooling of the economy, and also the tightening of the loan conditions, especially for consumer and business loans, break the persistency of the strong demand pressures. So this is the first consideration, which is a case A type consideration. We see the core sticky CPI index, which is actually far from its target. It is around 4% mark now. And having in mind that we have a 2% target, we can state that currently inflation expectations aren't properly anchored. So we may have to maintain high policy rate in order to anchor the expectations properly. However, we'll see in the later examples that other measures of inflation are pretty much anchored. And so here we can see the household net worth, which has been increasing mainly because of the COVID-19 expansionary measures. We see a $50 trillion increase in household wealth, which is like twice as much as the GDP in the US, meaning that after COVID-19, all those people who saved their income and accumulated all this wealth, they will still continue to consume. And this trend will continue as long as the wealth and the consumption levels are matched. And we also can see that this wealth increase is also in both financial and non-financial assets. Namely, in financial assets, we see that the different indexes, like S&P 500 index, for example, has doubled in over 4-year time. And also we have a smaller proportion of the wealth increase that falls into non-financial assets. And these are mainly the housing prices and construction in general. Moving on to more of case B type considerations, I've plotted the unemployment rate. Here we can see a steady hike in 2020, which is obviously the result of the COVID pandemic. We see a double-digit, close to 15% unemployment rate, which then starts to decline. And starting from 2022, we can see that it is stabilizing around the 4.1, 4.2% mark, which I think may indicate cooling of the economy. And this is mainly one of the arguments supporting the dovish scenario that I was inclined to when I started my presentation. So
So
moving on,
do you think that, do you estimate that the unemployment, how does it compare to the natural rate? Isn't that the criterion
I
one should
haven't
use?
plotted the measure. However, it is actually close to Nairu, which in turn may be not very good estimate for the state of our economy. But I'm paying more attention on the fact that the unemployment rate starts to stabilize in a certain point. So if it continues so, it may also approach the desired number as well. Then I've also included the bank lending conditions that continue to tighten. I've also, I'm sorry, I didn't put the dates in the x-axis, but it's like from 2018 to 2024 for the left-hand side, and 1990, if I'm not mistaken, to 2024 on the right-hand side. We see tightening in lending conditions, which means that it is more difficult for people to borrow from banks, especially consumer and business loans are not very easy to get. So this would lead to a decline in consumption and also support the case B type of scenario in this case. Finally, you can see the graphs that I plotted and made my case scenarios here. So you can see that the market expects that in the short run, like in 2 months' time, maybe, the interest rates would remain the same on the 5.33% mark, and then gradually decrease to a point when it reaches to 3.5% mark. And also in case A, we see that we maintain high interest rates because we don't believe that the steady decline in inflation will be continuous. And on the other hand, we have the case B scenario, which assumes a steadier decline in the interest rates because of the two mentioned reasons above. And also, I plotted the core PCE and for year over year and 3 month over 3 month. We see that we have inflation close to the 2% mark, which I mentioned earlier. But we can have in mind that because of the other measures of inflation are not yet anchored, we may also consider the case A type of scenarios. But in my opinion, in this case B scenarios just outweigh the case A type of scenarios in terms of the risk, just because of the huge gap between the real GDP and the real potential GDP. However, my suggestion for the policy rate would be to maintain it on 5.33% mark and watch out for the case B scenario type of risks to act immediately if we encounter them. And that's basically it. Thank you very much for your attention.
Thank you. No, this was quite comprehensive. I mean, would you go all the way up to case A or towards case A? I mean, would you, because your case A scenario
Oh, the graphs. You mean these graphs?
Yeah. I'm trying to understand your
Okay, yeah,
graphs here.
exactly.
So your case A scenario involves some, even if all these upside risk to inflation materialize, you would still have a decline in interest rates, right? Uh, just not, just a bit delayed, for example, relative
I
to the
understand.
market.
Yeah. So basically,
So,
yeah, my
that's
suggestion for
your recommendation.
my last final recommendation, you mean?
I mean, your
Well,
bottom line, yeah. I mean, your best assessment here. You think you should stick close to case A, as I understand it?
Not really, because when I constructed both case A and case B, the interest rate for this period when we are going to make a decision is both 5.33%. So I would suggest maintaining it on 5.33% in any case. But watch out for more of case B type of risks than case A type of risk, because in my opinion, when we go for the case B type of scenarios, we may have less losses when we learn that the case A was more appropriate, then we do it vice versa.
Yeah, but as I understand, the logic of the scenarios, right, is that you derive the best uh, interest rate path. That's your blue line, assuming that case A scenario materializes, right?
Okay.
So that would still involve some cuts in interest rates
Later,
over
yeah,
time, right?
exactly, yeah.
So you maintain them. You mean you maintain the level for longer than the market expects, say until the end
Exactly.
of the year.
Yeah, exactly.
Yeah. Okay. Just to clarify. And now, of course, it would be nice to know if case A or case B materializes, but of course we don't. So you mentioned the least regrets approach uh, uh, to make monetary policy making more robust, essentially, to this uncertainty. So what if we believe it's case A, but suppose case B actually materializes, and we design policy on the basis of your case A, and we are wrong, essentially. What would be the main costs to the economy if we were to do that?
Well, in my opinion, as I plotted these case A and case B scenarios, not very distinct for each other. I think that if we go for a case A and then we find out that case B was more appropriate, I mean, we can eventually just
We can switch, yes,
our
once we,
approach.
but suppose we don't realize it in time, and for a, I mean, as a risk management type of exercise, suppose that we don't get enough good indicators to make a switch, or central banks sometimes have certain inertia in their actions. They don't deviate. They don't like to deviate quickly. So for whatever reason, suppose we make a mistake, and for a prolonged period, we think we're in case A and conduct policy according to what case A implies, but it so happens that the economy is actually in case B, just by way of illustration. I mean, I just wanted to understand what costs, what types of impacts, macroeconomic impacts this would have if we were to do
Well, the
that.
first thing that comes to my mind is that well, the central bank that goes for the scenario will immediately lose some amount of credibility that it gained previously, which means that it would be more difficult to control the macroeconomic variables in the near future. However, if we communicate everything properly, because in fact we suggest both scenarios to the public and to other participants of the economy, I don't think that the outcome of this case would be very frightening, because of the fact that everyone knew that there was a possibility of a case B type of a scenario. However, we went for a case A type of scenario.
The impact on inflation and employment.
Certainly, there will be.
You mentioned dark corners at the outset, right? Is the balance of risk such that we could essentially get to a very low inflation trap with unanchored expectations and with possibly a big correction, a big decline in asset prices that could have second round effects that could exacerbate because the case B is a kind of a low growth, low inflation scenario, really, right? Could we be making it so much worse by making a policy mistake that we could have unanchored expectations and potential financial crash?
Yeah, there
or is that an exaggerated type of fear? I mean, what's your best sense?
I think what you mentioned is fair. So these type of costs are for sure going to occur. However, they are maybe a bit more exaggerating than it needs to be, in my opinion. Yeah, but they can be for sure. There will be costs because we go for different.
View. Yeah, that's fine. Great. Okay. No, thanks. This was quite interesting. Thank you for this.
Yeah, thank you so much.
Thank you very much, Johannes.
Thank you, Alex.
Can you give me a couple of minutes?
Yeah, of course, we have time. Yes. As I suppose. Yeah, sure.
Yeah.
So, Ivan, are you next?
Yes, we agreed with
great.
yes.
Very good. Let's just wait for Yanis to also take like 2 minute break and we'll start.
Okay, apologies. I had to make this phone call. Alex, are you there? Alex? Sorry. Let me knock on his door. He's right across here.
Can you see my screen clearly?
I can see it very well. Thanks, Ivan.
Okay, thank you.
Alex, are you there? He doesn't respond. Email himself.
Sorry for this.
Okay.
2 minutes.
I was about to email you.
Yeah,
Okay, we're all
okay.
set. We're all set.
Great. Let's go. So, hello everyone, once again. And before starting our next presentation made by Ivan, let me introduce our governor. So, our MOOC governor today and yesterday, it was the same as well, is Ioannis Halikas. Ioannis, who is a senior advisor at Better Policy Project. And he also had extensive experience from 30 years working in the International Monetary Fund. He also obtained his PhD degree at Yale University under James Tobin. So welcome, our governor, and do you have
Hello, Ivan. Good to see you. In anticipation of our interest rate decisions, I would like your assessment of where you see the risks at this point. The market, as you know, has adopted a rather, has revised its expectations of inflation down, has adopted now a much more benign scenario of early easing of policies and smooth land and soft landing to the inflation target. But we'd be interested to hear if you share this assessment or if you see any risks that should make us more cautious or even more active compared to the market's baseline at this point. There are signs of I would say some demand pressures on the economy. On the other hand, we may be underestimating supply side improvements, productivity improvements that we don't factor in our. So it could be wrong on either direction. It's one of those common situations facing policymakers. We'd like your assessment of where we are, what in your view would be an appropriate policy response, and what's a good way to communicate it to the markets in a credible fashion.
Thank you very much for sharing this remarks with us. So Today we have Ivan, who is a student currently in Czech Republic, however, also a student at the Global Forecasting School and a participant of our summer school in the Diligent Training and Research Center remotely, but still. So welcome, Ivan. We are looking forward to listening to your presentation.
Okay, thank you very much. Thank you very much, Governor. I will be presenting the my not-detail book analysis with application of FPAS Mark II monetary policy framework with case A and case B scenarios. And at the end, I will suggest policy recommendations and how to appropriately communicate these policies. In the presentation, in the presentation, I will briefly remind the fundamental concept of FPAS Mark II. Then I will provide statistics outlining several aspects of the current state of the US economy and current trends. From this, I will suggest possible forecast for several indicators and draw a baseline scenario for the economy. Lastly, I will present the analysis of the several types of demand shocks considering case A and case B scenarios and show them in the graphs. And as I said, I will provide policy recommendations. So, as you know, the world is an uncertain place and policymakers should account for this. And FPAS Mark II was specifically developed for this, focusing on risk management and policy of so-called least regrets. And I will demonstrate this in this presentation. So, as you know, FPAS Mark II has three ingredients when developing a scenario. Where the economy is now, what are the driving forces, and what are the instruments necessary to achieve basic policy objective. And I will go through all of this in the presentation. And all of these ingredients should have several key features. Namely, they should be related to the current data, they should be realistic, and they should be relevant to the policy. Now, quick reminder about those scenarios. There is case A, which is a scenario where the policy rate is above the market expectations. And then there is case B when the policy rate is below market expectations. In addition to that, case X and case Y scenarios that could be used to account for other extremely undesirable economic conditions. However, in this presentation, I only include case A and case B. And after the initial analysis, it is possible to apply the least regrets policy, which is essentially about minimizing the cost of making a certain decision, like considering the costs and probabilities of case A policy being chosen, while in reality, case B is what happened, and the other way around. This is all considered under this framework. Now, moving to the analysis of the current state of the economy and driving forces. This slide shows the historical data and forecast of policy rate, or in other words, interest rate set by the central bank. And also the forecast is estimated by the Federal Reserve of Atlanta. From the graph on the left, the response to COVID-19 crisis by the central bank can be seen while combating inflation. And currently the interest rate is pretty high. And all the measures that were taken to combat inflation were successful, and the inflation is currently going steeply down, which I will show in the following slides. While the forecast on the right, which may be interpreted as market expectations of the interest rate trend, has a downward trend. And interestingly, the estimation is lower than it was a month before. So yeah, as I said, this is the likely trend that the financial markets are expecting from the interest rates set by the central bank. Okay, now in this slide, the sticky and flexible consumer price index inflation is shown. And as I said, the success of the previously mentioned interest rate policy of the central bank can be seen on significant decline of inflation of flexible consumer price index from 2022 to 2023. And now it seems to stabilize at a few percent, similar to pre-pandemic levels. However, in addition to that, there is also sticky consumer price index, which is much more interesting because it can be interpreted as long-term expectation of inflation and thus the interest rates set by the central bank. It has a slow downward trend, but it is still higher than pre-pandemic levels and higher than the target inflation level. This indicates that possibly there are different long-term expectations regarding inflation from financial markets, and this should be addressed with appropriate communication. Now about labor market. This slide shows labor market statistics like unemployment and available job openings. And the impact of the pandemic on both graphs can easily be seen, and well, it kind of tells a story. So due to the pandemic, many people lost their jobs, and there were not many jobs available. But after the crisis has largely ended and businesses started to open, there was a significant boom in labor market and high demand for labor. So the unemployment level rapidly stabilized to pre-pandemic levels. And as you can see, the graph on the left, which is job openings, has a decrease at the beginning of the crisis and steady growth, but after the crisis, it started to slowly decline. And the graph on the right, which is unemployment rate, has a giant spike around 2021, but after that, it started to gradually decline to pre-pandemic levels. It's pretty uncertain where unemployment will go now, but probably it will remain stable at pre-pandemic levels, which is somewhere around the Naira level. Also, given that job availability is still pretty high, it will likely remain stable for long term at this point. However, it should also be noted that it might slightly increase because of because a little bit, because the inflation is currently declining and because of the Phillips curve relationship. And actually, this dynamic can be seen a little bit in 2024. I will, yeah.
But
I will discuss.
if can I ask you a quick question just for my understanding?
Sure.
If job openings remain, if vacancies remain high relative to historical averages, right? And unemployment stabilizes, wouldn't that create some upward pressure on wages and prices? Wouldn't firms be more actively competing to fill those vacancies by offering higher wages?
Yes, definitely. It would increase the demand in the labor market and so drive up the prices and wages. Unfortunately, I actually did not include the wage graph here, but certainly.
Okay. Yeah.
And
No,
we may continue regarding asset prices too. I think there might be somehow related. I'm not sure. But yeah, and I will discuss this further because this is also interesting.
Let me not interrupt you. Yeah, please
Yeah.
keep going.
Yes, I will discuss it when considering case A, I think, or case B. Yeah, I will.
Okay.
I'll discuss it in
Looking
further slides.
forward.
Okay. Now about credit availability. Or in other words, tightness, or how difficult is it to get loans. According to this graph, at the beginning of COVID crisis, there was an increase in difficulty to get credit. Then it significantly dropped, and then it increased during the time when there was high inflation. I would say that it will probably stabilize at its current
Sorry,
level.
just for my
Sure.
clarification. Is it possible to move? Yeah. No, I can see the gears. Perfect.
Sorry for that. It's a little bit. I think it will stabilize at about a bit higher at its current level, which is a bit higher than pre-pandemic level. There's probably no longer the issue of inflation, the problem of inflation. It's currently, as I said, it's currently going downward. However, this tightness might increase again if some other crisis might happen. So, for example, war on Ukraine or some kind of other volatility that could happen, it is likely to increase again, and it will impact the case in case of case B scenario. Yeah, and as I said, I will describe it when considering the shocks. Now to the next.
It's
Yeah, as I
it's
said,
a bit difficult to interpret this chart relative to historical levels, right? Because this is
yes,
tightening relative to the previous period. So if you have a large forbearance, that you have a large relaxation of lending standards during COVID, and then a tightening of those, I mean, you need probably some stock measure of overall tightness, right, to just accumulate all these changes.
Yes, probably.
Because
You're right.
I think it's a little difficult to see, are they high by historical standards or low? The lending
Yeah, this is
standards of
true.
banks.
Yeah, I think.
Yeah,
Yes, I
I
will
always
research
had
into
trouble
this.
with these charts before. Yeah, no, please go
Okay.
on. But I see your point here. It's well taken.
Okay, and as I said, at the end of the presentation, there will be a very nice table outlining all of this, and I will come back to these charts again.
Okay.
Now about wealth and savings, and here there are two charts: S&P 500 and personal savings rate. So the left graph, as I said, S&P is 500, which could be interpreted as the net wealth of the economy. It seems that after the pandemic, net wealth has significantly increased with huge growth, but there is an upward trend. And yeah, it pretty much doubled in 4 years. It does not seem very good. And there might be some kind of asset price bubble, given that probably there was no proportional increase in the productivity or increase in wealth. Yeah, so this might be potentially concerning. On the right side, the graph shows the private savings rate of people in the US economy. There was a large spike in the savings rate during the COVID crisis. This was because people didn't have as many options to spend their earnings on. So, for example, vacation or international travel. So instead, they put all of it into savings. That's why it created a huge increase in demand after the crisis, after COVID, and so it created a lot of inflation. And it may be argued that this kind of force is still persistent in the economy. Yeah, and yeah, as I said, I will discuss it. I think that's pretty much it for this slide. Now about the baseline scenario. This slide shows the graphs for Fed fund rate, unemployment rate, and inflation indicators. These graphs show historical data for these indicators, and also the light blue line indicates the baseline scenario or market expectations, which I have drawn based on the previous conclusion of current state of the economy and its driving forces that I have described in the previous slides. So, for example, it is likely that inflation will continue its downward trend after the successful interest rate policy. It may reduce faster or slower depending on the scenarios, but it has an overall downward trend. So, given that inflation largely reduced to pre-pandemic levels, it makes sense for the central bank to reduce the interest rate. Also, given that inflation reduced, the unemployment rate will slightly increase and stabilize to pre-pandemic levels too. And now to this nice table.
Here I had a question actually.
Sure.
I mean, we do have market expectations for the Fed funds rate, right?
Yes.
So I'm not sure why you need to construct it yourself, because I thought, I mean, from what I've seen is that market expectations are that you reach a steady state at some point 2 years out or so, and the federal funds rate that's consistent with the 2% inflation something like 3.5%, isn't it?
Yeah, this is just okay. I'm sorry. This is just for general demonstration.
Okay. So it's
something
not
is
actual
above or below.
numbers. Yeah. No, I mean
Yes.
the
This is probably over. This is
the
over
inflation number
exaggerated.
looks correct, but it's strange to have as a steady state policy rate, as a neutral
Yeah,
rate,
this is a bit over exaggerated. Yeah, but
something
this is
that's
like the general.
zero in real terms. It's kind of unusual.
Yes. Oh well.
Yeah, but
Yeah.
I take your points in your illustration.
Okay. Now about case A and case B. So the positive shocks, which is case A, include the strong and persistent demand in the economy and increase in household wealth. So as I said, because of lockdowns, people were not able to spend as much money as they wanted for international travel. So they put it into savings and spent it after the pandemic ended, which created a lot of consumption, which increased demand significantly and caused inflation. So some may argue that this kind of force is still active in the economy. However, well, looking at the personal savings rate, it seems to actually it's percent change, I assume, but it seems to be at about
I
the
think it's
level.
savings over disposable income, right? It's the percent.
Yes, disposable, the amount that the person has earned. So it seems to be at about the pre-pandemic levels, or that even a bit lower than that. So probably the savings were already exhausted. So yeah, I'm not sure about this specific thing regarding case A.
I think that you can measure if you take the average pre-pandemic, you can look at the area under the curve there and of the precautionary savings during the pandemic, right? And see how much of this has been spent already.
I see.
So I mean
Yeah,
that's one way to
possible.
look at it. If it's more, then that means that people are starting to probably consume out of their wealth, out of their increased wealth. So that
Yes.
so in the former case, probably it's a return to a normal equilibrium, and you would expect a savings rate to revert to pre-pandemic levels. Otherwise, you would have a sort of persistent decline in the savings rate relative to the pre-pandemic history. That
Yeah, and
might be
also,
one way to look at it.
yes. Well, and the other indicator that I showed are the S&P 500 index. And as I said, it doubled twice, which is concerning. I don't think this is a very valid indicator to show that the wealth increased. I mean, maybe the nominal wealth increased, but the real wealth, as I said, I'm not totally convinced that the productivity has doubled since before the COVID. Maybe I don't know, artificial intelligence, but I'm not sure if this was
I mean, first of all,
sufficient.
you can't deflate it, right?
Yeah.
Because there has been significant cumulative inflation there.
I mean, yeah, that's
So
true.
when
So
you
it's
calculate well, you could calculate the real component, but even the real component will show a very large increase. I'm pretty sure.
Yeah, so yeah, as I said, potential price bubble. So appropriate regulations would probably also be necessary in the financial sector. Okay, let's move on. Then there is labor market remains tight. So meaning there is high demand for labor force, which could be caused by the persistent trend from post-pandemic economic boom, which happened, as I said, when all the businesses opened after lockdown. And I think that's where the job openings graph is useful. And yes, it's probably pretty tight. There's still pretty high demand for labor, and even high, yeah, but it's already close to pre-pandemic level too, if you compare it. the difference is about 1,000 in these units. So yeah, potentially too. Okay, now about the negative factors, or case B. The first point is if the labor market is cooling, which it does, and as I showed in the graph. So if this kind of trend has ended and everything and the real labor market returns to its stable state with a bit higher unemployment and to pre-pandemic state. The second point is savings rates returning to the normal level. So similarly to the previous point, if the surplus savings that were collected during the pandemic were exhausted, then it will return to the previous level of demand. And as I showed this savings rate, I mean, it probably also significantly did decline, but as you pointed out correctly, it's possible to probably estimate how much is remaining. Yeah. The third point, it's tightening of the loan conditions, which means it becomes more difficult to get credit for investment or consumption, so the demand will decline. And as I showed here, currently it's actually as you also pointed out, it's a bit confusing graph.
No, right, but I see your point there. Yeah, they're certainly tighter. They look tighter to me then because they essentially reverted back eventually to pre-pandemic standards, and they keep tightening. I mean, they're above zero. So yeah, that's what it means.
Okay.
So I take your point there.
Okay, thank you very much. So and that's pretty much it from this, and from all of this.
You don't see an additional case B risk that you have some correction in asset prices, since you think they're overvalued already.
I did not include it, unfortunately.
Yeah,
but
no,
yes,
just
as I
for
pointed
your
out,
consideration. Yeah.
Yes, as I pointed out, there is really this is concerning. The level of asset prices is concerning.
Yeah.
Now about those case A and case B scenarios. So again, I'm sorry for this Fed funds rate graph with case B.
That's
It's
fine.
too
Yeah,
low.
yeah. No, I'll scale it mentally up a bit. Yeah.
Thank you very much. So the red lines here are the scenario A, and when the demand is still high or increases, and the green line indicates the scenario B when demand potentially decreases, and it impacts all of the rest of these variables. And the light blue line is the baseline scenario. So, for example, if there still will be considerable inflation, it's better not to decrease interest rates significantly, while given that there is negative relationship with inflation and unemployment, the inflation will slightly reduce, and also the other way around. So I personally believe that the case A scenario would be more probable, considering the long-term inflation expectations are still fairly high. I think that the best policy would be to keep the policy rate stable for the next term and only then slowly reduce it while looking back at the long-term interest rate expectations. It is also important to communicate the risks and chosen policy clearly to the financial markets that the central bank will keep the long-term inflation at its target instead of possibly risking inflation when following case B scenario.
That's
pretty much it.
I have problem understanding here a bit.
Yes.
Apart from the scaling, which is just a technical matter. Essentially, when I thought that when we were trying to think of scenarios and arrive at a policy rate target or path consistent with that scenario, the point was to devise such a path to get inflation go back to target over a certain horizon. Now, if you look at the core PCE, for example, it never gets back to target over this horizon, even though you have a tighter policy. Shouldn't you calibrate, try to think through how maybe policy needs to be tighter in your construction of the scenario? But I thought that the policy rate there should be an endogenous response to make sure you return to your target eventually.
Yes, that is absolutely correct. Yes, these graphs are horrible. I'm very sorry for this.
Right. No, but that's more conceptual, right? I mean,
Yes,
you
yes,
think
they
through
should.
how much do I need to tighten
Absolutely.
to get to
Absolutely.
my
They
target
should
within
be
2
within the
years, 3
target.
years, whatever they.
So
Yeah.
the central bank will only reduce its interest rate when it is absolutely sure that the target the inflation target is its current the desired level. So yes, absolutely.
Yeah. And also, and another technical point, I mean, the year to year and the 3 month should be pretty close at the end of the period, no?
Yeah, that's also right. I will fix these graphs. I promise. I'm really sorry for those.
Okay. Yeah. Yeah, but I mean, the way, you should probably the inflation rate in your case A and in your case B, I think are a bit exaggerated, right? With this tightening, probably you should be getting close to with this tighter stance, you should be getting closer. But unless you have a really bad case A scenario in mind, which is perfectly fine, yeah. Let's. I keep interrupting with you, but
that's pretty much it.
Yeah, I think we just ran out of time. So,
but I think
thank you so much.
I think you made your point very well.
Yes.
Thank you very much, Governor.
Thank you for this.
I will fix my graphs. Thank you for feedback.
Okay, great.
Fantastic. Thank you very much. Thank you for your presentation. Thank you, Governor, for the comments. And I believe we can move on to another presentation. So I guess, Yanis, once you are ready, let me know. And I guess, Martin, thank you very much, Ivan, once again. And so we can move to Martin. I suppose you are here. Yeah.
Just 1 second.
No problem.
Okay, I'm all set.
Yes. Well, let's start. Hello, everyone. And right now we are going to listen to another presentation by Martin. But before that, let me introduce our mock governor, Yanis Halikas. Yanis, who is a senior advisor at the Better Policy Project and whose experience of working in International Monetary Fund for 30 years is extremely valuable for us. We have a pleasure to welcome Yanis as our governor today. And do you have any opening remarks?
Hello, hi Martin, good to see you. In thinking about, we very much appreciate your input on to help us with our thinking about our near-term policy moves. As you may have seen, the inflation has been surprising us a bit on the downside, on the favorable downside. It has been coming down a bit faster than we thought. The markets are already factoring this in. Now they are assuming that the inflation path justify an early easing as of September, and then a steady continued easing after that. And in their estimation, that should be consistent with a soft landing towards a 2% inflation target within a 2-year horizon or so. This would be a very welcome development, of course, if it materializes. On the other hand, we do see some areas that could merit additional thinking. There is strength in the real economy. GDP is growing still above our current estimate of potential. So this could reflect persistent aggregate demand pressures that could delay or even reverse the progress in inflation. On the other hand, conceivably, we may be underestimating supply side improvements, productivity improvements, which are not easy to capture in real time. And this could, of course, have the opposite policy implication for us. So, in this context, looking forward to your assessment of where the economy is, what should be a desired policy response, and how could we communicate it in a convincing way to market. We're eager to hear your views.
Great, thank you. So let me introduce our presenter briefly. So Martin is currently a student at Northwestern University, but also a GFS student and a participant of our summer school at the Diligent Training Research Center. So welcome, and we are looking forward to listening to your presentation.
Hello, Mr. Governor. Hello, Alex. Thank you so much for the introduction. Thank you for having me here. And if you are ready, I can share my screen and start with my presentation.
Yes.
Everything is good. You can see it.
Very well. Yeah,
okay,
thanks.
That's great. So this is my current analysis of the US economy under FPAS Mark II framework. And what I'm going to talk about is where the economy is now, what are the driving forces, what are the case A, case B scenarios, A, B, B, A scenarios, what are the risks, and then I will give my final recommendation for this, for policy rate. So let's start with understanding the context. As Mr. Governor already mentioned, the economy is pretty strong. The GDP growth is 2.8%, and the projection is that it's going to remain high at 2.8%. And if you look at the subcomponent contributions to GDP now, you can see that most of it is from consumer spending, which was the case since COVID. Because of the lockdown and the fiscal stimulus, there was a lot of spending, but it was mainly in terms of investing in assets, buying houses, which was the primary reason that drove the S&P 500 prices, for example, higher, and the prices of houses higher. But currently it's changing a little bit. Now it's more of a spending on services that is driving this high GDP growth. For my analysis, I have taken secured overnight financing rate as the basis for my market reference scenario. As you can see, the projection is that the market expectation is that the Fed funds rate is going down to 350 basis points. And here is my market reference scenario, which is depicted with the orange color. The Fed funds rate is going down, converging to 3.5%. Unemployment, it's already the third consecutive month that unemployment is increasing. Currently, it's at 4.1%, but the projection is that it's going to increase slightly, 4.2%, and converge there. And this is pretty much like the estimates for Nauru, as Nauru is also at 4.2%. So, there it's the economy is performing pretty well in terms of unemployment, and at the same time, the inflation is also pretty good because it's going to just increase slightly and then converge to 2%, which is the target. For the inflation, I have considered the crude oil prices estimate that is currently stabilizing at around $80 per barrel. And what I've observed is that crude oil prices are usually have behaving similarly as PCE, and probably the explanation is that crude oil prices have both direct and indirect impact on PCE, both in terms of transportation cost and in general, crude oil prices are also in PCE. And so having this stabilization of crude oil prices can be a good indicator that the PCE is also going to go down and converge to our target of 2%.
Here we are concerned essentially about the second round effect, right, on the general because the direct effect is not included in
Yes,
the
exactly.
Fed's target. Yeah, but you think it's important because it could have important second round effects.
Of course, yes. Regarding my case A scenario, we can see the inflation is still higher. If you look at the 3-month over 3-month, it's at around 4%, and year over year is 4.3%, which is 2% around 2% higher than the our target. And this can be a indicator that market expectation about the inflation is still going to be higher than 2%, and this will lead us to the case A type of scenario when the market expectation is developed that the inflation is going to be higher. So we'll have our case A type of scenario when the Fed funds rate will have to be higher and PCE will be higher because the expectation of the inflation is directly in the transmission mechanism. It's directly impacting the actual inflation rate. It's also, we have already talked about this a lot, but it's still relevant talking about households' assets increase. And it started during the COVID, and probably the primary reasons for that was the fiscal stimulus and the changing consumer behavior, because there was excess accumulation of wealth. However, people could not spend it by traveling because of the lockdown restrictions. But what they did instead was investing it in stocks, and as a result, S&P 500 prices went up, almost doubling, and the prices of houses went up significantly. And as a result, we have inflation and probably formation of bubbles. But as of now, we cannot really estimate that. It's usually done when the bubbles burst, and then we can estimate. And this, yes, and this is very important to consider when we talk about AB type of scenario. And I'll talk about this in a bit. Regarding case B scenarios, the tightening of loans, if you look at the graph, the net percentage of domestic banks tightening standards for credit card loans and standards for commercial and industrial loans to small firms, they are all positive, around 20%, which means that most of the banks have tightened their standards for credit. What this means is that there will be less money creation in the economy, which would directly imply that there is less investment in the businesses, reducing, increasing the unemployment rate, reducing the inflation, and reducing the overall slowing down the economy. And what are the costs of A, B, and BA scenarios? First of all, what do we mean by A, B, and BA? These are scenarios when we think that it's going to be case A type of scenario, we pursue it, and then it turns out that we actually shouldn't have increased our Fed funds rate, but decreased, and vice versa for BA scenario. And let's say we increase our interest rates now, it will result in an economic slowdown because of the higher interest rates. There will be less lending, meaning less money creation, which would slow down the economy, reduce the investment and consumption spending, and will increase unemployment, and of course will reduce the inflation. But this is probably an extreme case where we might end up in low inflation trap like Japan. But given the current inflation rate, it's probably not really reasonable to think that we might end up there, because if we do control it, it's probably not that realistic of a scenario that we can consider.
Yeah, but what if you have, in addition to that, as part of your AB, a sharp correction in asset prices, right, and potential financial stability issue? Is that realistic? And if so, could that lead you to a low inflation trap?
Given the current prices of houses and the prices of stocks, then maybe it is possible if we do increase the interest rates too much, for example, then we might end up in a scenario where we will be in low inflation trap. But that's probably very unrealistic given the fact that we are kind of in control of the policy and we can make sure that we do not end up there. If that answers your question.
Yeah, no, it answers it. I mean, I'm sure with the, I mean, after, I mean, monetary policy may be responsible for times for creating bubbles, but once a bubble occurs, it's very little difficult for monetary policy to do much about it. You need other types of policies.
Exactly, yes. And I will talk about it when I consider the PA type of scenario.
Okay.
So for PA type of scenario, we reduce the interest rates, but then it turns out that we actually shouldn't have reduced the interest rates. In this case, there will be increased inflationary pressures because there will be more money creation in the economy, more investment in the businesses, more job opportunities, and overall the economy will grow. And this might result in not formation, but contribution to already existing asset bubbles, because I believe that asset bubbles are already there due to the fiscal stimulus and changing consumer behavior from the COVID time. And this might result in too high inflation rates that will be difficult to deal with later. And at the same time, we have a high debt to GDP ratio, which is 120%. And this is already too high. And by doing the case B type of scenario and then realizing that case A is a case, then we'll end up in a scenario where our debt to GDP ratio will increase while we are trying to lower it. So it might be even more of a problem in the future. And regarding this debt to GDP, fiscal policy is important.
So you accumulate debt even though presumably, or is it, I mean, what's the mechanism exactly that accounts for debt accumulation? Because you are reducing short-term rates, right?
Yes.
So that could, in principle, make debt service for the government easier. But with inflationary pressures and possibly asset bubbles, you would create a longer term premium on government bonds. Is that the mechanism you see? I mean, why does
Yes,
this
pretty
make
much. Which yes, and that would be the reason that government will have to borrow more money in order to finance these lower bond rates, if that makes sense.
Well, I mean, if the term premium does not change, right? In principle, it should have the opposite effect. No, I mean, you make it easy. I mean, cheaper for the government to borrow. So when it's rolling over its debt, it's rolling it over at lower interest rates, lower bond yields. So and on top of that, presumably, BA you have more. It's more expansionary on the economy as a whole. So even on the deficit, that should help if they don't change policy. It's only if because you've made the economy riskier, you've created inflationary expectations in the future, and therefore the term premium, the premium of long term bond yields over the short term interest rates increases.
Yes.
That could be a mechanism. Yeah. Maybe you should to clarify exactly how the debt dynamic, I mean, the channels through which the debt dynamics will be affected.
Yeah, I mean, my thinking was that if we do actually lower the interest rates, then it will actually result in what you said about term premia, like the bonds will become more risky.
Right. No, just to clarify, I mean, it may be
Yes.
useful to explain exactly why it's happening. Because someone may tell you of lower interest rates, that dynamic should improve. But yeah, I mean, your point is well taken. So please forget the diversion. I just want to clarify a bit.
Okay. Can I continue or?
Yeah, please.
I mean, And this is my last part of my presentation, which is the final recommendation. And in my opinion, we shouldn't be changing the interest rates too much, just maybe slightly reducing the interest rates to, let's say, 5%, because of the political uncertainty that is expected to persist until November, and the absence of immediate economic urgencies. And when I say immediate economic urgencies, I mean there is nothing that we have to immediately deal with, because the unemployment is pretty good, inflation is pretty good, GDP is strong, and the only thing is, let's say, debt to GDP ratio, but this is directly related to political uncertainty, because depending on the next administration, there is going to be policy changes in the fiscal policy. So that might significantly impact the debt to GDP ratio. So we do not want to rush to conclusions and change the policy and then figure out that we shouldn't have. So probably just keeping the interest rates where they are now, just slightly decreasing, so that we can match the market reference scenario in order to gain some credibility from the market. At the same time, not increasing, not making the economy grow too much. This would be the most reasonable way to go for me. And why I'm saying we can reduce a little
Although
bit.
in my view, unfortunately, you may get expansionary policies post-election, no matter who wins. I mean, one party wants to lower taxes, the other wants to raise spending. So, as far as monetary policy is concerned, this could be a baseline, not a risk at this point.
For sure, yeah, that makes sense. But one thing that I would like to add is that why we want to lower a little bit is because I don't think the economy is overheating now. So just reducing the interest rates a little bit will not result in an overheating of the economy, so that we'll have to increase the interest rate in order to cool the economy down. And
so you would reduce them to 5% in September, say, right?
Yeah.
Or
yeah,
and then keep them there and then see how, and
yeah,
then
I mean,
recalibrate after the elections.
Yes. I mean, if we do not have, if the economy is doing well, we do not have any urgent issue to deal with, then what is the point of changing something significantly when we can buy some time, reassess the economy after the elections, and then make a right policy?
Okay.
That's my thinking about this.
That's very reasonable. No. Unless you have anything else to add, I mean, this was a very nice presentation. Thanks very much, Martin.
Yeah, I mean, I also did some research on the labor market, but
okay.
Should I talk about it?
I mean, if it's relevant to this, yeah, of course.
It's to some extent relevant, but
it's of course, yeah.
It's always relevant. But the thing is that it seems too uncertain right now, and that is why I was not sure whether it's worth putting in the presentation. But there were some interesting things that I noticed while doing the research on labor market, and
I think it would be always interesting to include it and point. I mean, if you have various indicators that point in opposite ways, and it's hard to reach. It's still interesting for people to understand the risks again.
Okay.
Again, FPAS-Mark2 is a risk-based type of analysis, so it's good to have the risks down there.
For sure, yes. So what
you could put labor market factors in both scenarios. I mean, if you have, if there are conflicting indications coming out from the analysis.
Something interesting that I was able to observe was that in 2024 June, there were 206,000 jobs created, but there were job losses in the industries such as like manufacturing and aerospace. But what's interesting is that the participation rate has increased to 62.6%, and that was maybe the reason that there was observed a slight increase in the unemployment rate.
Yes,
so
I think you have a good point there.
Yeah, it's not really that the economy is bad and that is why unemployment is increasing, but rather unemployment, the labor force participation rate is increasing, and that is why we observe
because
this,
it fell very steeply during COVID. participation fell very steeply during COVID, there were all sorts of transfers that some people may have just stopped looking for jobs because there was nothing to be found. But then even beyond COVID, they kept some transfers that reduced incentives to participate, which were eventually gradually removed. And that's why you have this increase in participation. You're right.
Yes. Yeah, and probably this is it about my presentation. Unless you have some further questions, Mr. Governor, happy to try to
No,
answer.
this was very interesting. Thank you so much, Martin.
Okay, thank you too for listening.
Thank you. Thank you very much, Martin. It was really enjoyable to listen to your presentation.
Thank you too, and have safe travels, Mr. Governor, to Yerevan.
Thank you so much.
Yes.
Oh, yeah, you're here. Okay, great. Fantastic. So should we proceed with our next presentation or?
Let's take a short break if
Yes, we
you don't
can.
mind.
We
Maybe
can.
2 minutes break.
Yes,
not
in
a
2 minutes I'll be back. Hi, Mary. How are you? Is everything good? You ready?
Well,
I'm sure you are. We can wait for Johannes then, and we'll start once he's ready as well.
okay.
Unless you have any questions at this point. That's fine.
Hi. Sorry, needed a little caffeine here too.
No, we are on time actually, 1 minute early. So should I start?
Yeah, let's
Okay, fantastic. So before introducing our next speaker, Mary, let me introduce our governor, Yanis Halikas, who is helping us. He's been helping us today and yesterday, and so we are benefiting from his experience, 30 years spent at the International Monetary Fund, and also he obtained a PhD at Yale University under James Tobin, and now Yanis is with us as a senior advisor to the Better Policy Project. So welcome, Mr. Governor. And do you have any questions at this point? Oh, sorry, questions, remarks, or any other
Yeah,
thing?
just
Or maybe questions, I don't know.
hello, Mary. Yeah, mainly questions at this point. I mean, our big question is what to do with our interest rates. We have some relatively conflicting indicators, which is not unusual, as you know, for monetary policy. We have progress on the inflation front. Certainly, it has been coming down faster than we thought. The markets have factored this in. Now they are expecting an early interest rate cut from our side as early as September, and then a steady easing, further easing after that. And on that basis, they are projecting a soft landing now, unlike their earlier projections. So a soft landing to our 2% target by within a couple of years, roughly. That would be great if it could realize, of course. We do have some questions and concerns that could justify deviating from market expectations at this point. There are some indications. First of all, the real economy has been doing better than we thought. Real GDP is growing above our potential estimates. This could signal persistent aggregate demand pressure that could delay or reverse the progress on inflation. On the other hand, our potential may be wrong. We may be underestimating improvements in the labor market. On the supply side, productivity is very difficult to track in real time, especially longer term trends of productivity. And in that sense, that would, of course, call for a very different policy reaction. So, in the middle of this uncertainty, Mary, we would very much appreciate your assessment, your policy recommendations, and your views as to how best to communicate any deviations from market expectations to the market in a credible way.
Thank you very much, Governor. So let me quickly introduce our next presenter, Mary. Mary, who is a participant at our summer school at the Belgian Training and Research Center, and she's as well a student at the Global Forecasting School. So Mary, welcome, and we are looking forward to listening to your presentation.
Thank you very much. I'm Mary, and as Alex mentioned, I'm a CBA participant, CBA Macroeconomic Summer School. Today, I want to describe current state. Let me share my screen. Do you see my screen?
Yes, very clearly. Thanks, Mary.
And today I want to describe current stance of U.S. economy, emphasizing what scenario I incline and what monetary policy will react under these economic conditions. But before this, I want to briefly talk about FPAS Mark II. Central banks establishes their objectives such as price and financial stability, and to achieve their objectives, they monitor key economic indicators such as inflation rate, unemployment rate, GDP growth, and etc. And through this analysis, they assess where is the economy and what underlying forces are the economy. And based on this analysis, they formulate monetary policy strategies with appropriate instruments to achieve their goals. And in this context, three questions are important. Where is the economy now? What underlying forces are in the economy? And what policy instruments we should use. And under FPAS Mark II, comparing to FPAS Mark I, we don't have a baseline scenario. We have a case A scenario where policy rate higher than market expects, case B scenario where policy rate lower than market expects, and some extreme economic conditions such as case XY scenarios, but when we can have a higher inflationary environment or low inflation trap. So I want to illustrate these cases through the example of US and US economy. Let's start to talk about US economy and referring growth rate of real domestic products, we can see that according to Forecast Atlanta, Fed, its projections of its growth continue to be maintained. And what is the reason of this? This is driven by consumption. The reason of is accumulating saving during pandemic, and after pandemic people started to spend accumulating money which supports consumption and create persistent demand in the economy. We also have assets prices rise, and we have it for both financial assets and for non-financial assets. For financial assets, we have $47 trillion increase, and for non-financial assets, we have $18 trillion increase. And as you see from the graph, net worth increased. And what mean increased net worth? It will create persistent demand and create high economic activity, which create inflationary pressures in the economy, and have a holistic image of price changes. I also consider financial asset price changes in financial market. For example, prices in equity market. I picked three stock market indices such as Standard and Poor's 500, Dow Jones Industrial Average, and Nasdaq Industrial Composite, which shows that equity prices increasing. And referring yield bond markets, we can see that yields of bonds are decreasing, which indicates that we have the prices of bonds experienced increase. And this is a very crucial point because this creates additional inflationary pressures in the economy. And I think in this case, policymakers should be more cautious because in the economy, we can have asset bubbles, and their sharp decline can lead to sustainable losses for both businesses and financial institutions. And
could I introduce another thought here? I mean, if bond yields decline, there isn't much of a decline. First of all, they seem to have stabilized. But if indeed they decline, it's a bit tricky how to read this. It could, as you say, it makes borrowing easier, so it could add to demand. But at the same time, it could signal that the market now has lowered its longer-term inflation expectations. So that could be the opposite signal in a sense, for monetary policy purposes, right?
Yes, I think this question is very controversial because if prices in the economy continue to increase, and participants of markets understand that they have overvalued assets. This can cause that bond yields will start to increase because purchasing power of money will decrease, and investors start to demand more interest rate for bonds, and this can decline the prices of bonds, and this can affect, I think, balance sheets for financial institutions. For example, banks have many government bonds, and they can suffer capital losses, I think.
That's a good point. Yeah, please keep going. I'm sorry for the distraction here.
No worries. I want to continue delve into inflationary pressures in the market, and primary point is sticky price inflation. Why this is important and useful tool? Because it tracks prices that changes infrequently in the market, and resulting long-term expectations of both households and businesses. In the last quarters or months, we see some decline sticky price inflation. I think this is a good sign, but it is not positive signal because overall over the year percent of sticky price inflation is 4.3%, which is significantly high our target. And as for PCE index, you can see from the graph that in the first quarter we have increase in this index, which means that we have high consumption and inflationary pressures. But in the second quarter, you can see that this decreased too. In spite of these decreases in the economy, I think inflationary pressures are ongoing in the economy because these percentages are significantly above our target, which is 2%. And
sorry, just to understand what your PCE index is. This is real personal consumption.
This is personal consumption expenditures.
In real terms, is it annualized percent or year on year or?
No, it's annualized percent. Yes.
Oh, okay. In real terms, right?
Yes. Yes.
Yeah. Okay. It's this high. It's 3%. The latest. Okay.
Okay. And now I want to talk about what's going on labor market. In labor market, there are many uncertainties. This is noticeable from the graph that during pandemic, we have a decline tightness of labor market, and we have increased unemployment level. Although the labor market continue to be tight, if we compare it to pre-pandemic times, and what can it cause for the economy? It can the workers and unions can push their wages, and this can create increased labor cost for businesses, and they can pass these costs into consumers in the form of higher prices. But I want to support a case B type of scenario in this case because I consider wage growth tracker, and as you see from the graph, wage decline in this last month, which shows that we don't have inflationary pressures in labor market. And as you said, although we have decreased unemployment level in after pandemic, but in the second quarter of 2024, we have some increase in unemployment market, which can contribute to wage decreases. And we should have image of financial conditions, and I consider in this case bank lending tightening index. Although the intensity of tightening decreases after pandemic, but lending conditions are still tight. And in the first quarter of 2024, bank started to tighten their conditions, as you see from the graph. And what does this mean for the economy? This can limit access to financing, taking out loans, decreasing taking out loans from the banks for different purposes, for example, business investment and consumer spendings, and this will decrease the amount of loans, which can decrease demand pressures in economy, and we can have deflationary environment in this case. And in this case, we also have case B type of scenario. And
just to strengthen your point on how to read this chart, I think
okay.
You notice that it's declining, but this is percentages of tightening, right? Percentage of banks tightening. So you have to read this cumulatively in a sense. So even though they increase, they're still above zero. So you have about 20% more tightening relative to the previous year. So the tightening continues. That's what the graph says. It's not that it becomes less, right? Because it adds to an already tightened situation. So if you look at the banking system as a whole, now you have more banks, still more banks tightening. So the question is this above zero or below zero? It's in this.
Okay.
Sorry, just to this strengthens your point actually that you could have constraints on the lending side.
Thank you for your consideration. Now I want to summarize case A and case B scenario for the US example. And according to Federal Reserve projections, the expected path of policy rate will cut in the future, and it will be 3.1 at the end of 2026, according their projections. And PCE also will be declining, and in the long term, it will stabilize at the 2% of its target. And what about the unemployment rate? It will be not so volatile, and in the long term, we have 4.1% unemployment level in the end of 2026. And summarizing case A and case B scenarios, if in the market case A scenario persists, we have inflationary environment, strong demand, and prices continue to persist. And labor market will be tight also, and this can push wages, which will increase the cost of labor for businesses, and this can pass to the prices of goods and services, which will create additional inflationary pressures in the economy. And what about case B scenario? We have case B scenario, demand will decrease and prices will be decreased. And if the lower tightening, loan tightening conditions are still in the economy, the amount of loan decrease, and this will create lower economic activity for the economy. And in the final, I want say what scenario I support more and what scenario I believe. I believe case B scenario, but I think that Fed should not rush to cut policy rate. I will approve it in my next slide. Why I support case B scenario, although there are demand side pressures and high consumption level in the economy, but in the second quarter we noticed from the graphs that both PC index and inflation, sticky price inflation rate are declining. Although labor market remains tight comparing to pre-pandemic level, but in the second quarter we also have increasing unemployment level, and as you see from wage tracker, wage continue to decline. And first point is about long tightening index, that the conditions of loans continue to be tight, and this can affect the amount of loan in the economy. Furthermore, the percentage of banks that tighten their conditions in the second quarter in the first quarter in 2024 is increased. And why I think that Fed should not rush to lower policy rates, because I think there are inflationary pressures in the economy, and when we cut policy rate, it can deepen inflationary environment. And although labor market is cooling in the last quarter, but it is uncertain, and it is still tighten, and this can cause that workers can push their wages, and this can create inflationary environment for the economy. And also we have many uncertainties connected to political sector. And summarizing my presentation, I want to say my final decision and how communication mechanism I will use. I will use for monetary policy. My final decision is that I want to maintain rates unchangeable, because I want to see how market indicators are working, are changing in the first quarter, to have a more deep image of the economy. And my communication mechanism is that I will say that interest rates cuts should be delayed, and to avoid some shocks, and to have more approved decision. I think that this can help people to restrain demand in the economy, and it will cool inflationary pressures in the economy. Thank you very much for listening to me. This is the last part of my presentation.
Thank you very much, Mary. Yeah, I mean, you laid out the cases for risks in either direction. Could you explain a bit how you came to, I mean, what considerations informed your choice of erring more on the side of case A? Of course, nobody knows. I mean, you can only guess which of the two scenarios is the more realistic, right? So, an additional consideration we may have is to see what happens if we are wrong, right? Which very often happens. So, what happens if we follow your advice and adjust rates more slowly, closer to the case A. But in fact, it turns out that case B turns out to be the true state of the economy. What the cost would this have? What are the macro implications of that?
Okay. If in the economy economy are case A type of scenario and they implement case B, I think it's
No, I was asking the opposite because you recommend that
opposite.
we implement policies
Okay.
according to case A, right?
Mm-hmm. Okay.
So what happens if we follow your recommendation, but the economy is in fact turns out to be in case B,
Mm-hmm.
a low growth, low inflation type of
Okay, I
scenario?
think okay, I think it will affect our financial activity, and I think it will decrease the activity in economy, and it will persist demand if we cut rate slowly, and we can give incentives to economy to develop more and to make economic activity more high.
Or low, probably, right? Yeah.
Okay.
It will depress the economy more. I mean, case B is a low case scenario. If we apply on top of that higher interest rates, probably we'll be depressing it more.
Yes.
Okay, great. Thank you so much, Mary.
Thank you too much for.
Thank you.
Thank you too. Have a nice day.
You too.
Is it possible, Mary, that you could stop your
Yes.
sharing your screen?
No, there's not.
I mean, no, it's okay. I mean, I don't know, but because Mihran is here, but I'm not
Oh,
sure.
the screen. Sorry.
There's the screen. Absolutely, you can stay here. There's no problem if you wish. The only issue is the screen, so we will have opportunity to put the other presentation on. So that's great. Do we need a break or shall we begin? What do you think?
Not for me. I don't know if Mihran is.
Yes,
ready
Mihran,
or
are you
not?
here? Are you ready? Sorry, I couldn't hear you.
I think we are both ready.
Oh, okay, fantastic. Well, then let's start. If we finish early, that's better for us. Hello everyone. And before listening to Mihran's presentation, let me briefly introduce our mock governor, Yanis Halikas. Yanis has been working at the International Monetary Fund for 30 years and currently is sharing his knowledge and experience as our senior advisor at the Global Forecasting School and the Better Policy Project. Welcome, Mr. Governor. And before starting our Mihra's presentation, do you have, Mr. Governor, do you have any comments?
Yes, hello, Mihran. We essentially, I'm looking forward to your assessment and help in guiding us or advising us to with regard to where monetary policy should be going from now. We have been holding after our tightening cycle. We've been holding rates steady for some time at our policy rates. However, we do have some very encouraging indicators on inflation, which still remains above our target for the third consecutive year, but finally has started to come down. And in fact, the recent trends have been even more favorable than we were projecting a few months ago. The markets have factored this in by now. They are now projecting or expecting us to start an easing cycle as early as September and keep easing steadily throughout. And on this basis, now they expect a soft landing towards a 2% target. That would be a very favorable and very welcome scenario, certainly. But we still have some questions that we'd like your input on. Do you think this is a reasonable path on which to base our policies, or do you see other factors affecting it? We have indications of continued strength of the real economy. Does this reflect mainly aggregate demand strength? Does it reflect supply improvements, productivity improvements that we may have overlooked? And how does this, how do you see these developments? What's your recommendation about our policy decisions, and what's your views about how to best to communicate those to the markets if we decide to deviate from the market, the expected market path? We're all ears here to
Thank you,
listen to your
Mr.
advice.
Governor. So before passing my voice to the speaker, to Mihran, let me introduce Mihran first. So Mihran is a macroeconomist at the Central Bank of Armenia. He joined us recently, and he's also a student at the Global Forecasting School and the participant in our summer school intelligence training and research center. So Mihran, thank you very much, and we are looking forward to listening to your presentation.
Thank you for the opportunity to give me to provide current analysis about the US economy and give my recommendations about the future monetary policy making, and also how to communicate the monetary policy that we are planning to do to the market. Can you see my sharing of the screen?
Yes, very clearly. Thanks, Miran.
Okay, let's start. From the beginning, as I know that you are really aware of the new framework that we have introduced about the FPAS Mark II. So now I want to go straight about how I constructed my market reference scenario and case A and case B scenarios. Starting with the market expectations, I used the recent release of the expected 3-month average SOFR paid by Atlanta Fed, which is on 26th of July. And comparing this result with the beginning of the July, we can observe a significant decrease of the expectations about the future policy rate by the financial market participants, which was 4% by the terminal point. For example, in the beginning of the July, the terminal point until the end of 2026 is 4%. Now it's expected to be 3.5% by the market participants. And these results, the market also expects that by the end of 2026, the inflation will be in its target, 2% target, which seems that financial markets, the financial inflation expectations in financial markets is well anchored. We can also see some improvements in the distribution of future 3-month average SOFR, where, for example, comparing it again with the beginning of July, the distribution about the next policy rate has been is now more narrow, which means they become more precise in their expectations. And also it has been declined slightly, comparing again with the beginning of July. Now, I want to talk about the GDP now estimate, again, released by Atlanta Fed, which what we can observe here is that the GDP growth is higher than its historical trend. And this mostly conditioned on increased service consumption and government spending, which I will go into more details in my next slides and talking about this more. Briefly, I want you to introduce the case A type and case B type considerations that I have created. Basically, what I included in case A type of considerations is mostly inflationary pressures coming again from government spending and increased service consumption. The second component is as we know, the increased household net wealth will continue to have its impact on inflation. Another point is further fiscal expansion by the government, which we hear from both candidates, for example, that they will further expand their expenditures. And the last component of case A type considerations is that labor market will remain tight. About the case B type of considerations is the tightening of the loan conditions. And the amount of loan that provided, we see that it's going down. The second one is the opposite of case A type of considerations, in that we say that labor market remains tight. Here we say that recent labor market data indicates some cooling directions. And there is a hope that stock market will correct itself. That's the last component. Now let's go into case A type of considerations. First, I want to talk about sticky price inflation. Why I'm taking this measure? Because it reflects very well the inflation expectations of households and businesses. We already talked about the financial markets expectations, which it seems that are well anchored, but we cannot say the same for the households and businesses, because when looking at the results of sticky price inflation, for example, in the April of this year, we can observe that year-on-year sticky price inflation is 4.2%, and 3 months over 3 months sticky price inflation is 3.2%. It shows some declining trend, but still it is over than 2% target, which means the expectations of the market are still higher than our inflation target. But I also developed my argument why it is very important to look at this result, because, for example, when looking at the CPI basket, 70% of the products consists of goods and services with sticky prices, and the remaining part consists of flexible prices, goods and services. And furthermore, when, for example, companies whose goods or services are sticky, when they are planning to change their prices, they know their inflation expectations about the future is already incorporated in these price changes, because they know that they will not have an opportunity to negotiate these prices for a long period of time. That's why it's a very good measure of inflation expectations of households and businesses. Now let's go to the next slide, which is about households' balance sheet. To understand what's happening in the United States, it is very important to look at the household balance sheet, because after the COVID-19 pandemic, we can observe a very significant increase in household net worth, particularly $53 trillion increase in their total assets, which consists of two parts. About 2/3 of the increase is generated by stock values changes, and 1/3 is comes from housing prices change, and we can observe that for example, S&P 500 still grows, and all the other asset prices on the rise again, and it makes some fear of pro-inflationary fears. Why? Because if their net worth has been increased so significantly, they will most likely continue spending until the nominal increase in their income will match with the increase in assets. That's how the ratio of households' net worth as a percent of their disposable personal income normalizes to its long-term average. This is very important component of KSA type of scenarios. Now, the next, again, very important thing to think about is
how can Milan, sorry to interrupt. How can we interpret this increase in wealth? Do we have indications of underlying fundamental structural improvements in the economy? Do we have indications of public behaviors in some of these asset markets?
You mean what are the components of this increase of the net worth of assets?
Yeah, I mean, it's a very big increase, obviously.
Yes, it can come from different things, different components. For example, we can consider the earnings growth, but it is not very huge part of it. The another thing that we can consider is that high inflation, which is the nominal growth of their assets. But still, in my personal belief, there is this very high growth is something like bubble, which generated like from nothing, and there is a big fear of breaking this bubble, which will affect the financial sustainability.
I mean, the price should not be even an issue here, because you're looking at the ratio to disposable incomes, and they both go up with the price level anyway.
Yeah.
So this is a real kind of increase.
Yeah. This is mostly can be considered something that is a bubble, and that will break in the near future.
I hope you're wrong, but yes, there's certainly a risk.
Yeah. Going further, the next component, which also is a huge component of GDP growth, which is the government spending, and it is interesting to look at it because knowing that the unemployment rate is now at its Nairobi, the government still has almost 8% budget deficit. And they even have further expansionary policy, for example, about the aging and climate change issues, that will even widen the government deficit further. And most part of this deficit consists of the net interest outlays, which makes some problems for monetary policy makers. How this makes problems? Because there are two sides of this effect. First, for example, if we know that the government debt will increase in the future because of these new expenditures, in that case, the private debt has to be decreased, so the aggregate demand will be the same, consistent with the inflation target. In that case, for example, a central bank has to decrease the private debt. It can be done by the increase of the interest rates. But in this case, if you will increase the interest rates, it means you will make a huge problems for government to serve its debt. And as we know, the interest rates is now high. Net interest outlays in the government budget deficit is high. You will even make higher these outlays and make even higher, bigger problems for government. So from this perspective, it is very problematic for monetary policy makers to decide which policy is more appropriate. And this problem is not without its spillover effects, because it's not only affecting to the government's government's servicing its debt issues, but it also has its spillover effects on the financial markets, because the markets who will bear very big losses in capitals, because when they involved when they have assets with fixed rates, and the term premium will increase with these huge deficits, and if this term premium will increase, they will have a very big capital losses with the fixed rates that they have. Now I want to talk about the case B type of scenarios. First, I want to talk about the bank lending conditions. We can observe from the left side of from the left-hand side, we can observe the growth rate of credit and loans of the commercial banks provided by commercial banks. We can see that there is a decline of the growth in the growth, and mostly it is reflected in commercial and industrial loans. And this decline of the growth of credit and loans will eventually lead to lead down the purchasing power, and it will decrease the aggregate demand and make some deflationary pressures. And from the right-hand side, we can also look at the bank's tightening lending standards, again, compared to previous quarter. And again, we can observe higher tightening standards set by banks, which again drives purchasing power down by the same way. The next component we should look for is the labor market. We can observe that at this moment the unemployment rate closed its Nauru, and the average hourly earnings, the wage growth is consistent with the inflation target if we are underestimating the productivity. And but there is also some kind of fear that the unemployment rate will go up. In this case, by the from the market perspective, it will indicate that they will have to delay their consumption, which will even make deflationary shocks on the economy. Now let's look at the case and the A and B scenarios for US economy that I've constructed. We can look on the bottom side is the PC and core PC measures, 3-month over 3-month measures. And if the economy will develop in case A scenario, we can observe that policy rate will have to remain the same up until the even more than the market expectations. It's almost until the end of this year, and then lend very softly. There's a little decline in the policy rate. And in the opposite way, if, for example, inflation will go down more than the market expects, the policy rate again will be the same as the market expects until the next meeting of the until the next meeting. It will remain the same, but then it will lend harder. But the most important thing that today I want to talk about is the recommendations about what policy to implement, because all the scenarios that I have mentioned, you are aware. And but the way I want to introduce this is a little bit different. Why it is different? Because today I constructed a table which on the columns we have the components that, for example, if we follow this type of scenario, how it will affect on the different components, for example, inflation, unemployment, growth, and the interest rate, interest payments by the government that they need to pay. For example, if the A scenario will happen, and if we will follow the A scenario, but B scenario will happen, what we will have lower inflation, we will have higher unemployment, we will have lower growth and higher interest payments. Because we have higher interest rates, the interest payments will also be high. But on if oppositely, if we will follow the B type of, we will follow B scenario, but A will happen, what we will have is the higher inflation, but lower unemployment, higher growth, and lower interest payments. In more extremist thinking, when we will, for example, if we will follow A scenario, but they will, for example, why will happen? It means that there will be very huge recession. We will have very low inflation, very high unemployment, very low growth, and very high interest payments. In the opposite way, if we will follow B and X will happen, we will have very high inflation, very low unemployment, very high growth, and very low interest payments. Of course, what my recommendation here is to implement policy B. Even if A will happen, the cost for A will be less than following A path and B will happen. Why? Because we have these examples, for example, for Japan. If we will follow B path and A will happen, if we will follow A and B will happen, in that case, we will face some kind of recession, even though we will have, for example, inflation close to the target, but for other indicators, for example, like growth, unemployment, and also interest payments, which are very crucial at this moment from the perspective of government, we will have very
even inflation may be well below target. I mean, in line with the Japan experience, right?
Very low target I considered in ABY scenario, but even in AB we will have, you are correct, even we will have lower than the target, and we will face the problem of lower effective bound, which where we don't have the appropriate policy instrument to adjust the economy in a way that we want. So if I think the costs for following A and B happening is much more costly, and we will afraid of this much more than of high inflation if we will follow B scenario and A will happen. In this case, we will have, for example, high inflation, but in my personal belief, if we will communicate to the market in an appropriate way, we can mitigate this high inflation in some way. How I think this can be mitigated, for example, it can be done by communicating to the market that the policy rate should be even lower than they expect. And in this way, they will anticipate even lower inflation and delay their consumption, which will somehow mitigate these inflation pressures if a scenario will happen, if we will implement this big case. So for the next
well, they may, yeah, but on the other hand, right, they will, I mean, borrowing terms will become much better for them, right?
Of course, borrowing terms will become much better.
This could fuel both consumption and investment.
Of course, that's why if you lowered your interest rates in this graph, backing to here, if you lower interest rates, it will be more attractive for government to involve the debt. And from the other perspective also, if you lower your interest rates, the private debt will also be more attractive, and it will increase the purchasing power, and then also increase the aggregate demand and higher inflation. So you will have higher inflation, but it is still better, in my personal belief, than the fear of recession.
Yeah. Okay, no, that's a defensible argument, and you argued very well. What I would suggest is that you consider, obviously, if you can turn to, sorry.
Yeah.
I mean, some other ways to describe the dark corner scenario that Doug likes to talk about. Obviously, it would exacerbate whatever you have in the AB and BA. But the question is, and that's essentially a risk type based analysis here. But I would like to hear your views in terms of how likely these things are. So the ABY is where you essentially follow. I mean, you have high interest rates in a very low disinflationary true state, right? Which is the one you want to avoid, right? First of all, for both scenarios, the interest payments will depend also not just on how short-term interest rates evolve, but how long-term bond premia evolve, right? You could get an increase in term premia that reflect the risk of high inflation in this particular case, right? Or I mean, the risk here is that you have really you can in the ABY, the risk is that you could first of all affect financial stability quite a bit, right? You're keeping interest rates high, very high, even though the underlying economic activity is low. You're making this mistake. This would probably hit banks directly, and also indirectly to the effect that they to the effect that asset prices correct to a much larger extent. You could have a very substantial decline in asset prices here if you keep interest rates high in a low growth environment. So this would exacerbate what you're talking about here. I mean, you could have much bigger problems than just higher unemployment, etc., which is the case with AB scenario. On the contrary, so you may want to contrast that with the case where you get in the dark corner the other way, where you think you are in state B and loosen beyond what the market expects, but in fact you end up in case A with persistently high inflation, in which case you could unanchor completely inflation expectations. You could create very large term premium, right? And so it's these types of risks I think you could weigh. But this is a very nice discussion, the way you put it already here. These are additional factors to consider.
Yes, in my personal belief, that with the right what you have mentioned, I completely agree with you, and several of them I discussed in my presentation when I was talking about, for example, government debt or household balance sheet, and the risk that it contains. Of course, case A, even me, I believe more in case A that it will happen, but when considering from prudent risk management approach, what I am fearing is that the banks lending tightening conditions and labor market shows some kind of tightening indications. So it means that there is some probability that B scenario will happen, and even if this B scenario will happen and you will implement a policy, somehow you can be in a situation where you don't have any instrument to use. But when you are in a high inflation situation,
that was a very good point. Yeah, that you may hit the zero lower bound much faster that way. Yeah.
And also with the right communication, by working on it, you can even mitigate the impact that BA scenario will have on inflation, is high inflation. You can mitigate this effect somehow by right communications.
Okay, when we get to that point, we welcome your more detailed conclusion, because that might be a bit tricky to communicate. But thanks so much. Thanks so much, Miran. This was a very interesting presentation.
Thank you, Mr. Governor.
Thank you very much. Well, I'm not a governor, but thank you as well. It was a very good presentation.
Thank you.
Great. I think we have Satanik with us.
Yes.
Fantastic. So let me know, Yanis, when we are ready, and we'll start.
I'm ready.
Okay, fantastic. Therefore, let me introduce, before Satanik will start our presentation, let me introduce our mock governor once again. So we have with us Yanis Halikas, who is a senior advisor at the Better Policy Project, and he has experience of 30 years working in the IMF, obtained his PhD at Yale University under James Tobin. So welcome, Mr. Governor. And do you have any opening remarks?
Welcome to everybody. Yeah, we are trying to decide on interest rate policies in the period ahead. The markets are already taking into account the clear improvement in the inflation performance. Now inflation is on a clear downward path. They have reduced their inflation expectations. They are now expect us to start easing already in September and keep easing steadily. And in their view, that would allow for a soft landing towards our 2% target. Would like your views, is this a plausible type of scenario? It would be a very welcome scenario if it were plausible. But do you see risks in either direction? We do have strong GDP growth numbers recently. Do these reflect continued strength in demand that could prove that could delay the progress of inflation or even reverse it if they are strong enough? Could strong GDP numbers reflect factors, favorable supply factors that we may have been neglecting? So in the middle of this uncertainty, with all this uncertainty, very much looking forward to your assessment and policy recommendations and some ideas on how we could communicate our policy decisions credibly to the market, especially if they deviate from what the market is expecting currently.
Okay.
Let me just quickly thank you, Mr. Governor, and sorry to interrupt you, Satanik, but I would just like to introduce you first. Satanik is the macroeconomist at the Central Bank of Armenia who joined us recently and also level 1 GFS student. So we are now all ears. Let's go. Looking forward to listening to your presentation, Satanik.
Okay. Mm. Is it showing? Sorry.
Yeah, we can see it.
Yes, yes, very clearly. Thanks, Satan.
Okay. 1 minute, sorry. Greetings, Mr. Governor. Thank you, Alex, for introducing me. I'm excited to speak about applying risk management approach to the U.S. economy. I know that Governor is very familiar with FPAS Mark II, but I want to mention that FPAS Mark II is the next generation of FPAS Mark I, and here we are treating monetary policy as a risk management. And in this approach, we we analyze the economy and outline risks that are significant and concerning for us policymakers and also for markets. And to do this, sorry, it's not changing. Oh, okay. Is it changing?
Yeah, it's changing.
And for this, we are get rid of baseline scenario and building much scenarios, many scenarios. And before building that, we must answer three questions, important questions. Where is the economy now? What do we think might be driving it? And what do policy instruments need to do achieve basic policy objective? And to analyze U.S. economy for building scenarios, we must answer these three questions. And our scenarios are three type, case A, case B, and case 6 and Y. Here, case A scenarios are when a policy rate path needs to be higher than market expect. Case B scenarios is the vice versa. It needs to be lower than market expect. And case 6 and Y scenarios are everything that monetary policy are afraid, and it includes everything that necessary to avoiding dark corners, for example, high and variable inflation or raw inflation trap. And returning to questions, sorry, it's not, returning to questions, economy continues to grow, and we can start with question, where is the US economy? We can start with GDP. We see that the real GDP growth has been mainly driven by service consumption, and service consumption is particularly driven by healthcare and household renting, and we can see that they are also in underlying inflation. When we see here in measures of underlying inflation. Here are sticky CPI 3-month and sticky CPI 12-month. Sticky CPI 3-month is 3.2 and the 12-month is 4.2, which are high above from its 2% target, and this indicates that we have still a strong economy, and is this mostly driven by healthcare, entertainment, and household renting. Their change is far above from 2%, and this indicates that we have strong economy, and Fed must be aware of must be aware of the war against inflation is not over yet. And from
can you sorry, can you elaborate a bit? Why do we pay attention to sticky price inflation
because
rather than overall core inflation? I mean, the Fed
yes.
targets overall core inflation, but why to place emphasis on the sticky price.
Yeah, thank you for question, Mr. Governor. We are for us, it's important sticky prices because it's not changing over the years, one or two years, and we can see with us how market expects and how market behaves from this environment, in economy environment, and when our sticky prices is above, this means that they are expecting that that inflation is not going to its 2% target in recent times. That's why we are observing sticky prices.
Okay, yeah, please keep going.
From my perspective, this measure can fall under case A scenario because we see that inflation remains high and persistent and far from its target for past 3 years. And given this extended period, the Fed must be cautious as we are still experiencing some inflationary pressures. And we can also speak about household net worth regarding these inflationary pressures. We see that the total assets of assets of households is increasing, and we can see below table that from 2020 to 2023 the change is $50 trillion, which is a humongous number because it's twice time bigger than GDP of US in 2020, and this huge accumulation was due to in non-financial and financial part. It's a non-financial and financial components. Non-financial components are prices of houses, which are significantly increased, but in financial assets, we see prices on some assets, which are from 2020 are increasing. But I see that there is some uncertainty because in recent times the prices of some assets, stock market is decreasing. The trend is going too low, and this means that stock market is going to correction, but despite this, I believe that this will not affect consumption of households significantly because of psychological aspect of spending habits. I want to say that when people are used to a certain level of consumption, it's challenging to them to reduce it quickly. For example, if someone someone wants gets haircuts twice a month, for them it's difficult to change it to cut back to once in a month, and households generally find it hard to adjust their spending habit quickly. That's why I think there is not that much risks. But going to speaking about uncertainties, I want to speak about labor market because from different factors we have some controversial signals. We see here number of unemployed persons per job openings. The current number is 0.8, which meaning that 8 unemployed person for 10 job openings. And this could can have pressures from wage part because demand is higher than supply, and it can force firms to offer higher wages due to competition. And speaking about pull down factors, we see that leverage part is going to its normal level. Unemployment is going to its 4% level, but in the right side, we see that average hourly earnings are the growth of average hourly earnings is decreasing, but it's still high than CPI, and it remains higher, contributing some inflationary pressures. The trend shows that CPI line and although I think that CPI line and average hourly earnings line are approaching to each other, which indicating some cooling down effect. But as I said, the level is still remaining high, and going.
But real wages, even if when you adjust for inflation, real wage growth is still substantially below productivity growth, right?
Yeah.
I mean, you would expect wages over time to grow with productivity, real wages. So this, I mean, inflationary pressures here may be even weaker than you noticed, right?
Oh, yeah, exactly. Because we have productivity growth from technical sector, IT sector, and yes, as you said, Mr. Governor, we see that there is a cool down effect, and. Is going to say that we are seeing here job openings rate is going too low from 2022, but the level is still remaining high because we see below this table that all employees is the number of all employees is going high, and also job openings, the number of job openings is going too high. And I can say that this situation could fit in also both case A and case B scenarios. And because in some aspect the labor market is easing, but in some cases it remains tight. And going to a bank lending condition, we see that here I am fitting it in case B scenarios because credit and loans have decreased compared to year ago, which can drive purchasing power down. We see in left side some types of lendings are the trend of these loans decreasing, and also banks tightening lending standard. Banks are tightening their lending standards, and if this measure is above zero, this means that most of the banks are tightening their lending standards. And that's why it can be some cutting from demand side, and I am fitting this in case B scenario. And moving to sorry. Moving into fiscal policy, we see that here is expansionary policy. Here as are expenditures and taxes. The total deficit is increasing and is expecting to and it's expected to rising to in. Long term, which could disrupt policy making. The primary deficit is increasing, though its ratio. Also, I can here show. Yes, here I can show primary deficit and net interest spending. Primary deficit ratio is remaining the same, but net interest payment are rising, which could be problematic for monetary policy makers, because it can limit their ability to raise the policy rate as much as they need. That's why also I can speak about political uncertainties because elections are approaching and government expenditure is likely to be likely to rise, potentially creating inflationary pressures from a fiscal side. And from my perspective, the Fed should not cut the policy rate in September because we anticipate fiscal driven inflationary pressures in the fall due to the increasing in government expenditures and due to elections. And I'm gathering my case here. I'm gathering my case A and case B scenarios. In case A type scenarios are strong demand persists, considerations are strong demand persists, increase in household net wealth, also labor market remains tight, and increase in the government deficit. And in case B scenarios, recent labor market data indicates that the market is cooling down, tightening of the loan condition, and also stock market correction. And for building my case A and case B scenarios, it's crucial to know what market expects. And here market expects soft landing. Because they are anticipating that Fed will not cut the policy rate aggressively, and in long term they expect that the rate will be 3.5%, while the Fed's projection is 2.8%, indicating that market expectation are for soft landing economy. And here, as I said, here are the soft landing
What do you think,
scenarios.
Sorry, what do you think accounts for the difference between the market's estimate of the neutral rate compared to the Fed's?
I think that the differences are because of risks that Fed must consider and market don't consider it, because they don't see the long-term path, long-term economy, as I can say. I want to say that the Fed, I think, consider to bring economy its steady state more quickly than market expects. Also, they think that
that's absolutely true, but at the same time, the market thinks that the interest rate that's consistent with a steady 2% inflation at the end, I mean, the steady state, is higher than what the Fed considers it sufficient to keep it at 2%.
Yeah, and I want to say, Mr. Governor, that maybe market don't expect that the inflation will could go to its nature to target very quickly. That's why they in long-term horizons they just adjusted they bring adjusted Fed funds rate gradually, and like inflation, they don't think that it will bring its top target very quickly. It also goes to its nature level gradually, so its target level.
Okay.
And also I have built my case A and case B scenarios. As I said before, in case A scenario, Fed cuts its policy rate. Fed don't raise its policy rate. Instead, the Fed should remain the rate should remain the same for some time before eventually decreasing. This approach takes some inflationary pressures, absorbs inflationary pressures from fiscal policy side, fiscal policy side that will happen in fall. And in case B scenarios, I think Fed cuts its policy rate aggressively, because already the inflation is the trend is going to decreasing, and unemployment is 4%, and it can if the inflation is going if it will go lower than 2%, it can be it can be low inflation trap, dark corners. For that, I think that Fed must be cut its policy rate aggressively and adjust it very quickly for preventing such scenario. Thank you so much for listening me. Sorry for my English. It's my.
No, it was very understandable. Don't worry about it.
I'm so excited to describe my what I built. So that's all. Thank you so much for listening me.
Thank you very much, Sadhani.
Thank you very much, Sadhani. Sylvie, are you here by any chance? Yes, fantastic, great.
Should I start now?
Sorry?
Should I start now or in
Giannis,
F5?
can we start?
Actually, if you can give me a couple of minutes,
yeah, sure.
I'll be
No
right
problem.
back.
No problem. Okay, let's start once Giannis is back.
Yes, hello. Sorry for this.
No, it's okay. It's okay. So let's start with
Yeah,
our
absolutely.
that's our last presentation today. So before pass the floor to Sylvie. Let me introduce our governor, mock governor, Ioannis Halikas. Ioannis, who is a senior advisor to the Better Policy Project, as well as he had a huge experience working for 30 years in the International Monetary Fund. So Ioannis, is our pleasure to have you as our mock governor. And do you have any preliminary remarks?
Yes, hello, Sylvie. Great to see you. We are looking forward to your assessment and advice regarding our next policy move and the path for policy rates over the next few years. As you know, inflation has surprised everybody generally on the favorable side, let's put it that way. It has been coming down even faster than what we expected a few years ago. Markets have factored this in. They are now counting on an early easing of policies as early as September, steady easing after that. And on the basis of that, they are projecting reaching our 2% target without major unemployment issues over a 2-year horizon, maybe. We would, of course, welcome such a scenario if it materialized. However, we're looking at some other factors that might affect our decision. The real economy showing real signs of strength. We're trying to figure out where these are coming from. GDP is growing above our current estimate of potential. Still, despite the tightening that we have engaged in, this could reflect, on the one hand, very strong demand pressures or stronger than anticipated demand pressures, maybe even the building up of some bubbles in some asset markets that could be concerning. On the other side, of course, our potential may be wrong. We may be underestimating improvements on the supply side, better productivity performance. These are trends that are very difficult to catch in real times and have often led to policy errors in both directions. So with this uncertainty in mind, we would welcome very much your assessment, your recommendations regarding our next policy moves, and your views about how to best communicate our policy intentions to the market.
Okay, thank you
Perfect.
so much.
Thank you. Thank you once again. And let me just quickly introduce you, Sylvie, before we start your presentation. So Sylvie is a macroeconomist at the Central Bank of Armenia who joined us recently. And today, and also she's a student at the Global Forecasting School. So thank you very much, Governor, for your remarks. And Sylvie, I'm passing the floor to you, and we are looking forward to listening to your presentation.
I will share it. Thank you. Can you see my screen?
Yes, very clearly. Thanks.
Okay. Hello everyone. This presentation, which is about applying risk management approach to the US economy, includes current analysis for the US economy, and as well as the simulation of illustration of case A and case B scenarios to it. And to do this, we need to analyze the current state of the US economy, to examine the driving forces, and also to understand how to adjust the policy instruments to achieve main policy goals. And so let's start by understanding the current state of the economy with the GDP growth. And here we can say that GDP growth remains at a high level. It's with a 2.8% growth in the second quarter of this year. And according to Atlanta Fed GDP now estimate, it will stay at the same level for the next quarter. And the growth is primarily driven by personal consumption expenditures and especially service consumption. And we can see that this contribution of personal consumption expenditures to GDP also increases for last 2-3 quarters, and if it was approximately 1.5% for the second quarter of this year, and according to Atlanta Fed estimations, it will be around 2% for the next quarter, which is a really high indicate a really high level. And if we can say that if this tendency continues and this contribution of PC to gross domestic product will be higher for the future, we can see that it will have more inflationary pressures on the US economy, and in that case, all this situation will be at KZ type of will be corresponding to KZ type of scenario. And we can say that the main reasons for consumption to be so strong is the household net worth, and this indicator, household net worth, as a percentage of disposable personal incomes, is a very high level for last several years, and it's still higher than its historical average level. And these high level is mainly thanks to financial assets, the increase of financial assets. We can see that also both financial and non-financial assets have increased for last 4 years. But if we compare them, we can see that from first quarter of 2020 to first quarter of 2024, non-financial assets increases with around $20 trillion, whereas financial assets increase around $40 trillion. And also these we can see from the stock market that some these indicators indexes indicate a significant contribution, also indicate a significant contribution to households' net worth, and which in turn leads to increasing consumption. And if all these tendencies continue to be in the future, we can see that the inflationary pressures on the US economy will be higher, and all this situation will be KZ type of will be like a KZ type of scenario. And also, we have sticky price inflation. As I already said, the main driver of GDP growth is service consumption, and we can say that as this sticky price inflation still remains above its target, it's one of the main reasons for it. It's still high inflation in the service sector, and though this sticky price inflation decreasing and even quicker than it expected to be, but it's still remains a high level. And if some factors that I mentioned before will be some tendencies will be continued. We can say that I think there are some risks that for this inflation to decrease the to have even more increasing this indicator. Also,
Sylvie, could you explain a bit why we focus so much on sticky price inflation rather than, for example, the Fed's? The Fed's target, Fed's target is core overall inflation rather than sticky price. Why is this indicator important to monitor?
I think it's because of for in core overall inflation, we have both sticky price and flexible price inflation parts. And as we can see, flexible price inflation is decreasing more than sticky price inflation. And it's, if I'm not mistaken, is even negative at this time. But also core inflation is still we can say that it's near more near its sticky price inflation than flexible inflation. And if as the flexible inflation decreases, for us it's more important sticky price inflation to take into account as it is decreases, or the core overall inflation will decrease too.
But presumably you're monitoring sticky price inflation as an indicator of what to expect from overall inflation, overall core inflation, which is the Fed's target, right?
Yeah.
But anyway, keep going. I don't want to divert the discussion too much. It's something to maybe you need to explain a bit more clearly.
Okay. And on the contrary, for case A scenario, we can see that the net percentage of domestic bonds tightening standards remain at a high level, though although it has decreased over the last several quarters, and it also has a little increased just the last quarter, but still remains above zero level, which means that even not much, but there are still some banks that continue to tighten their lending standards. And also,
if I could strengthen your argument here, how to read this chart, right? As long as it remains above zero, the last example, the last observation, tells you that 20% more banks tightened relative to the previous quarter. So if you look at the banking system as a whole, the tightening increased relative to the previous quarter. As long as this is above zero, it means that the tightening has continued. It's even more pronounced, right? Because these are changes relative to the previous quarter. So now you have 20% more that say they tightened the lending standards.
yes,
So
and
to make your point even stronger, yeah,
yeah, and if this tightening will continue for the future, we can say that the deflationary pressures on the U.S. economy can be more strong. But for now, I think that even these tightening standards have some deflationary pressures, but that these are not as significant as the inflationary pressure. If we compare between them, I think that the inflationary pressures will be higher as because of increasing net worth, consumption, and net asset prices. And also, from labor market, we can see both inflationary and deflationary pressures here. When we look at the unemployment persons per job opening, this ratio, we can see that it's it's below 1, which means that we have less than one unemployed person for a new opened job position. So it means we can say that this indicator shows that we have a little more supply for demand for labor than supplies, which is indicator labor market to be a little tight, and which in its turn we can have some inflationary pressures on the U.S. economy. When we look at the other chart, we can see that growth of average hourly earnings of employees is decreasing, and if this trend continues, it can also affect the as well unemployment rate as well as the consumption, and have some deflationary. We can have some deflationary pressures from here, and also we can see these deflationary pressures from the fact that these difference between average hourly earnings of all employees and consumer price indexes continually decreasing. Um, and for the last part, I have case A and case B scenarios for the US economy. And at first we need market reference scenario to be based on market expectations. And as we all know, we have for case A scenario policy rate path higher than market expects, and for case B scenario, this path we need to be lower than market expectations. And in case A scenario, we anticipate the inflation rate to be higher than market expects because it's driving by such factors such as increasing consumption, household net worth, and stock market indexes. And all these factors will keep inflation, will have inflationary pressures. So to for that, we need Fed funds rate to be higher than market expectations to bring inflation back to its target. And in the case B scenario, if bank lending standards tighten further, we will have some deflationary pressures, and in that case also we will have some from and labor market, we can have some increases the unemployment rate, and in that case we need Fed funds rate to be lower and to be lower to market expectations. And comparing these scenarios, I think that the risks of inflationary pressures can be a little higher than those of deflationary pressures. So for now, it will be, for now, it will be right to have a Fed funds rate to keep Fed funds rate at the current level. And we can communicate it as follows, that of course there are both inflationary and deflationary pressures on the US economy, but based on the current analysis, we think that these inflationary pressures can be a little higher. So for now, it's important to have this Fed funds rate to keep it at a current level, and we'll adjust it appropriately according to future economic conditions to achieve our target. So that's all. Thank you for your attention.
Thank you. Just one question on your last point.
Uh,
I think that's a nice way to communicate it in terms of what the risks and the relative costs of being wrong are. If you could elaborate, suppose we follow your recommendation, right? And unfortunately, we can't observe the real state of the economy. So the policy error would be that we follow your recommendation on interest rates, but the economy is actually described better by case B. We are in a disinflationary slowdown, economic slowdown scenario. What effect would this have? What would be the costs of this policy error? What do you think the main effects are going to be if this were to happen?
Sorry, can you repeat it again?
Suppose, yes,
Uh,
suppose we stick to your policy advice, right? We keep interest rates above what market expects, as in scenario A, but the economy actually is in case B, right? So, what types of effects would we expect there, and how serious would the costs be if we made this type of error, which is very common in monetary policy?
I think in that case, the communication part for now is the most important, as that's right. I mentioned that for case A, for me the risks are higher than for case B, but also I think that for now. If I suggest to keep the inflation rate higher, to keep inflation, to keep the interest rate at the current
Interest rates.
level, it doesn't mean that I think that the decision will be only for the case A scenario. I think just it will be appropriate to not change the policy rate, and in some cases wait the further changes on the US economy or on the environment, and I think it's in that case it's important to not have some we can say bad losses in this case, as we mentioned, to have that we can have in case B scenario when it comes through. But I think it's we need to communicate all our decision like that market always will be assumed that we even if we now keep the interest rate at the current level, if there are more risks in the future, that case B will be more realistic. In that case, we will make decision for our other future meetings in according to case B scenario to manage those risks.
Okay, great. Thank you. Thank you so much. Thank you so much, Sylvie.
Thank you.
Thank you so much, Sylvie. It's really good, and this is the end of our presentations today. So assuming the fact that our mock governor is leaving soon, going to Yerevan and then back to Portugal. Hence, we would like to thank you, Ioannis, for staying with us, for
Thank you so very much. It was very
raising, for listening,
as
for
always,
providing some
very
comments.
enjoyable and a very good experience.
I'm really glad that you
Ioannis.
enjoyed it too. Thank you for everyone who's been listening. Like I see you, Timur here, but also Sylvie, Satanik. Thank you, Asya, for streaming that, and thanks for our
Yes, big
online
thanks,
audience.
Asya.
I'm curious to see the watch time. I'm not sure whether there's anyone who has been watching us for 9.5 hours straight today, but if there is someone, well, then congratulations. For sure, it would be
Strange preferences. People have strange preferences.
But you never know. You never know.
Yeah.
Timur has been very good in summarizing all of our materials. So economic superstars, I believe, happen and exist.
And what about my presentation? Because I thought that it is my turn to present today.
Oh no.
We haven't been informed about that.
Actually, we scheduled it with Doug that on Tuesday on 5 o'clock Armenian time.
We didn't know.
But I mean, as soon as my
Sorry,
presentation is ready,
there will be more sessions with another other guy.
Yes, but the problem
Unfortunately,
is like we wouldn't even mind doing it now, but Yanis has to leave to
yeah, I
Yerevan,
have to.
and
I've
therefore
already
it's
delayed
not
it.
possible.
Sure,
So
sure,
sorry for
no
that.
problem.
We were on the
Sorry
tight
for this.
schedule.
No, that's terrible.
So
We should.
I
No,
guess
no
some
problem. Just let me
miscommunication.
know when.
Absolutely.
Yeah,
I will
yeah.
contact you, or I will clarify it with Doug, and then Doug will contact you. It depends. Well,
Sure.
I hope that this 20 minutes was well spent for you. And if there's anything, just write me in the chat in the future. So you don't need to wait here. But I hope you enjoyed Sylvia's
No, it's
presentations
our
as we
fault.
all
We
did. So
certainly let you know.
yes. Let us know in the future. And thank you so much again. Well, great. See you.
See you.
I believe, Asya, that you can finish streaming. We don't need it anymore today.
And thank you, Johannes, for your insights. It was like really valuable, and have a
Oh,
good.
it was great pleasure to work with you, Rudik, and everybody. And we'll touch base again. Don't worry.
Thank you.
Bye-bye.
See you.
Have a good
See you.
trip.